Good morning, ladies and gentlemen. The event will begin shortly. Kindly make your way into the hall after your breakfast. You're highly encouraged. A very good morning once again. Our event will begin in a couple minutes of time. Kindly make your way into the hall after your breakfast. Please take your seats closer towards the front of the stage. Thank you. A very good morning, everyone, and here's another gentle reminder to make your way into the hall now. The event will begin in less than 2 minutes' time. Thank you. Good morning, ladies and gentlemen. Welcome to iFAST Mid-Year Review 2022. This event is jointly organized by FSMOne and iFAST Global Markets Singapore. This year, iFAST is proud to bring together some of the firm's best investment and wealth advisory professionals and fund management partners to offer their perspectives on what has been happening in the financial markets. In the morning session today, look forward to hearing investment opportunities and ideas shared by our research teams and product experts. In the afternoon, we will cover some of the best ways to implement investment ideas and examine the critical aspects of wealth management. Our wealth advisory professionals will also come together for a candid sharing of what investors should be doing in order to meet your various financial goals. We would like to also take this opportunity to thank our partners, Nikko Asset Management and BlackRock, for making this event possible. In addition to today's presentations, we've also lined up some exciting activities for both our viewers at home and in-person attendees to join in. There will be 2 quizzes today, so pay close attention, and you could be one of the 12 winners to walk away with $50 worth of Grab vouchers. To our in-person attendees, you might have noticed a number of partner booths set outside on your way in earlier today. It has been a long while since we could interact face-to-face, so take the chance later to catch up with our investment experts and product specialists who are here on hand to answer your questions and share their knowledge with you. If you're watching this at home, it's not too late for you to join us at the Star Vista's Star Gallery. Other than mingling with our industry experts and like-minded investors, you will also be able to take part in our live in-person lucky draw to win attractive prizes such as a MacBook Air and shopping vouchers. We've got a great program lined up for you today, so let's begin the morning session. Our market outlook for the second half of 2022 will be presented by Tan De-Jun, Assistant Manager of the Research and Portfolio Management Team at iFAST Singapore. De-Jun, please.
Hey, morning everyone. Okay, good morning everyone and welcome to Mid-Year Review 2022. So it's been a while since we had our first in-person event, and to all of you who haven't been to any yet, I'd like to welcome all of you back. And we hope that you find this refreshing compared to all the webinars that you have been attending. So my name is De-Jun, and I'm with the research team here at iFAST. And for today, to kickstart today's event, I'll be covering 2 major topics and also to give you guys a recap on what has been going on in markets over the first couple of months. But really, I just want to talk about 2 major topics. And the first is inflation, and the second is interest rates. So both these topics, they go hand in hand, and together, they have also dominated much of our news headlines since the beginning of the year. So my goal today is actually very simple, and that is to give you guys an update of where we are in terms of inflation and interest rates, what to expect going forward, and more importantly, how you can position your portfolios for this new environment. So without further ado, let's get started. Moving on to the next slide. So the US economy has come a long way since the start of the pandemic. As a matter of fact, it experienced a stunning recovery, posting some of the strongest GDP growth numbers seen in this decade. In 2021, US GDP growth expanded by 5.7%, compared to a contraction of 3.4% in 2020. And this is really due to the massive pandemic stimulus, unemployment benefits, high vaccination rates, and also the earlier than expected economic recovery. And all these things together, they actually powered the US economy to be among the top performing equity markets in 2021. But in hindsight, most economists, they now agree that the massive pandemic stimulus have actually been too much, and that has actually contributed to the high inflation that we have seen in the US today. So as you can see from the chart, can you go back to the next previous slide, please? So this chart over here, it shows you the M2 money supply in the US. So this is basically a measure of the total amount of money that is in circulation in the US economy. So you can see right up to the pandemic, money growth was pretty stable. Up until 2020, it suddenly shot up. And from then on, it also increased at an increasing rate all the way until the recent months, until it started tapering off. And this is really due to the massive stimulus packages that the US government has handed out in order to sustain the economy through COVID-19. And like I said, this has contributed to the high inflation numbers that we have seen in the US. Moving on to the next slide. So after moderating in April, US inflation unexpectedly accelerated again in May, this time by 8.6% year on year. While the increase was broad-based, components such as food, energy, and shelter, they were the main contributors to May's inflation numbers. And moving on, with consumer prices showing little signs of easing, the Fed has been forced to take one of the most drastic measures in recent history, and that is raising rates by 75 basis points in June. So the last time they actually raised rates by 75 basis points was actually more than 28 years ago, and this goes to show how committed and in a way desperate the Federal Reserve is when it comes to bringing down inflation. And given the fact that monetary policy, it often works at a lag, and the fact that inflation today, it is largely driven by supply-side issues rather than demand, higher rates might not be the most effective way in bringing inflation down. So overall, we expect inflation to stay higher for longer. Moving on to the next slide. So there are many reasons why we think inflation will stay higher for longer. Right now, there are plenty of upside risks to inflation. So these upside risks include things like an escalation in the Russia-Ukraine crisis, new lockdowns in China, and also rising global food protectionism. So all these things that you see over here, they do have the potential to add to inflationary pressures, but at the same time, they are also beyond the control of the Fed. And this is making it a very tricky problem. And out of all these things that I've mentioned today, I think an escalation in the Russia-Ukraine crisis, it is perhaps one of the most critical issues of them all, given its potential to have an outsized impact on both food and energy prices. And this is because both Russia and Ukraine, they play a very integral role in the supply chain for both sets of commodities. So Russia and Ukraine, they combine to supply nearly 1/4 of the world's wheat. And on top of that, Russia, it is also a major energy exporter, especially to its neighbor Europe, where it accounts for about 40% of the continent's natural gas imports. Therefore, any escalation in the Russia-Ukraine crisis would send food and energy prices rising. So in the case of, and on top of that, like I mentioned earlier, interest rates, they will likely have little impact in affecting food and energy prices because these are largely driven by supply-side issues, and food and energy, they have their own set of factors that are affecting inflation. And in the case for food, rising population growth, climate change, and things like the decreasing abundance of arable land is causing a shortage of food, driving food prices up. And as a matter of fact, you can see from the chart over here very clearly that food prices, they have already been on an uptrend even before Russia invaded Ukraine in 2022. And this is largely due to supply-side issues such as rising food protectionism. Moving on to the next slide. So back in 2021, China, they actually tightened the control on the export of fertilizers in order to stabilize domestic prices. So while this move is considered a success in some way, and by that I mean domestic prices of fertilizers in China, they have not risen as much as global prices. Prices today, as you can see from the blue line, it is still higher from where it was when China actually introduced these export restrictions. And this makes it more likely for the government to keep these curbs in place while leaving the rest of the world to contend with higher food prices, higher fertilizer prices, and hence higher food prices. And looking ahead, we do expect higher prices to stay at least until these various supply chain issues are resolved. Moving on. Now, for energy, a confluence of events such as a rapid global economic recovery and especially an exceptionally long and cold winter that depleted stored energy supplies, and also years of underinvestment in the oil and gas industry all had a hand in pushing energy prices higher. And if you throw in the fallout from the Russia-Ukraine war, that's how you get energy prices sitting at their highest level in this decade. So just weeks ago, Gazprom, which is Russia's largest state-owned energy giant, it actually cut its gas exports to the European countries via the Nord Stream 1 pipeline by as much as 60%. And this affected more than a dozen European countries. So Russia's latest actions, once again, reignited fears of a widespread energy crisis, sending energy prices soaring again, as you can see from the chart. And to make matters worse, there has been a severe underinvestment in the oil and gas industry over the past few years. So in 2021, the total investment in upstream oil and gas only amounted to about $350 billion US, as you can see from the chart over here. And it is also significantly lower compared to the past few years. And this is despite the fact that 80% of the world's energy, it still comes from fossil fuels. And the reason for this underinvestment, it is largely due to ESG concerns, and also because many companies, many countries, they are starting to pivot away from fossil fuels and into clean energy. So Europe, for instance, is making plans to speed up its transition to clean energy in order to reduce its reliance on Russia in the wake of the war. However, this transition is not going to happen overnight. It still takes time. And during this time, we expect energy prices to remain higher. And also, energy prices, they are also likely to stay elevated or possibly climb even higher, especially if Russia decides to cut off Europe's gas exports completely. And as we head into the winter months where energy demand is typically the highest throughout the year. Moving on to the next slide. So adding to the inflation problem is America's red-hot labor market. As the US started to reopen, companies, they struggled to find workers to fill job vacancies. And although the lack of workers, it can be attributed to many different reasons, many of these reasons can actually be traced back to one thing, and that is the Great Resignation. So thanks to the US saw a surge in early retirements during the pandemic. Between February 2020 and February 2021, the US retiree population rose from 18.5% to 19.3%, which is roughly equivalent to 2 million people. And early retirement is also estimated to be responsible for more than half of the workers missing from the labor force compared to pre-pandemic levels. And another reason, aside from early retirements, is also the surge in wealth during the pandemic. Like I mentioned earlier, the massive stimulus, or the unemployment benefits, these things are keeping people out of the markets. And on top of that, if you throw in rising stock prices, rising home prices, consumer balance sheets today, they are actually much stronger than where they were before, giving workers more confidence to stay out of the job market and causing this tight labor market that we see in the US right now. So this lack of workers, it is actually forcing companies to raise wages in order to attract the talent that they need. And this itself adds to inflationary pressures. And on top of that, with higher input costs via wages, these companies, they are also more incentivized to raise the prices of their products and services, thereby passing these costs on to consumers and adding to inflation even further. And overall, this, with all these reasons that I have mentioned, supply-side issues in food and energy prices, and also the tight labor market, we do expect inflation to stay higher for longer. So higher for longer, it doesn't mean higher forever. I just want to make this very clear to everyone, okay? While we do not expect inflation to stay at the levels of 8 to 9% like we've seen over the past couple of months, we do expect it to actually moderate lower in the future. And this is really due to a number of reasons. So the first reason is base effects. Inflation, it is measured on a year-on-year basis. This also means that for inflation to come down, prices, they actually don't have to drop significantly. They just have to stabilize, and the math will take care of the rest. And if we assume a very bearish scenario where inflation doesn't come down, prices keep on rising, and if you take crude oil as an example, if the price of crude oil were to continue rising at the same rate as it did over the past year, by 2024, 1 barrel of crude oil will cost nearly $200, which is way higher than the all-time high in 2008. So think about it. When crude oil prices are at $200, how much will you be paying at the pump? Many consumers, they are not going to be paying such high prices for a prolonged period of time. It is simply not sustainable. And that brings me to my second point. When prices are that high, demand destruction will kick in, bringing prices and bringing supply and demand back into balance, and hence prices also. And the last reason is the Fed. The Fed remains extremely committed to bring down inflation, even if it causes a recession, as we can see from its current rate hike policy and also the recent statements that many of the Federal Reserve members have been making. So the Fed has actually raised interest rates 3 times this year already, and they started with a 25 basis points rate hike in March. After that, they move on to 50, and now we're at 75. And there are talks of more 75 basis points rate hikes in the future to bring down inflation. And like I said earlier, this really goes to show how desperate the Fed is when it comes to bringing down inflation, because they know that they cannot let this problem get out of hand. Having inflation going out of hand is way worse than having a recession in the economy. And overall, while we do not expect inflation to stay at 8 to 9%, as we've seen over the past couple of months, we do expect longer-term inflation to settle around 4%, and that is already higher than the Fed's target of 2%. So consumer inflation expectations, they are already anchored at a higher level, and with the growing labor shortages, a renewed focus on food and energy security, we believe that the world we are living in today is heading to an environment of higher inflation. Moving on to the next slide. So many investors, especially the younger ones, we are used to living in a time where inflation has not been a major problem, and the ultra-loose monetary policy meant that credit was easily available, not to mention very cheap as well. So that is the reality that we've all been living in over the past 10 years or so. But with the impending rise in interest rates, this reality that we are so used to, cheap money, cheap credit, it is all about to end. It is all about to change. So in the coming months, borrowing costs are expected to rise. And according to SingStat, a typical Singaporean household debt is made up by 70% mortgages, and the remainder is made up by other personal loans, things like your car loans or your credit card loans, so on and so forth. So an increase in mortgage rates will really affect consumers. And between as of May this year, the 2-year fixed rate loan has already doubled compared to where it was in December last year. And I believe over the past 2 weeks or so, you have seen plenty of news. There's been reported that many of the banks have started to reprice their mortgage rates. And now mortgage rates are likely even higher than where they were in May already, seeing that the banks have already gone through another round of repricing. And this is not just for fixed rate loans. The cost of floating rate loans is also going to go up as well as benchmark rates such as the SORA continue to rise. And given that the SORA is a backwards looking rate and it tracks the Fed funds rate, and if we were to assume that the Fed will continue to keep tightening according to the path that it has predicted, we can expect the SORA to keep rising in the future as well, and that will increase the cost of floating rate loans for consumers. And if the SORA were to reach the same levels as it did in 2006, 2007, which is around 3 to 3.5%, and if you throw in the spread that the banks add on top to the mortgage rates of about 1% on the low end and perhaps 2% on the high end, it is not unthinkable that mortgage rates could go as high as 5% in the future. Scary, right? So, but the main point of this is I'm not trying to scare you into thinking that you should quickly go and refinance your mortgage or go and prepay your loans before you're buried under the weight of all the interest payments. What I'm trying to do here is really just to make you aware that things are changing rapidly, and we've been living in an era of cheap credit for the past 10 to 12 years, and many investors, they are just not ready for a high interest rate environment. So the last time interest rates were at 5%, I think perhaps many investors, especially the younger ones, they are too young to remember or too young to even understand what interest rates are. And so we've been living in an era of cheap credit, but that is about to change rapidly. So unfortunately, I'm not a mortgage specialist, so I can't advise you on what to do with your mortgages, whether you should refinance, whether you should prepay. But what I can do is to give you some tips on how to position your portfolios for this new environment. So here are some ways you can do so. So the first thing that we advocate is value over growth. So in a rising interest rate environment, investors should look to reduce the equity duration of their portfolios by focusing more on companies that derive their valuations more from current fundamentals, aka value companies, rather than companies that derive most of their valuations from earnings that are way out into the future, also known as growth companies. And on top of that, value also tends to outperform growth in a period of high inflation and rising rates. So for investors with very growth-heavy portfolios, such as those that are heavily weighted towards US equities, you may want to consider adding some value exposure to your portfolios. And you can do so very easily via a value-oriented fund or ETF, one that uses specific value metrics like price-to-earnings ratio, return on equity, dividend, to screen for stocks that they buy into. Alternatively, if you look beyond the US market, you can also choose to invest in markets with relatively cheaper valuations, such as Asia ex-Japan, Japan, and China. So for one, I think China is really becoming very interesting given the recent changes that we have seen with regards to COVID policy and also how the government views the Chinese tech companies as a whole. And later on, my colleague will be anchoring a session all about China, and he'll be telling you guys more about why he thinks now is a good time to invest in China. So please make sure you stay for that session. Now, moving on, with inflation likely to stay elevated and or worse, trend even higher, commodity prices, like I mentioned earlier, do have the potential to go even higher. And to hedge against this potential rise in inflation, we advocate that investors can invest in commodity-related equities as a potential hedge against inflation. And moving on to fixed income, we advocate going short duration, reducing the duration of our fixed income portfolios, and this is really to protect against a faster than expected rate hike environment like the one that we are expecting. On top of that, investors with a slightly bigger risk appetite, you can also consider an exposure to Asian high-yield bonds. So Asian high-yield bonds right now, they provide one of the highest yield per unit of duration, which can be a buffer to potentially offset the rise in rates. So these are basically some of the ways you can think about to position your portfolios for this upcoming environment. Of course, this list is not exhaustive. Depending on your own risk appetite and your own investment horizon, you may want to make some changes to the way you position your portfolios. But for those of you who are pretty lost, have no idea where to start, I think this would be a good place for you to begin. These are some minor adjustments that you can make to your portfolio today. And with that, I've come to the end of my sharing today. I would like to wish everyone all the best in your investing journey, and I hope everyone can make lots of money this year. Thank you.
Thank you, Dajin, for your insightful presentation. Now on to our next segment. This will be presented by Chloe Halim, Research Analyst of the Research and Portfolio Management Team at iFAST Singapore. She will be sharing about the Commodities super cycle. Over to you, Chloe.
So hello everyone, thank you for joining us today. My name is Chloe and I'm a research analyst from iFAST Singapore. For today, I will be sharing more about what is happening within the commodities space and why we think that oil prices could actually reach $150 going forward. So here's the outline for the presentation today. I'll be sharing on crude oil in particular, as this is one of the most highly traded commodities out there. And it's also a major source of the global energy supply. So much so that an analysis of the commodities market will not be complete without looking at what is going on within the crude oil market. So to start off this presentation, I'll be sharing some of the factors behind this commodity super cycle which we are currently witnessing. And beyond this, we also see this longer structural trend on underinvestment that is bullish for the overall sector. Not to mention, in this inflationary environment in which we are currently in, commodities, they help to serve as a useful inflation hedge. And last but not least, with all this being said, we think that oil prices could remain elevated and could even reach $150 a barrel. So in the next slide, there's no commonly agreed upon definition of what exactly is a commodity super cycle. But typically, it's been used to commonly describe a period where the commodity prices, they rise above their long-term trend. So back when COVID-19 pandemic first struck us about 2 years ago, I think we all know that the world's appetite for raw materials, it plummeted. And with this, so that the demand fell and the prices actually collapsed. But yet, it was not long again before these prices were soaring as the global economies, they eventually and gradually recovered from the pandemic. And to make matters worse, what happened within this year is that we saw this Russian-Ukraine war. And this is a war that actually caused a massive supply upheaval, especially to this commodity space, and in a manner in which many of us have never seen before. As after all, this is not just a shock to the oil supply, but that to every single commodity out there, such as grains, cooking oil, metals, so on and so forth. So behind this commodity supercycle actually lies this demand-supply imbalance that's observed within this whole space. So on the next slide, when we look at crude oil in particular, I think this is something that we can relate to. There's an increase in global oil consumption, and this is attributed to the pent-up demand for travel, especially after lockdowns have been lifted and countries were now opening up their borders. So people were actually eager to make up for this lost time, especially in the past 2 years, and were now eager to get on board the plane to actually travel. So the total demand for air travel actually increased significantly in April this year. And you can see that in the table where it actually rose about 78.7% on a year-over-year basis. And this whole April air passenger data is actually a cause for much optimism, as you can see that air travel in general has increased across the various markets except for China, as they continue to have some restriction. So nevertheless, the message is that as the global air travel makes their long-awaited recovery, it brings with them a stronger demand for oil. Not just air travel, we see the case where this global demand for oil will actually continue to rise in the third quarter of this year as the Northern Hemisphere's summer driving season begins. So during this time, you'll see that there are lots of cars on the road, especially in the US, and this will be one of the most heavily traveled times within the year. So going forward, OPEC actually expects to see a strong global oil consumption as well as a strong global oil demand. So they're projecting about an increase of about 3.1 million barrels a day and to average about 101.8 million barrels a day in the second half of this year. And this is a pretty significant number as it will actually surpass pre-COVID-19 levels. And to make matters worse, while this demand is growing, we see the case where supply fears have actually worsened. So I think we all know that there are new sanctions against Russia now, given that EU members, they agreed on a partial crude oil ban that covers more than 2/3 of oil imports from Russia. So this is an embargo that covers Russian oil brought in by sea, and they allow a temporary exemption for imports that are delivered by pipelines. So why this is the case is because this was actually a move that was crucial to getting Hungary on board, and the EU needed to achieve some form of common consensus to get there. So all in all, the EU has also agreed to slash Russian oil imports by up to 90% by the end of this year. So as Russian exports, they fall sharply, the country's facilities will naturally start to cut production. So output, it tends to average at around 10 million barrels a day in May, and this may drop to about drop by around 1 to 2 million barrels a day, according to some analyst estimates. And this International Energy Agency is going as far as to suggest that Russian oil production could actually drop about 3 million barrels a day. And in the next slide, we see the case where despite all these fears being there, OPEC as a whole, they actually failed to alleviate a lot of their investors' fears. So OPEC, they committed to accelerate this output increase, but then again, we see that this group actually said they're going to add about 648,000 barrels of oil per day for July and August. But this is about 50% more than previous increases seen in recent months. However, we do note that over time, OPEC as a whole, they struggled to actually meet these production targets. So if you look at this table here, you will see that In May, OPEC actually produced less barrels compared to April. So OPEC's production in May was actually down about 176,000 barrels per day compared to April. And this can be attributed to the shortfalls coming from Libya, Nigeria, as well as Iraq, for instance. So overall, OPEC has also produced about 2.7 million barrels a day below their production target. So I think this whole table illustrates to show that OPEC has actually failed to actually kind of alleviate supply fears over time. So in the next slide, other than that, I also want to highlight that within OPEC, not many of the countries, producer countries within them, have a spare capacity. So where it stands, only Saudi Arabia and UAE, they are the only OPEC nations with spare capacity. So between both of them, they have about 2.4 million daily barrels of unused output to deploy. But we see that this is actually unlikely to keep pace with the expected incremental amount of 3.1 million barrels a day as projected by OPEC. And not to mention that these current agreement terms between OPEC, they do not allow these nations to compensate for other nations who have production shortfalls. And furthermore, it's expected that this extra spare capacity from Saudi Arabia and UAE would be offset by even greater decline from other member nations such as Iraq, Libya, as well as Nigeria. And not to mention that we continue to see that this loss of Russian oil supply will continue to weigh on the global markets. As oil struggles to keep pace with the demand, it's natural we see that the world, they start to draw down on the existing crude oil stocks. And we see that overall, the crude oil inventories across the globe have actually been falling. But beyond this, we see this longer structural trend of underinvestment that is bullish for the overall sector. So I'll be going in detail within the next few slides. So underinvestment, they tend to precede a commodity super cycle. And this is precisely the underinvestment within the space that have been a key contributor to the shortage of fossil fuels. So this is unsurprising, as the oil and gas industry have been one of the most disliked as well as out of favor sectors within the recent years. And the simple reason behind this is due to many ESG concerns. So there are many ESG mandates out there that restrict capital to this industry that actually pose major challenges for a sector that badly needed new investments to keep up with the growing demand. So the result is that the annual investment in upstream oil and gas actually peaked at about 780 billion in 2014. And it has been on a decline ever since then, despite the fact that the world as a whole is still consuming record amounts of fossil fuels. So take, for instance, about 80% of our global energy needs comes from these fossil fuels. And if we look at the case of, let me give the example of oil refineries, for instance. So about just 2 years ago, the margins for refining oil, they were actually in the dumps due to the pandemic. And because of this, a lot of these refining capacity have been shut down. So about 4 million barrels a day of refining capacity has been shut down since the pandemic. And while this situation has now reversed, with these oil refineries now making record margins, as illustrated by the crack spread seen on this chart, we find that the waves of refinery closure since the onset of the global pandemic, they've already done their damage. As countries continue to pursue these net zero emission goals, we continue to see that we'll expect more refinery shutdowns with time, as this can be, after all, considered a rather dirty industry. So a key takeaway that I have from these two slides is that this is a sector that needs a lot of investment, and the prior underinvestment within this space would actually take years to rectify. So greater investment is needed to grow the supply and actually debottleneck the entire system in order to accommodate more demand for crude oil. However, ESG concerns will continue to prevent companies from investing in this space, and we do not see that over time investments will start flowing into the sector, and this ensures a persistent supply deficit compared to that of the demand. So at the backdrop of whatever that's happening now is none other than that of inflation. So commodity prices, they have been one of the main drivers of what has become one of the highest inflation in a generation. So in the next slide, you see that inflation is now running at the highest levels in a way that we have never seen before. I gave the example of the US CPI index, which actually increased 8.6% year over year, and this exceeded all expectations in May. So in a high inflation environment that we are currently in at the moment, commodities, they typically outperform other asset classes. And overall, there's a strong correlation between that of the Bloomberg Commodities Index as well as the US CPI Index. And what this means is that it actually highlights the effectiveness of commodities as an inflation hedge, as seen in the chart above. So given that there are many supply constraints out there, which continue to mean that the commodity supply would be unable to catch up with this demand, we do expect that commodity prices will continue to remain elevated in such an environment. And so what this also means is that commodities-related equities, they remain a decent hedge in one's portfolio. So with all this being mentioned, we think that oil prices could actually remain elevated and could reach $150 a barrel. And this will be driven none other by the factors as mentioned previously, such as the pent-up demand for travel, busier road traffic, inventory shortfalls, as well as OPEC's output constraints, as previously talked about. Not to mention the higher crack spreads, and these higher margins for global oil refineries would mean that those refiners with spare capacity, they might actually want to ramp up production, and this leads to increased demand for crude oil and thus higher crude oil prices. And beyond this, another positive catalyst to take note of is actually that of China's recovery. So China's recovery in the event of the easing of lockdowns would likely to be another positive catalyst, and we've actually started to witness some signs of this in early June after China had announced an end to its 2-month-long COVID-19 lockdown. Another thing to note is that a further escalation of the Russian-Ukraine war would also be beneficial to oil prices. So in the next slide, we think that these high oil prices are here to stay because of the fundamental improvement in supply capacity that will actually take time to ramp up. And this lack of investment within this space is actually a long-term trend that we have witnessed. So this results in a lag between the demand and supply will actually take time or years to actually fill this demand-supply gap. As such, the current demand-supply dynamics are supportive of these high oil prices. And with this in mind, investors may actually wish to consider these products such as the BlackRock World Energy Fund if they are seeking a dedicated energy fund out there. And this fund is invested in companies that are involved in the exploration, development, as well as production and distribution of energy. Other than that, they may also wish to consider other commodities-related funds that we have out there, such as the JPM, Global Natural Resources Fund. And this fund not only invests in oil, but also in those companies that are involved in the metals mining space. So last but not least, another product that you could perhaps consider is that of the BlackRock Natural Resources Growth and Income Fund. And this is a fund that is well diversified across different commodities with an allocation into the mining, energy, and agriculture sectors. And with this, I actually come to the end of my presentation. So thank you very much for your kind attention.
Thank you, Chloe, for the presentation. Next up, we have Lim Teng Chong, Research Analyst of Global Fixed Income at iFAST Singapore. He will explain why bond investments are great again and dive into the opportunities available in the fixed income space. Teng Chong, please.
Hi, good morning, everyone. My name is Teng Chong, and I'm from the iFAST Fixed Income team. So for today's presentation, I'll be presenting about bonds and what makes bonds a great investment in today's rising rate environment. So I think the previous presenters, Jin and also Chloe, mentioned about the current inflationary environment that we are in. So just to recap on what has happened in the market so far, the US Federal Reserve started to raise its key interest rate in order to combat inflation. That's mainly caused by supply chain bottlenecks and shortages, as well as the Russia and Ukraine war. So in May, CPI for all items increased by 8.6% year on year, which was the highest in 40 years. And this led to the US Fed to increase its Fed fund rate in order to combat the increase in prices. So in the most recent FOMC meeting, the US Federal Reserve raised its federal funds rate by 75 basis points to a range of 1.5 to 1.75%. So from the chart on the right, it is the dot plot of the FOMC participants on their projections for the Fed funds rate. So the participants expect the Fed funds rate to increase until 2023 and fall in the longer run. So although these are just projections and should be taken lightly, but I think the dot plot allows us to really understand the longer term considerations and expectations of the Federal Reserve for their monetary policy. So what does this all mean, and what does this mean for SGD bonds? So unlike the US, Singapore do not adjust its interest rates, but implements monetary policy through its exchange rate. So interest rates in Singapore are largely determined by foreign rates, especially those from the US, as well as market expectations of movements in the Singapore dollar. Therefore, Singapore interest rates have risen too as a result of the rate hikes in the US. The increase in interest rates in the US have caused SGD bonds to fall, as you can see from the chart on the left. And this is because bonds have a negative relationship with interest rates. So when interest rate rises, bond prices will fall. And this happens vice versa as well. So when interest rate falls, bond prices will increase. So the Singapore yield curve also saw its yields increasing as interest rates continue to increase. So you can see from the chart on the right, we can see that the yields for the 2-year and the 1-year SGS bonds saw the highest 1-year change. This means that the yields for the bonds maturing in 1 to 2 year time have the highest increase in yields. And as a result of interest rate changes, global bond yields have increased significantly. And this is a stark contrast to what we have experienced and saw in the past few years, where interest rates were low. And unlike the past, investors do not need to take on large credit risks in order to gain a decent yield for their bonds. As you can see, US investment-grade bonds are already trading approximately 4%, and other bonds in the other various markets have also risen in yields. So we think that now is a good time to invest in bonds. And this is because as yield on government bond increase, this has resulted in corporate bonds spreads to widen as well. Investors do not need to take on much credit risk in order to gain a decent yield from their bonds. Investment-grade bonds and even government bonds are providing attractive yields at this time. Investors can consider short-term maturity bonds, which have risen the most in yield as they are less volatile to changes in interest rates as compared to bonds of longer maturity. And as mentioned previously, these bonds that are maturing between 1 to 2 years' time have risen the most in yields. So we think that bonds with shorter maturity do present a good opportunity for investors to consider. As interest rates continue to increase from now to 2024, investors can invest in shorter maturity bonds and then reinvest the maturing bonds into higher yielding bonds as interest rate continues to increase. Furthermore, with the expectation that in the long run, interest rates will fall as the US tames inflation, we think that now is a good time to consider bonds as the yields have risen so much. So now, next, I will share 2 bond ideas that we think that is worth considering in your portfolio. The first idea I'll be presenting today is Metro Holdings. I think this is a familiar name to most of you all out here, as Metro is one of the prominent departmental stores in Singapore. However, Metro is not just a departmental store operator, it is also a property investment and development group. It was first founded in 1957, and a few years later, the company was listed on the Singapore Exchange in 1973. And has since grown into a large, diversified retailer and also a real estate developer. And even though it was well recognized as a departmental store operator, Metro has been focusing on expanding its property business. And slowly, the company had downsized its retail operations to just 2 stores in Paragon and Causeway Point. So other than departmental stores, Metro is also engaged in property development and investment and also retail. Its well-diversified asset portfolio ranges across commercial, logistics and industrial, residential and malls and retail centers. And as at 31st March 2022, average occupancy for the group's investment properties is 93.9%. So taking a look at the financial highlights, operating profit before interest and tax have been relatively stable over the years, despite a significant decline in revenues for FY21 due to the pandemic. Property revenue for FY22 fell from 24.6 million to 13.9 million due to the lower sales of property rights of its residential properties in Indonesia. However, retail revenue increased to 86.6 million as footfalls at departmental stores improved following the circuit breaker measures in 2020 and also the resurgence of retailers in its malls. So taking a look at the business outlook for FY22 and FY23, so in terms of operating profit by geography, UK and Europe is Metro's strongest segment, followed by ASEAN, Australia, and lastly, China. So for its China properties, it has been hampered by COVID lockdowns in China. However, we think that average occupancy at its China investment properties still remains relatively high at 95.4%. And its properties are also located in Tier 1 cities in China, and it's also well diversified across different segments. So we continue to hold a positive view on its China properties. Taking a look at ASEAN, we expect a stronger retail activity at Singapore following the ease of restrictions, and Singapore's property portfolio also remains high at 97.2% with an weighted average lease expiry of approximately 6.4 years. Indonesia is expected to pick up gradually as it continues to open up its borders, but social measures will continue to impact the sales and collections at its Bekasi and Bintaro projects. So over at the UK and Australia outlook, we think that Metro's 2 student accommodation properties at Warwick and Bistro are well positioned to capture the growing student accommodation sector in the UK and continue to provide a resilient cash flow and steady cash flow to Metro. In Australia, portfolio remains high with a committed average occupancy of 95.2% with a weighted average lease expiry of approximately 6.5 years. Now, moving on to the credit profile and credit comparison between peers. So in the table, we compared Metro with other comparable property developers such as Wing Tai Holdings, OUE, and City Development Limited. Metro has kept a really healthy liquidity position with a current ratio of 4.07 times and total cash of approximately 331 million, which is more than sufficient to cover its short-term borrowings of 135 million as of 31st March this year. It's able to pay its interest with its interest servicing ability with a healthy EBITDA coverage of approximately 2.52 times. in terms of gearing, its net debt to equity is 0.17 times, which is much considerably much lower than compared to other comparable property developers, as you can see from the table, except for Wing Tai Holdings. However, all in all, we think that Metro's credit profile is prudent and strong amidst lower revenues in the backdrop of the pandemic. So due to its strong credit profile and interest-paying ability, we recommend the Metro 4.3% 2024 bonds. It has an indicative ask yield to maturity of 3.49% with slightly less than 2 years to maturity. So you can see from the chart, in the chart you can see that the Metro 2024 bonds offers the highest yields as compared to its peers. Among the bonds maturing approximately the same time, such as the Wing Tai 4.7%, as well as the CIT SP 3.9%, we find that the Metro 4.3% has the higher yield and stronger credit profile as compared to both, CIT SP. The Wing Tai 4.7% 2024 bonds, although having a stronger credit profile, it offers a less attractive yield as compared to Metro. So on the whole, we feel that Metro bonds are worth considering in part of the group's diversified business portfolio, and its financial profile is supported by strong liquidity and an unencumbered balance sheet, as well as healthy credit metrics. This bond is also available on Bond Express and will be available on lot sizes as little as 5,000 Sing. Moving on, the next idea I'll be presenting is Commerce Bank. So Commerce Bank is one of the leading banks for around 30,000 corporate clients and 11 million private and small business customers in Germany. The bank transacts about 30% of Germany's foreign trade and is located internationally across approximately 40 countries with over 40,000 employees. So the group mainly operates in two main segments. Firstly, the private and small business segment, which they offer advice such as account, card, and consumer credit. And the second segment is corporate clients, which they provide advisory services. So going forward, Commerce Bank aims to be a digital advisory bank as part of its Strategy 2024, where it aims to drive technological progress to remain competitive. So 2021 was a turnaround year for Commerce Bank as it returned a positive operating profit after the pandemic due to lower impairment losses on loans. Private and small business segment recorded a notable increase in income due to the continued growth of its credit portfolio and net commission income, which helped to offset the decline in its deposit business. Corporate clients segment also improved significantly on the back of improvements from the performance of its capital markets and transaction banking. Total operating return on equity was 5% for FY21, higher than negative 1% a year ago. While cost-to-income ratio for the group also declined by 1.4 percentage points. So for our outlook for Commerce Bank, we think that the pandemic will continue to have a significant impact on the global economy. Several countries such as China have seen repeated lockdowns and coronavirus outbreaks, and the escalation of Russia and Ukraine conflict also represents a significant risk to the economic outlook. However, we think that its private and small business segment will continue to make further progress this year, following the restructuring of its sales model to become both a digital as well as a branch-based full-service bank. Asset management income is targeted to be higher following the expansion of its market position, while its subsidiary M-Bank is expected to further boost this segment's operating income due to a marked improvement of its financial position. So for the corporate client segment, Commerce Bank will look to improve its cost-to-income ratio and the efficiency of capital employed after cutting down its European and Asian locations. And this segment will also continue to leverage on its strong international trade finance capabilities, while demands from corporate customers will be met more efficiently through its digital product and service offering. So taking a look at the solvency profile, we have compared, in the chart, we have compared its CET1 ratio to various European banks. So as of 31st December 2021, Commerzbank is 38% owned by the German government and has a credit rating of A1 and BBB plus by Moody's and S&P, which makes it investment grade as an issuer profile. Risk-bearing capacity ratio, which measures the available economic capital to absorb unexpected losses, stood at 176%, and it has been consistently higher than 100% for the year. Its liquidity coverage ratio was 145.1%, which is well above the 100% regulatory requirement, while net stable funding ratio was 129%. This underlines the sound financial and funding situation of Commerzbank. So our recommended bond for this is for Commerzbank is the Commerzbank 4.2% 2028 bond, and it has approximately about 1.2 years left to its next call date, with a yield to call of 4.21%. And the bonds have a call date on the 18th of September 2023. And if it's not called, it will reset at the prevailing 5-year swap offer rate, plus the initial spread of 1.972%. So we think that Commerzbank have, the high likelihood of Commerzbank calling back is, this bond is quite high, considering its strong solvency profile and also its strong credit profile. So Commerzbank also has a good track record of calling back its Tier 2 notes, and recently redeemed the Commerzbank 4.875% bond on the 1st of March this year. I think investors should also note that this is a Tier 2 note, so it has certain loss absorption features that the issuer may trigger if solvency falls below a certain threshold. However, with a CET1 ratio of 13.2%, Commerzbank remains well capitalized and above its regulatory requirements. So with that, and this bond is also available on Bond Express. And with that, I've come to the end of my presentation. And later on in the afternoon, my colleagues from will be sharing with everyone on how iFAST can help you in your bond investment journey. So do stay tuned with that, and I hope that investors consider bonds in their portfolio. Thank you.
Thank you, Ding Zhong, for the presentation. In our next presentation, Yo Hui-shi, Senior Research Analyst from the Research and Portfolio Management team at iFAST Singapore, will tell us why we believe a hurricane is coming for S-REITs. Despite the popularity of S-REITs, they aren't a good investment option this year. Let's find out why.
Hi, good morning, everyone. Welcome again. I'm Hui Shi from the iFAST research team, and today I'll be sharing about a sector that is the darling of the Singapore stock market, and that is none other than the REITs. Year to date, the Singapore REIT sector is down by about -5%, and with the fall in share prices, the S-REIT sector is now offering a forward dividend yield of about 5 to 6%. Which may look somewhat attractive if you compare it to what investors have been receiving over the last couple of years. So the question of the day is whether S-REITs are indeed looking attractive again. And if you think that S-REITs are attractive simply based off its 5 to 6% yield, then you might want to think again. Because today I'm here to caution investors that with the current macroeconomic environment of rising interest rates, actually, your 5 to 6% dividend yield may not be attractive at all. And in fact, we also believe that with the impact of rising interest rates on the S-REIT sector shouldn't be understated. And I'll be sharing some of the reasons why in my next couple of slides. So on the next slide, firstly, higher interest rates, they make funding more expensive. And this affects the REITs as they tend to take on debt to finance their growth strategy. So in general, REITs, they tend to be highly leveraged, meaning that they do hold quite a substantial amount of debt. Interest rates are likely to stay elevated for a prolonged period of time, and this would cause the REITs to refinance their expiring loans at a higher borrowing cost. And assuming that everything else is equal, the higher borrowing costs will increase interest expense. And this will also affect their distributable income, thereby putting some pressure on the distribution per unit, otherwise known as the DPU of the REITs. So currently, the average cost of debt of the S-REIT sector is slightly above 2%, as many of them, they have managed to lock in quite low interest rates over the last couple of years. But investors should not be feeling too happy right now, because with higher interest rates taking hold, we believe that S-REITs will eventually face the reality of a higher average cost of debt. So on the next slide, with interest rate benchmarks going up, we believe that the average cost of debt of S-REITs could reach about 4% in the next couple of years. And based on estimations, the increase in interest expense as a result of the average cost of debt moving up from 2% to 4% is likely to lead to a decline of at least negative 20% in DPU from today's levels. But on a slightly more positive note, a mitigating factor of this could be rental reversions. In fact, positive rental reversions, as higher rental rates could also help to drive DPU growth. In the chart on the right-hand side of the screen here, it shows you the rental reversions of some of the largest S-REITs for the first quarter of this year. And so far, rental reversions have ranged from about negative 6% to positive 4%. Now, moving forward, supported by elevated levels of inflation, we believe that the annual rental reversions of the S-REITs are likely to be within the positive low single-digit range. However, this may be insufficient to make up for the increase in interest expense as a result of higher borrowing costs. And if the rental reversions are unable to make up for the higher borrowing costs, this could ultimately lead to a flattish or even negative DPU growth moving forward. And also some REITs, they tend to have longer leases, and this would cause them to lag behind others in terms of rental reversions in the current inflationary environment. So by and large, we do expect S-REITs to take a beating due to the higher funding costs as a result of rising interest rates. And in particular, REITs that have less ability to make up for the increase in interest expense are going to be hit even harder. Now, on the next slide, so far, I've highlighted higher funding costs as an example of how interest rates can impact S-REITs. Now, secondly, I would also want to point out that higher interest rates, they tend to lower the value of a property that is being held by the REIT. So how are properties held by REITs being valued, you may ask? Well, the most common techniques are the discounted cash flow method as well as the capitalization method. Now, firstly, the discounted cash flow method, also known as the DCF method, it involves the estimation of your net income discounted by a rate of return, also known as the discount rate. I think most of you are likely to be familiar with this DCF method, so I won't go too much into that. But basically, higher interest rates will increase your discount rate, and assuming that everything else is equal, your higher discount rate will lower the fair value of a property. Now, moving on to the capitalization method, which is what I want to focus on today, because not many investors understand this. So this capitalization method, it involves the estimation of your net operating income, capitalized using a rate that we call a cap rate. This method is essentially dependent on this cap rate, and the cap rate corresponds to an investor's required rate of return minus the expected growth of the property. And when your interest rates increase, this will push up your required rate of return, thereby increasing your cap rate. And assuming that everything else, like your net operating income, is the same, this higher cap rate will also lower the fair value of a property. And on the next slide, in other words, we can also establish a relationship between the cap rate and interest rates, which is shown on the screen over here, whereby the cap rate is equal to the interest rates plus a certain level of spread. And to illustrate this, we can assume that the interest rates as represented by the Singapore 10-year government bond yield reaches 4%. And we also know that historically, the spread between the cap rates and interest rates is at about 2%. So if you sum these two numbers together, you will arrive at a cap rate of 6%. And this 6%, this is actually higher than the cap rates used over the last couple of years, which were at about 4 to 5%. And so your higher cap rate is likely to lower the fair value of a property. A mitigating factor here could be a higher net operating income. However, we believe that the growth in the net operating income is unlikely to be strong enough to offset the impact of a higher cap rate. This is because of a rather mild rental reversion, as what I've shared earlier, and that's also coupled with the fact that many of the S-REITs, they have reported an increase in their operating expenses as a result of higher electricity costs. I think higher electricity costs, this is something that perhaps we can all relate to. We all know that tariffs have increased substantially this year due to higher oil prices amidst the Russia-Ukraine war. Overall, we think that property valuations could decrease as a result of a higher cap rate, which the growth in net operating income might not be able to offset. And this will in turn lower your property valuations, and that would also drive down the net asset value, otherwise known as the NAV of a REIT. When we value a REIT, we often talk about this ratio called the price-to-book ratio, or your PB ratio. And this PB ratio is also equivalent to your price-to-NAV ratio. So going by this ratio over here, when we know that the net asset value decreases, that could also weaken share prices, because ideally, investors should be still paying a similar price-to-NAV multiple for the same exact REIT. Now on the next slide, so far I've talked about the impact on your DPU growth as well as your NAV. Now last but not least, I also want to point out that higher interest rates, they also make the yields generated by the REITs look less attractive as compared to less risky assets, like fixed income for instance. And this is reducing the S-REITs' appeal to income-seeking investors, perhaps like yourselves, as some investors may rather hold bonds at the current juncture. And why do we say that the yield of S-REITs is now looking less attractive? If you take a look at the screen over here, we can see a chart. It shows you that the yield spread between the S-REIT sector and the 10-year Singapore government bond yield has narrowed to about 2.6%. And this is much lower than your 5-year average, which is at about 3.7%, or even your 10-year average, which is actually close to 4%. And what this narrowing yield spread means is that investors are now compensated with a lower risk premium for holding S-REITs. And why is looking at this yield spread or your risk premium important? We believe that even as government bond yields increase, investors of S-REITs should still be compensated with the same risk premium as before, because they are still investing in the same risky S-REIT sector. On the next slide, to maintain the same risk premium or the yield spread as before, the yield of S-REITs will have to expand. And that also implies that share prices have to decline first. Now, next question is, what could be an attractive level of yield right now? We know that historically, the yield spread is close to about 4%. And if you believe that the 10-year government bond yield will maintain at current levels, which is slightly above 3%, then perhaps a 7% dividend yield from the S-REIT sector could be attractive. But what we really think is that the 10-year government bond yield is going to go up even further and reach 4%. So if you add that with your historical yield spread, then I think investors ideally should be expecting a yield of at least 7 to 8% from the S-REIT sector. And to get to such levels of yields, the share prices of the S-REIT sector clearly still has plenty of room to fall from today's levels because the yields right now are only about 5 to 6%. And so, do you still think that your 5 to 6% dividend yield from the S-REIT sector is very attractive? Evidently, looking at the yield alone is not enough. It's not enough because in the current environment of rising interest rates, there can be, S-REITs can be affected in various ways. And this includes the impact on your DPU growth, the NAV, and the yield spread. And all of this can impact the share prices of the sector. And the key takeaways from what I've just shared is that, number one, rental reversions, they may not be high enough to offset the impact of the increase in interest expense as a result of higher interest rates. And that may ultimately lead to a flattish or even a negative DPU growth overall moving forward. And number two, property valuations are likely to be lower against the backdrop of rising interest rates, and this would decrease the net asset value, also known as the NAV, and in turn, that could also weaken the share prices of the S-REITs. And lastly, to income-seeking investors, S-REITs, they have become less appealing investments as compared to less risky assets, like fixed income, for instance, due to the massive drop in yield spread. And with that, the yield of the S-REIT sector is likely to have even more room to expand. So all in all, we would like to caution investors that rising interest rates can have a profound impact on the S-REIT sector. And against this backdrop, the sector could see a further repricing moving forward. But that being said, we believe that not all REITs are created the same. Some REITs could be hit harder as compared to others due to their positioning in terms of their debt structure or their weighted average lease expiry, so on and so forth. And as such, we believe that investors who want to invest in S-REITs right now should be selective. And I think this is the key takeaway of today's presentation. And with that, I've come to the end of my sharing on S-REITs. Thank you for your kind attention.
Thank you, Hui Shi. If there is ever a good time to enter China's stock market, our iFAST research team believes it is now. Yo Weiren, Senior Portfolio Manager from iFAST Singapore, will tell you why and share more about our bullish case for China in this next presentation. Weiren, please.
Hi, good morning, everyone, and thank you so much for joining us here at our iFAST Mid-Year Review 2022. So my name is Wei Ren. I'm part of the research team in iFAST, and today my presentation is on one particular market that has captured the attention of global investors for the past 1 to 2 years, and that market is China. So we think that now is a good time for investors to consider investing in the Chinese equity market. And in my slides today, I will actually be sharing with everyone the reasons why we have recently turned positive on the prospects of Chinese equities. So next slide. So we have always been positive on Chinese equities if you have been following our investment views. So over the past 1 to 2 years, we have expressed a certain level of positivity over the performance of Chinese equities. But admittedly, our expectations, our convictions have not worked out as expected because as you can see from the table, this chart on this slide, China has been the worst performing major equity market since 2021. Last year, we were caught off guard by the unexpectedly harsh crackdowns on the Chinese tech companies. And then for this year, Chinese equities continued its underperformance for the most part of this year, largely because of reasons that are largely quite well known by now. So we have got reasons like the COVID-19 lockdowns in China. There is still the uncertainty over the regulation and the environment over there in China. And of course, earlier this year, there was also concerns that China could potentially come under sanctions because of its relationship with Russia. So a confluence of factors have actually contributed to this sell-off in Chinese equities over the past 1 to 2 years. But despite these obvious risks, we think that now is the time for investors to consider entering into the Chinese stock market. And the first reason why we have turned positive, on the next slide, the first reason is because of our expectations that the Chinese government is going to implement more aggressive policy actions to stabilize the economy. So as of now, China's economy is facing a lot of downward pressures. And a lot of that is actually coming from the zero COVID policy that has so far been coming at a huge economic cost to China. And it is perhaps not surprising that a lot of economists, they have been downgrading their estimates for GDP for China this year. And a lot of them are not expecting China to achieve their official GDP target of 5.5%. In fact, if you look at the consensus estimate right now, economists are generally expecting China to hit 4.5% GDP growth for this year, which is well below the 5.5% official government target. Now, we acknowledge that it has become increasingly challenging for China to achieve this 5.5% GDP growth target. But having said that, I just want to say also that this target, it still remains achievable with the help of more stimulus measures. And we are expecting China to roll out more aggressive stimulus measures in order to support the economy. And they actually have been rolling out economic support measures, and they have also been aggressively fighting back against plummeting confidence in recent months. And as you can see very clearly from this table over here, the government has been rolling out new measures almost on a monthly basis. So on a year-to-date basis, there are a lot of things that the government has done, including rate cards. They have also been giving out tax reliefs, and they have also been issuing special bonds for infrastructure investment. And in the month of May alone, there has been a series of policy measures that are being introduced by the government. So I'd like to bring everyone's attention to a couple of them. So the first of which is the cutting of the lower bound range of mortgage interest rates for first-time home buyers. This is significant because this is the first time ever in China's property crisis that the central government has directly intervened in the property market. And just a few days later, the central bank lowered the 5-year loan prime rate. So the 5-year loan prime rate is the standard benchmark for mortgage loans in China. And this reduction was by 15 basis points. So this 15 basis points is actually the biggest cut ever. So it is a very clear signal to us that the government is very intent on supporting the housing market. It is very intent on reversing some of the damage that it has done to its housing market over the past 1 to 2 years. And also, it doesn't stop there. They have also been giving a new round of tax reliefs, and on top of that, they have brought forward the deadline for special bond issuance. So if you look at this table, in March, the Chinese government actually announced the issuance of special bonds for infrastructure investment. And the initial deadline for the local governments to finish this issuance is actually by September. But in May, the government decided to just bring forward this deadline by a few months to June. And they have also stipulated to local government officials that you must finish spending the proceeds by August. So they have been doing a lot of things this year to try to rescue the economy. And also on the next slide, besides just policy intervention is not the only thing that the Chinese government has been doing. The Chinese government has also been actively engaging in what I call verbal intervention. They have basically been saying a lot of things that signal their intention and signal their desire to want to stabilize China's economy. And I do have a couple of examples here on this slide. So in March, the government said that they will ensure stability in capital markets, support overseas stock listings, resolve risks around the property developers, and to complete the crackdown on the internet sector as soon as possible. And then in April, the government also said again it will step up policy support for the economy. And in that same meeting, the government mentioned again that they will normalize regulation. And this time around, instead of saying that they will complete the crackdown, they are now saying that they will support the development of internet consumer companies in China. And later in May, Li Keqiang came out to say that they must avoid an economic contraction in the second quarter. And this same message has also been reiterated by President Xi in a separate statement as well. So in both actions and words, it is very crystal clear that the Chinese government wants to move decisively this year in order to stabilize its economy. And we should also not forget that this year is a particularly important year for President Xi Jinping, because this year he is going to seek a historic third term as the president of China. So he will definitely want to go into his third term, showing that China's economy has made good progress under his leadership. So there are reasons to believe that the government will roll out more stimulus measures in order to achieve its GDP growth target for this year. And on the next slide, adding to our optimism is the fact that China has been emerging from its worst COVID-19 outbreak in almost 2 years. As we can see from the chart on your left, the number of COVID-19 infections has been trending down significantly in recent times. And because of that, the government has actually started to ease some of the very harsh COVID-19 lockdown measures that they have implemented over the past few months. So life in Beijing and Shanghai, it is now starting to return to normal. So if you look at the airport and also the seaport cargo volumes, so that is back at 90% of its pre-pandemic capacity. And workers are starting to return to office. Shopping malls are reopening, and also the government has started to reopen partially the public transportation system in China. And I've also included one additional chart on the right, which shows the volume of passengers taking the Shanghai metro. And you can see that there has been a sharp increase in the number of passengers ever since the lockdowns were lifted. So there has been an easing of the COVID-19 measures over in China. But of course, on the next slide, I just wanted to say also that there are still risks when it comes to COVID, because the reality is that China is unlikely going to move away from its zero COVID policy. So what this means is that if there are going to be flare-ups in COVID-19 cases in China, then there is a possibility that China will reimpose some of these harsh measures that they have used over the past few months. And the implication is that economic growth will definitely take another hit. But having said that, I just wanted to say also that there are reasons also to be optimistic that zero COVID will not come at a huge expense to the economy. And I say that because the Chinese government, by now, they are well aware of the huge economic cost that comes along with this zero COVID policy. And we think that the urgency and the need to stimulate the economy is now so overwhelming that the government may be forced to try to find ways to accommodate these two objectives, or maybe be even forced to soften certain aspects of their zero COVID policy. And this is especially so after Li Keqiang actually summoned about 100,000 officials to an unprecedented meeting. And in this meeting, he actually expressed concerns about the slowdown and also to push for a faster easing of lockdowns. And this meeting is unprecedented because this is the first time ever that a top-level government official is addressing directly to the many different layers of government. And this is important because typically in China, policy transmission, it takes place across many different layers of government. So the message from the top, by the time it reaches the bottom, it could be misinterpreted or overly interpreted. It's just like how in the army, officer says wake up at 5:30, then down the chain of command, sergeant says 5:15. And then the men, we all wake up at 5 o'clock instead. So this is what is happening in China because zero COVID has been overly interpreted by a lot of the local government officials who don't want to get into trouble, which is why on the ground, you are seeing very harsh COVID-19 measures being implemented. And most of the times, these measures are implemented without regard for the economic cost that comes along with it, which is why Li Keqiang wanted to take this opportunity to tell all local government officials right now that a contraction in the second quarter must be avoided. And on top of that, you must better manage, you must better balance your COVID controls and economic growth. So this was the message that Li Keqiang had for the local governments in that particular meeting. So there are reasons to believe that certain aspects of the zero COVID policy measures will be softened. And this week, China actually shortened its quarantine period for international travelers. So the direction is very clear. They are not going to go back to the very harsh COVID-19 measures because of the huge economic cost that comes along with it. So there are reasons to believe that zero COVID will not come at the huge expense to its economy. And on the next slide, on top of that, we believe that investors have been overly pessimistic on the earnings outlook for Chinese companies, especially after a series of better than expected earnings results, including that from Alibaba and Baidu as well. And Baidu in particular actually reported an earnings decline of about 9% in its first quarter results, which in all honesty was not an impressive set of results, but because analysts have been so pessimistic on the earnings outlook of Baidu that the company ended up beating earnings expectations by a huge margin. And we can also see that the earnings estimates for China tech companies, as indicated on the blue line on this chart, the earnings estimates for Chinese companies, they have been downgraded very substantially this year. And this is in stark contrast to the S&P 500, where earnings estimates have actually been upgraded this year, despite the fact that there has been mounting economic risks at the global level. Analysts have been increasingly optimistic over the earnings outlook for US companies. But already, we are starting to see quite a lot of high-profile earnings misses in the US, including Walmart, Target, and also in the tech sector, we have also seen earnings misses from Amazon. Snap also issued a profit warning earlier this year as well. So clearly, it's two different markets. One with a lot of optimism, and the other one with a lot of pessimism being built into the markets. And on top of that, there has also been a stabilization in the earnings expectations of China tech companies. As you can see from this blue line, the earnings have actually been not downgraded in recent times, which means that analysts, they have stopped downgrading their forward earnings estimates for constituents within the Hang Seng Tech Index. So what this means is that if you look at the stabilization of earnings, the massive downgrade in earnings estimates, and also the huge sell-off that we have seen over the past 1 to 2 years, this means that perhaps a lot of the negative factors, a lot of the negative overhang that we have seen is already priced into the markets. And right now, there are also strong signs that China's crackdown on its big tech companies could finally be easing. As I've highlighted in my slides earlier, the government has been highlighting in various statements that they will support the development of the internet companies. And they have also been matching their words with tangible actions because they have done a couple of things, such as the recent approval of new gaming licenses, reports that the investigation in TT is about to be wrapped up. And earlier this year, they have also removed an audit barrier that involves US-listed Chinese stocks. So with an easing of all these regulations, there could be a potential rebound in Chinese companies in the years ahead. Next slide. And I think more importantly, I just wanted to say also that the valuations of Chinese equities right now, they are still very attractive, especially when you consider the fact that the MSCI China Index is currently trading at multi-year lows. So based on our in-house fair PE estimate that we have assigned to the Chinese equity market, we are actually projecting an upside of close to about 50% over the next few years for the Chinese equity market. Next slide. So if you want exposure to the Chinese equity market, then I have a couple of product recommendations. So on the active funds, our recommendation for active funds is actually the one by JP Morgan. And if you are a passive investor who prefer to just invest in ETFs, then our recommendation for that is actually the iShares Core MSCI China ETF. And of course, for those of you who just want to go straight into the areas that have been beaten down, the areas that are the most sensitive to policy changes, then you should just go straight for the China tech sector. And our recommendation for that is the iShares Hang Seng Tech ETF. Next slide. Okay, so just to wrap up, I just want to urge all investors here to keep faith in Chinese equities. I know it has been a painful journey for most of us here, or some of us here, who have been invested in Chinese equities over the past 1 to 2 years. The drop has been significant. But I just wanted to say also that the factors that have caused the huge sell-off in Chinese equities are starting to turn around. As I've mentioned in my previous slides, there is a turnaround, there is an easing of some of these negative factors that have caused the sell-off in Chinese equities. And it is our view that China has the ability to outperform its global peers over the next few years. And in fact, they have already started to outperform global equities in the month of June, as you can see from this table over here, at a time when global equities are selling off sharply. China's equity market rebounded strongly by more than 8%. And this also means that on a year-to-date basis, China is no longer the worst performing equity market in the world. And given that there has been a significant shift in its policy stance, we think that China definitely has the potential to outperform its peers over the next few years. So if there is ever a good time for you to buy Chinese stocks, that time is right now. So with that, I end my presentation today. Thank you so much for your attention, and I'll hand the time back to Gladys.
Thank you, Aaron. Up next, we will hear from our panelists, Kenneth Tang, Senior Portfolio Manager from Nikko Asset Management, and Lisa Lee, Vice President, Fixed Income Product Strategist at BlackRock. They will discuss their best investment ideas for the year ahead, as well as the ones to avoid. Moderating this session will be Jean-Paul Wong, General Manager of FSMOne Singapore. Let's welcome them up.
Lisa? A warm welcome to all of you, to all our dear investors in person here at the event, as well as those who have joined us online. Very happy to see a lot of you in person this morning. It's been a long while, obviously, so it's been good to catch up and speak to a few of you, and look forward to catching up later on as well. So for the panel today, it's about looking at some of the ideas that our partners and fellow fund managers and investment strategies are looking at. But before we get some of these ideas from my two fellow panelists, Kenneth and Lisa, I'll just move on to the next slide, which shows the different performance of the markets. So looking at the stock markets, I think Weiren talked a little bit just now already, but essentially if you look at so far this year, in the first half of 2022, a lot of rate, and I believe some of our portfolios at least are also in red. So, and mine is also not different. I guess it's really then what should we do? And that's really what we will try to find out. So here, only two markets among single countries which are in the green. So that's Indonesia and our home market, Singapore. And among the regional markets, we have Latin America, which is often taken as a proxy for commodities. Obviously, commodities was one of the very few things that have done well so far this year. But a lot of rate across the board. And on the next slide, moving on to the fixed income markets, the picture is not very different. The so-called best performing market here is the Chinese bond market. But if you look at some of the other sectors of fixed income, so some of them have been down about 15 to almost 19% for the Asian high yield, for example. I also wanted to have one slide just to show that there are things that have actually done even worse so far this year. And that's on my next slide, showing the cryptos. I mean, always feels a bit better when you compare sometimes, right? Not a good habit, but yeah, I guess it does help. So looking at cryptos, right? And we have been talking about cryptos quite a bit at FSMOne and iFAST. And the reason is because from last year onwards especially, we have received some investors' queries asking us about, hey, you know, why are you so bearish on cryptos? And we came out with a very cautious note. And in fact, we were warning investors not to go into cryptos about 1 year ago. And I think some of us were telling us, you know, this is not going to age well and so on. But of course, cryptos have also corrected very severely. I think if you look at this slide here, Luna, of course, in May, we know what happened. It just crashed. And the other cryptos, including your so-called major cryptos like your Bitcoin, it's down almost 60% year to date. So that's a bit of how some of the markets have performed so far this year. And I wanted to move on to the next slide just to hear from Lisa and also Kenneth. So in an environment where we have seen a lot of inflation, we have seen central banks, especially in developed markets, increasing interest rates. Of course, the exception is China here. Let's start with this question first. So what are some of the things we should be avoiding as investors? So I wanted to show this slide. I'll start with Lisa because she has a slide to explain her view on this and a chart, which is next. So Lisa, let's start with you.
Sure, thank you, John. Very happy to be here. My name is Lisa Lee. I'm the Asian fixed income product strategist with a focus on China bond market. As John mentioned, we think some of the risk factors will continue to persist in the near future, such as inflationary pressure, the geopolitical tension. So therefore, we have been suggesting our clients to stay up in quality, focus on core investment grade strategy with short duration carry. When we talk about fixed income, I think there are two metrics we need to look at. One is yield, which gives you expected return over the longer period of time. And the second one is the duration exposure, which measures the sensitivity against the treasury yields movement. So if you look at the red chart on this graph here, the y-axis shows you the yield, the x-axis shows you the duration. So ideally, you should invest into an asset class which gives you high income, at the same time, low dollar duration exposure. So generally speaking, we like short-dated bonds over longer-dated bonds. We like investment-grade bonds over high-yield bonds in light of the uncertainties. So if you look at the investment-grade space, which is shown under the green shaded area here, you can see Asia credit definitely stands out compared to global counterparts, because in Asian credit, you have higher income with much lower dollar duration exposure compared to traditional global fixed income assets like global aggregate. So therefore, we suggest clients to stay up in quality, short duration bonds. Within the investment grade space, we continue to like China story, such as the local government financing vehicle, strategically important sector will continue to benefit from the expansionary fiscal policies. Whereas within the high yield space, we are trying to get away from the property sector because we think the market volatility will continue over the next 3 months' time without any significant rebound in the pre-sales number. Back to you, John.
Yeah, thanks, Lisa. Kenneth, how about you? What are some of the sectors that you're more cautious or negative on?
Right, thank you, JP. I think as Lisa has shared, there are clearly a lot of headwinds for many asset classes. And I think what we try to do in Nikko Asset Management is really to focus on our convictions on how to be best defensive and best positioned in the current environment. So when we look at really the landscape for investments, our strongest equity disposition in Singapore for today's market is really investing in companies with sustainable growth and positive change. What I mean by that, we want to find companies that are resilient to the inflationary headwinds and also with the ability to continue to maintain or even improve their margins in such a high rising interest rate environment. So that's number one. And then number two, I think we can also talk a lot about dividend strategies later, but in a nutshell, dividend gives you a lot more visibility on cash flow, a lot more protection in terms of yields to perhaps tide through the difficult times for the markets today. But I think there's another part of dividend that I would like to share more about later, which is more to do with growth. You want to find companies with dividend growth that can help compensate for the rise in inflation, which is actually very important at this time.
Yeah, thanks, Kenneth. So I think for the benefit of the audience as well, I think you kind of know what are some of the favorite sectors from Kenneth and Lisa. So I'll play a bit of the devil's advocate and hopefully ask some of the questions, tougher questions on why those are the sectors that are more interesting. So So we move on to the ideas that our panelists really like, which is the next point here. But before I go back to Lisa, I wanted to turn to Kenneth. So I think when you look at Singapore, right, over the last few years, a lot of investors, even here, we equate Singapore with dividend story. I mean, it's hard to find investors here who will say Singapore it's a high growth kind of story. But when the environment changes, just now we were talking about interest rates going up, the kind of dividend yield that we're used to having from Singapore equities, let's say in the region of about 5%, right? Is that now enough? Because that yield gap between rising interest rates on the one hand, and also secondly, the kind of dividend yield we see from Singapore equities, is that sufficient to make it still interesting to invest in Singapore equities? And in fact, if the dividend yields for Singapore equities have to keep going up, we're kind of assuming then that the share prices must keep dropping as well. So does this actually worry you, Kenneth?
Yes, JP. In fact, it worries us every day as investors. We have been living in such a low interest rate environment for far too long, since the global financial crisis of 2008. And today, rising rates are likely to be the new narrative going forward. So you have to go back to the economic backdrops that predates 2008. And you can actually see that in these times, when inflation was higher, interest rates were rising, which are the stocks or which are the sectors that typically perform best? What we have found in our prior periods is that high dividends and rising dividends tend to do actually exceptionally well relative to the other sectors in times of rising interest rates. And you talked about Singapore, JP. When you look at Singapore in the case in point, if I go to the next chart, you actually know that Singapore is a very high dividend market. In fact, it's the second or third highest in Asia today, yielding about 4.2%, which is short of Taiwan's 4.7%. But year to date, as many of us know, and if you could go back to the previous slide, in a time where markets have been challenging for equities globally, Singapore have managed to hold its own and even eke out a small positive performance in a rocky start for 2022. And you can see that the relative performance of Singapore has clearly been one that has shown defensiveness, a stronger mettle towards performance, and that has actually held up a lot better, which goes very much in line with the idea of higher dividends and protection for the markets. On your question about dividend yields, I think it's important to discuss this because I believe there has been, in the previous panel, there was the sharing of really how the yield gap would narrow. Yep. And here it's important to really know that while the yield gap between dividend yields in Singapore and the 10-year bond yield in Singapore has narrowed, it's around 1%, it is still positive, but it's trading at lower band of its range. So what you want to do then is look at the yield gap. Is that attractive for you? And if you think you want to improve on that, what a dividend strategy can do is to overlay that, because when you invest in a dividend strategy, you're not getting just a pure yield of 4.2% for Singapore, you're improving on that. So when you improve the dividend yield gap of, let's say, 1 to 2%, it becomes a lot more attractive, and it will definitely perform better in today's environment. And I think the other thing to think about for dividend strategy, which I mentioned, is today, dividend growth is very important. And I highlight growth because, as many of us know, the famous saying is when the tide runs out, you actually see who is swimming naked. Yeah. Well, the reality today is growth is scarce. Today, if you are able to deliver growth in a time of scarcity of growth, investors will pay a higher premium for that certainty. So finding dividend growth is actually the key narrative and the key conviction behind all our dividend strategies at this time. So I think find growth and you will find performance.
Find growth and you'll find performance. Okay, key point here. Lisa, just now we had a slide on the fixed income markets performance globally. So I think it's one of the worst starts for a very long time for global fixed income markets. It's all red just now. So in this kind of environment, do you think that yields have now reached a level where it is sufficiently attractive to invest in, and which are some of these bond markets that you like?
Right, so when we talk about fixed income, we want to receive stable income in a predictable way. But very unfortunate these days, it's very hard to get predictable income because nothing is being fixed, because there are so many market uncertainties around us. Even the traditional global fixed income strategies like Rose income focused strategy fail to do so. If you look at year-to-date, global fixed income was down by more than 10%. Global high-yield strategy was down more than 20% year-to-date. So finding a stable income strategy with low volatility and low drawdown is becoming extremely difficult in the current market environment. However, we do think that one strategy really stands out right now, especially during the volatile market period. So that is the China bond strategy. So here on this chart shows...
On the next slide, for fixed income.
And next one, please.
Yeah, I'll just show the next slide.
Correct, thank you.
Yes.
So this chart shows you the track record over the past 10 years for the cross-border China bond strategy we managed within the BlackRock. So you can see this is a pretty chart which shows you an upward trajectory over the past 10 years. So even during the most volatile market period, for example, 2018 US-China trade tension, Q1 2020 pandemic outbreak, last year property sale, and year-to-date, on back of the hawkish Fed and geopolitical tension, China bond managed to deliver resilient performance with very little drawdown and very little volatility compared to other global counterparts. So for example, year-to-date, this cross-border China bond strategy was just down by 2% compared to global traditional income strategy, which was down by more than 10%. So this strategy is being increasingly recognized as an evergreen solution with high income and low volatility and low drawdown. So a lot of investors started to replace their traditional global income strategy with China bond because China bond gives you much higher risk-adjusted return over the longer period of time. So investors might ask, how can we achieve such strong performance even during the most volatile period? I think dynamic asset allocation across onshore versus offshore bond market is really the key. Because when we talk about China bond market, there are actually two markets here: onshore market, which is priced in renminbi, and the offshore market, which is priced in dollars. So historically, correlation between onshore China bond versus offshore China bond has been extremely low. So if you have a strategy which can move dynamically across these two markets, depending on different market cycles, you can always generate resilient performance regardless of market cycles. So back to previous page, please. Yeah. So here on this chart shows you some of the performance between onshore bond versus offshore bond market over the past few years. The red bar here represents the China offshore credit market performance. The yellow bar here represents the onshore bond performance. So clearly you can see these two markets behave very differently. For example, back in 2018, that's the China-US trade tension period, China onshore market delivered positive 8% return despite the sell in the global fixed income market back in 2018. Similarly, back in Q1 2020, if you recall, that is the pandemic period. Global fixed income was sold off by more than 15% during March, whereas China onshore bond fund continued to deliver positive 2% return during March liquidity crunch. And similarly, if you look at year-to-date, onshore bond is probably the only asset class which give you positive return this year, up by close to 3%, despite the extreme sell in other parts of the world. So by doing dynamic allocation, not only you can achieve lower volatility, but most importantly, you can always deliver resilient performance no matter what kind of market environment we are in, because of this low correlation between onshore versus offshore. So within BlackRock, we manage our China bond strategy in a cross-border way. So next slide, you can see some of the example here. We have been moving across both onshore and offshore. For example, back in 2018, we increased our allocation to onshore. Similarly, over the past 12 months, we have also started to increase our onshore allocation, which serve as a hedge against the volatilities in the global fixed income market.
Okay, thanks, Lisa. So I think just now on the fixed income performance that I shared earlier on, so I think the China bond index was an aggregate of different segments. So I think what Lisa is sharing here is going into the different segments, the different sub-indices, and showing that there are differences in the performance of the different Chinese bond markets. I'll go back to Kenneth on the next question. So higher interest rates, I think some of my colleagues have been talking about higher mortgage rates. We've read about inflation, whether it's for chicken rice, but generally food, generally even going to top up petrol and so on, or prices just anecdotally in daily life seems to be going up. So in terms of what that means for Singapore market, right? So how should we look for gems and opportunities, Kenneth?
Well, thank you, JP, again for the question. I think, again, as Lisa has shown, there is hiding places for performance in the fixed income markets despite rising interest rates. So the question then goes on, is in equities, will there be hiding places for positive performance? We all know that higher interest rates, higher inflation causes the rise of what we call the cost of capital of running the business. And usually that's not a good mix for equities because your cost brings up your funding costs, and to make a return on that becomes a lot more challenging, especially when times of interest rates when they are rising very fast or above market expectation. But we have found that if interest rates were not to shoot up but gradually rise, is actually quite interesting when you look back at how Singapore would have done. So if you go to the chart on really, the next chart, on the performance for rising rates and Singapore's equity performance, you can actually find that there's a positive correlation to equity performance in a time of rising interest rates. And you look back for the last 20, 25 years, the most interesting moves in interest rates was found in the mid-2000 period, 2003 to 2007, and also in the 2017 to 2019 periods. And over the two periods, you actually see prices for Singapore market do fairly well. So that's actually interesting because we find that during these times, there's going to be opportunities to invest, and you can actually make positive returns despite higher interest rates. The other thing to mention also is that we also have good evidence to show that active stock picking becomes a lot more value added. So interest rates, when they rise, we believe there's also going to be greater alpha opportunities where the fund manager can actually add value to improve on that performance. And I think that's also very key. The next chart, if I may, highlights something that Jin presented earlier in his presentation, which talks about growth and value. In a very quick nutshell, growth has to do with investing less, focusing more on growth and more agnostic on valuations, whereas value focuses on earnings yield, book values. And you can see that growth has underperformed value over the past few years. And actually, if you look at particularly the time of rising interest rates, value has started to re-exert itself. But look at the overlay of Singapore versus the region on Asia stock market, you find that Singapore's outperformance against Asia also correlated with value outperforming growth. So it's implicitly saying that Singapore has a lot of value traits. And when you look at the demography of Singapore today, what do you have in Singapore? Banks, property, industrials, and this make up about 70% of the Singapore market. So this is actually quite good data to show that Singapore is inherently quite value, and a time of value, a time of being defensive actually does lead to decent returns.
Okay, thanks, Kenneth. So I'll move back to Lisa because when we talk about bonds, we're talking about the yields that we can get from these fixed income instruments. And one point to note, right, is we've seen the Chinese government bonds seem to have lost that yield advantage relative to the U.S. Treasuries. When you then look at the volatility in the yuan, and that seems to pose a risk as well for fixed income investors. So how should we, really continue allocating into Chinese bonds? And what are some of the key, risks that you see? And are they kind of priced in? Yeah.
Right. So renminbi has been relatively volatile over the past few months due to the technical reasons. So over the short run, we think renminbi will remain volatile given the hawkish Fed. So therefore, we suggest clients to go into the hedge share class if they don't want to take any FX risk over the short run. So hedging cost has actually compressed a lot over the past 1 year. So last year, I remember hedging renminbi back into Sing dollar cost you 2% hedging cost. Right now, this hedging cost has dropped to below 0.5%. So even taking into account of the hedging cost, investors get around 6.5% yield in Sing dollar hedge basis with an average rating of investment grade credits when you invest into the cross-border China strategy. So from the yield perspective, 6.5% investment grade still offers you a big yield pickup compared to global fixed income, which is right now trading slightly above 4%. So from that perspective, we think that investing into hedge share class makes a lot of sense. For the clients don't need to worry about the currency risk. At the same time, we think it's still a good opportunity to go for China bonds, basically for 3 key reasons. So firstly, due to the divergence monetary policy, in U.S., because of the inflationary pressure, Fed started the quantitative tightening, whereas in China, given the zero-COVID policy and the potential impact on its economic growth, monetary policy will continue to remain accommodative, which means this will support the bond investment this year. And secondly, it's all about diversification, risk mitigation. As I mentioned before, China bond is the only asset class which give you positive return during the global market itself over the past few years, so which serve as a risk hedge. And finally, I think in China, you have a lot of opportunities because this market is highly scalable and diversified across different sectors. For example, in the onshore market right now, we like financials, we like strategically important sector, which will benefit from the regulatory support. Whereas in the offshore market, we prefer short-end 1 year, 2 year investment grade paper, given the attractive income, attractive yield it offers at this point of time. So nevertheless, China bond still offers clients core investment grade strategy with short duration carry.
Yeah, thanks, Lisa. I'll go back to a topic that my colleagues have been talking about, S-REITs. So that's to Kenneth. So similarly, right, just using that train of thought about rising interest rate, then we would assume upward pressure on cap rates as well, and potentially leading to declines in property values. What's your view on this, Kenneth? Is that a key concern for investors who have exposure to SG REITs? And also, maybe quickly as well, how about banks' outlook?
Right, thank you again. I heard the analogy that a hurricane is coming.
Yeah.
I'm not sure whether we're going to get a hurricane, but I think maybe more like a rainy storm. I believe the backdrop of rising rates will be a headwind for the REIT sector, but actually it underlies, again, one of the points I was stressing, the importance for high dividend sectors like REITs to focus on really dividend growth. And I would just add another point about balance sheet leverage. So I agree with the speaker earlier about really how we need to be a lot more selective. And this is really what we try to do as an active strategy, active overlay for the dividend strategy that we have. And when you look at Singapore today, while the overall headwind is there, we do find 2 very important trends that is supporting Singapore or SG REITs. Number one, we have this lens of reopening. And when we talk about reopening, we're talking about coming back post-COVID, There's going to be a lot more recovery, and we think retail REITs as well as office REITs do offer some form of protection on growth, because we think that that will actually facilitate growth as these sectors come back. So we want to be a bit more selective in the retail REITs and the office REITs that are best leveraged towards that growth. The second theme that I think is important for Singapore is really Singapore's role as a financial sector. I'm sure we know that Singapore has built itself as a financial hub, a technology hub, a manufacturing hub, and what we think in the coming years, despite these concerns about deglobalization, we will still Singapore prosper as a center for FDI. And as companies come to relocate in Singapore, we will see greater demand for selective industrial and logistics REITs that can participate in that demand. So we think that it's actually two things that we want to look for. Number one, growth, and number two, really the ability for the balance sheet to manage that growth, meaning they are in a better position to shield itself from rising rates. On the question on banks, I think the good news is that because Singapore banks is a large part of Singapore's market, they are very good dividend anchors. They anchor you with a yield of 4 to 5%, and we actually have also a hedge against rising rates in the form of net interest margins, because we know that as interest rates rise, net interest margins will actually move up. But we do know on the flip side, the concerns over mortgage rates. And I'm sure many of us, including myself, have received notices to say that our mortgage rates are going to be increased, or the loans are going to be increased. I think it's going to be very key to see how banks actually manage loans growth in a time like this. So we have to be also a bit more cognizant of that risk. But I would say that generally speaking, the banks are still well placed for growth and also anchoring dividend yields that is very attractive today.
Yeah, thanks, Kenneth. You mentioned about COVID just now. So I think different parts of the world were going through different COVID stories. I think back to China, and that's for Lisa. So I think obviously still zero COVID. There's a little bit of loosening in recent weeks in some parts of China. I mean, at what stage do you feel that you're worried that this kind of policy would have a negative impact on the issuers that you have in your portfolio, and what are some of the default expectations perhaps that you have?
So we think Chinese government will continue to adhere to the dynamic zero COVID policy over the short run, especially given we are going to have the election in October this year. So that is not going to be changed. But we do see a lot of supportive policy measures. For example, they managed to reduce the quarantine day to 7+3 recently, which is definitely a positive development. So right now, if you look at the impact on the credit market itself, I would say it is actually very marginal. If you look at this year, year to date, the onshore high yield default rate is actually much lower compared to last year, the same period. So actually, we believe this year, 2022, our projected onshore high yield default rate is just at 0.8%. compared to 1.5% last year, so which is significantly reduction compared to last year. I think this is primarily driven by the supportive policies, easing market condition, increased credit impulse in onshore, which all provide support for the lower default rates in the onshore market itself. And besides, in the onshore market, a property is just less than 3% of the entire investable universe, even though we do see increasing default from the property sector, but given the onshore market is huge, it's highly scalable, the impact on the entire market default rate this year has been very low compared to last year. So if you look at this chart, which shows you the default rate comparison across different asset class, the green bar represents the onshore China bond default. You can clearly see that China bond has much lower default compared to other counterparts. Whereas if you look at the offshore China high yield market, we do see the offshore high yield market will continue to face default pressure this year, mainly driven by the Chinese property sector, which we continue to be cautious within our strategy at this point of time.
Okay, thank you, Lisa. I think next question, that's back to Kenneth. So I think just now I was also talking to an investor and I was mentioning, depends on our perspective, time horizon. Sometimes you hear us say long term, right? So I think, but when we talk about long term, I think for Singapore market, and we compare it to, let's say, the US, the S&P 500 index, I think the returns haven't looked as great, I think. If you just look at the numbers, and we're looking at about 10 years, we're talking about 5% thereabouts each year for the STI, right? So, Kenneth, I know you've been talking about the search for quality and so on for your portfolio. But generally, what's your message to investors who may have such a maybe cynical views on having Singapore in their portfolio, and does buy and hold still work for Singapore?
Well, buy and hold, wow, that's actually quite a loaded question. I'll try to give a loaded answer because I think it requires a bit of financial gymnastics. So please bear with me, everyone. I mean, you can see on the chart, what you see in trying to answer the question is does a 5.4% average return good enough for investors? And here, I think as you rightly put, JP, that there is actually good data to show that for the past 10 years in Singapore, if you invested in the STI from 2010 to 2020, your average return will be about 5.4% on the right. And actually, if you go back the previous 2 decades, you actually have much better returns of 8.3 or 8.7 and 13.3. And when you dig deeper to the numbers on the left, you can actually see how that rolling 10-year average number changes over time. And while the number for the last 10 years kind of averaged 5.4%, you will notice that actually it ranges from low single digit to high or to low double digit in the region of about 12 to 13% to 2%, depending on the time of entry. Meaning depending on where you invest in Singapore, your returns can move from 2% to 5% or to 13%. And that is really one of the things that you notice in this graph. For example, if you look at the latest data, which is 2022, in the second quarter, that number is 2.4%. That means that if you invested in the STI from 2012 to 2022, over the 10 years, you will have gotten a return of 2.4%. But if you use 2013, in the first quarter of 2013, if you invested again from 2003 to 2013, you have gotten 13%. So what that tells you is timing is actually quite important in how you invest in Singapore. Which then, if I were to take the step further then, if you look at 5.4% and you wonder to yourself, I'm not happy with 5.4%, I think Singapore needs to give me that. I think we offer maybe 2 potential solutions. Number one, I think active management can actually hope to improve that 5.4% by adding value, or what we call alpha, to that number itself. But the second thing which I wanted to spend a bit more time is really to look at these numbers today. So we know that these numbers move around from 2 to 13%, but if you notice the red bars, these are the times where Singapore went into a recession. And these are times where GDP growth was negative. And these were the years that many of us can remember, the 2008 financial crisis, 2001 and 2002, the SARS crisis, and of late, the COVID crisis in 2020. And during these periods, if you ended that 10-year return during those periods, you have gotten 1 to 2%. But if you invested from that point on, and you actually continue for the next 4 to 5 years, that number improves significantly to even double-digit returns. So intuitively, it's saying that if you invest in the markets in times of recession, there is obviously better returns that can improve over time as the market comes out of recession. So what is the market telling you today? As I mentioned, if you look at the second quarter, we have moved from SARS of about 1 to 2%, and we are still at 2.4%. So implicitly, I think the market is telling us, at least based on history, not as a forecast, but based on history, that the Singapore market is pricing in a fair amount of bearishness and is concerned about recession. So I think that is actually pricing in a lot of that downside, in my opinion.
Thank you, Kenneth, for all the stats. We have to take a closer look. Yeah, but thanks a lot. So next question to Lisa. I think you mentioned about property market just now, and I think you were saying that the exposure, I think, to onshore China is quite low. But property market is something very high profile, not only because we're Asian who like properties and like to buy and sell properties, but really because that has been one sector that has been under a lot of pressure in China. And I think home sales and housing prices have continued to fall. And of course, there's the danger then that people expect prices to keep falling, so I'm not going to buy, right? So what's your outlook on this sector going forward?
So when we look at the property investment, we usually look at from 3 different perspectives, so including the refinancing channels, regulation front, as well as the pre-sales, which is the sales numbers. So these are the 3 key factors we need to look at. In terms of the refinancing, we definitely see a lot of supportive measures being introduced by the government since Q4 last year. For example, merger and acquisition loans are now being calculated as part of the 3 red lines. And also, banks are being asked to extend loans to developers to prevent default. Some of the stronger SOE names can issue bonds in the onshore bond market to refinance. But at this point of time, the refinancing channel continued to tilt it towards high-quality developers, whereas the weaker private developer continue to face struggle given the general weak sentiment. So we do expect to see this will continue over the next 3 to 6 months' time. In terms of the regulations, a lot of easing measures being introduced over the past few months. We have already seen more than 150 cities started to roll out easing measures, for example, removal of the home purchasing restrictions, lowering down the mortgage rates, low down the down payment ratio. But sentiment-wise, people are still a bit panicked, and they think the property price will continue to drop. So this really creates a vicious cycle at this point of time. And finally, pre-sale number remain weak, although we do see a slightly pickup in sales volume moving into June, given the reopening of Beijing and Shanghai. But this is something that we need to monitor, especially to see if they are sustainable or not. So in a nutshell, we remain cautious over the China property sector over the short run because we do think a lot of weak private developer will continue to face refinancing difficulties over the next 6 to 9 months' time. So within our strategy, we have been positioned very defensively in the property sector over the past 18 months. And we have been trimming down a lot of exposure, especially in the offshore high-yield dollar space, because that market is going to be volatile moving forward.
Sure, thanks, Lisa. So we'll wrap up with the final 2 questions to my panelists. So I'll continue with Lisa. So what kind of returns are you expecting going forward on a 12-month horizon?
It's very hard because I don't have a crystal ball, but we think for cross-border China bond strategy, we think it will return around 6 to 9% in renminbi term over the next 12 months' time. In other words, it is translated into 5.5 to 8.5% based on the Sing dollar hedged basis. So a base case scenario is the return is around 8% in the next 12 months' time because majority of the return will come in from carry. Given the carry, the yield of the strategy is already at close to 7% at this point of time, with additional 1% coming from the cross-border rotation between onshore versus offshore across different sectors. Under the bear case scenario, we think there might be 2% capital loss, so 6% return over the next 12 months' time, assuming the onshore credit spread widened by around 50 basis points and offshore widened by 100 basis points. Whereas in the bull case, we think the return will be like 9% with 1% capital gain on back of the spread compression across onshore and offshore.
Okay, thanks, Lisa. And one last question to Kenneth. What are your best convictions then for Singapore? We'll wrap up with this question.
Well, I think there are probably quite a few, but I think one of the things to really think about for our markets today is what should you do? And I think usually when we look back at history, there are certain things we can learn from history. And in the case of today's history, I would say that unfortunately we are living in unprecedented times. because when you look at the big superpowers in the US and in China, the US is facing a major inflation problem not seen since the 1970s. And today we have also a recession concern. Whereas in China, you have concerns over a hard landing and the administration trying to help the economy to recover post-COVID and managing geopolitical tensions. So when we try to draw parallels with the past, it is not going to be as easy. But that said, while history doesn't repeat itself, as the adage saying goes, it can usually rhyme. So we want to try to draw some anecdotes on how you can actually look at today's rising interest rates environment and see what we can do as investors. So I've actually summarized some of our key conclusions for our investors. These are our thoughts on the market. These are not official recommendations, so please remember the caveat. We are just looking at ways of how we can invest better in today's environment. So the first thing to note is, number one, we are living in challenged periods of time, and there's no sugarcoating. Higher interest rates, higher inflation will be difficult for equity markets. But in Singapore, there's a silver lining. You have actually a defensive quality. Number one, you have earnings resilience. Number two, you have actually value traits in demography. And third, you have actually attractive valuations. Not a bad mix in today's environment. So we think Singapore will do well in this environment. Number two, dividend strategies can be very attractive in these times. When you look at growth in dividends coupled with a very high focus on dividend yield, we think that has shown in the past, in times of stagflation, dividend strategies tend to perform even better as an alpha strategy than before. And when you look at then what do we like in Singapore in terms of sectors, we think that the key thing we want to look for, again, as I mentioned, sustainable growth and positive change. So where do we see that happening? Industrials, utilities. We think that's an interesting sector to be in Singapore because, number one, they have energy prices as a tailwind, and number two, they are also pursuing a lot of what we call ESG initiatives. We have a couple of investments that we are very positive on, given the move towards energy transition. So with that, I kind of thought I would just summarize these are our key thoughts on the market.
Yeah, thanks, Kenneth. So I will just wrap up with a couple of slides. On the next slide, just a couple of quotes that we sometimes use with our, to share with investors. So timing is a risky affair. I think some investors have been thinking of whether, to pull in or out of markets. I think if it's a bit of rates, depending on whether the outlook is good or bad, of course. But if you keep timing, then there's a risk that you'll miss markets turning and staging a recovery. So I think Peter Lynch used to say that far more money has been lost by investors trying to anticipate corrections than actually lost in the corrections themselves, because most of us, we just don't have that crystal ball that I think Lisa said she doesn't have as well, right? So then what is one strategy? I think is really regular savings plan. I think we say it quite often, we believe in its merits. And I think it's, again, one way to just not succumb to the emotional parts of investing. And I think Benjamin Graham captures that thought quite well. And the last point here is really diversification. Don't be overexposed to just one or two sectors. Just have something that is quite well spread between equities and fixed income. And of course, just don't go near cryptos at all. Just to reiterate that point. But really, it's relative to your goals, your life goals. What are our life goals? If we know what are the life goals we want, whether it's retirement, the kids' education, we have a time frame in mind, and I think that should guide us in terms of a lot of the decision making. So just to wrap up on the last slide, so this is our research team's latest portfolio positioning, so just for investors to have a look. So this is where we have the neutral positioning across fixed income subsectors and equity subsectors, and also the latest positions in terms of the latest weights, which reflects our preference, which is whether it's underweight, overweight, or neutral. Happy to to catch some of you later on to speak further if you have questions on this. So Kenneth and Lisa, thank you so much. I played the devil's advocate part and had some of these questions, but I thought it would be good for investors to really appreciate what you analyze every day as part of your work. And thank you to the audience for your time. Please take care. We'll see you soon.
Thank you, panelists, for the rewarding session. It is now time for our quiz. This will be the first of the 2 quizzes in line for you today. Aim to answer the quiz questions correctly in the shortest amount of time, and the top 6 participants in our quiz today will win $50 worth of Grab vouchers. To access the quiz, head to Event Live via the QR code on your event flyer. Click on iFAST Mid-Year Review 2022 and log in with your name and email. After you log in, click on Agenda and Activities on the left-hand side menu. Under the Agenda section, click on Quiz and then click on the Join Quiz button. If you're in already, you can see the warm-up question right now. This is just a trial question. What is FSMOne.com previously known as? We have 4 options for you to choose from. Aim to answer them correctly in the shortest amount of time. And now let's take a look at the results. 93.55% of us have chosen Fund Supermart, with 6.45% choosing Fund Supermarket. Which is the correct answer? It's the first one, marked by the green tick on the right, Fund Supermart. Right after this, you will be able to see a leaderboard, and that will display your nickname that you have used to log in and show you the results. For now, let's start with the first question. Which of the following is not a factor behind the commodities supercycle? Option number 1, short-term structural trends of overinvestment. Option number 2, strong pent-up demand for oil. Option number 3, supply fears have exacerbated. Option number 4, commodities as an inflation hedge. Answer them as quickly as you can. And the results are great. 62% of you have got this right. The correct answer is the first option, short-term structural trends of overinvestment. All right, and let's check out the leaderboard. Our top 6 rankers are Yap, Albert, Geraldo, Shia, JJ, and Mabel. We've got our ranks 7, 8, 9, 10 at the bottom. You all still have a chance to rise to the rankings, so make sure to answer as fast as you can in the next question. Question number 2, when investing in S-REITs, investors should not be selective of the S-REITs. Or could it be, should not just look at the yield alone? Or is it that investors should not look at the current investment climate? Or is it option number 4, investors should not look at DPU growth, NAV, and yield spread? Once again, the ranks in our leaderboard can change after every question, so you still stand a chance to rise up the ranks. 81.08% have got this correct. The answer is option number 2, investors should not just look at yield alone. And it seems that our rankers have changed. Our top 6 rankers right now are Albert, Kevin, DW, Geraldo, Chin, and CJ Ng. Mabel, CMZ, SSH, and Loy, you still have a chance to rise up the rankings. We have a couple more questions to go before the final rankers will be released. So let's check out question number 3. Which of the following is a reason why it's a good time to enter China's stock market at this juncture? We've got 4 options for you once again. China is tightening COVID lockdowns and restrictions. Earnings outlook has been looking overly pessimistic. Lack of policy actions to stabilize economy, and valuations of Chinese equities remain attractive. And the results are out. It seems that Most of us did not get this correct. 70.37% of us chose the last option, but the correct answer is earnings outlook has been looking overly pessimistic. That is the second option. And our rankers have changed once again with Kevin, CMZ, SSH, CJ Ng, NGVM, and Andy Ong taking the top 6 ranks. Rainbow Love, DW, Albert, and Geraldo, you still got a chance. All right, this is question number 4. Which of the following statements is untrue? Once again, there are 4 options here. Lower credit quality bonds are less attractive when government bond yields increase. Rising global food protectionism poses upside risk to inflation. Rising interest rates unlikely to directly impact food and energy prices. And lastly, shorter maturity bonds are more volatile to changes in interest rates. And the results are out. It seems that a small percentage of us here have got this correct. The answer is option number 4. Shorter maturity bonds are more volatile to changes in interest rates. Let's check out the leaderboard once again. Rank 1, we have CMZ, rank 2, Albert, rank 3, DW, followed by SSH, Kevin, and CT. Aim to be our top 6 rankers to win $50 worth of Grab vouchers. Let's go. This is question number 5. Which of the following portfolio strategy is useful when markets are choppy? We've got 4 options for you over here. This is a test of how accurately you remember our presentations earlier on. Diversify across products, providers, and investment platforms. That's option 1. Option 2, weekly regular portfolio rebalancing strategy. Option 3, adopt shorter-term investment horizon to react to volatility. Or is it option number 4? And the answer is option number 4. Ensure diversification across asset regions, sectors, styles, and themes. 78.31% of you got it correct. Congratulations. And now let's check out the leaderboard. CMZ, DW, Kevin, CT, SSH, and Elaine. Still very familiar names. You have taken the top 6 rankings right now. Congratulations. CJ Ng, LHW, NGVM, and Andy Ong did pretty good as well. Once again, this is only the first of the 2 quizzes in line for you today, so you still have more chances to go. This is the final question for the quiz. Now take a look at the top 6 ranks. If your result screen shows your nickname between ranks 1 through 6, take a screenshot showing the whole activity window and make sure that your rank, score, and nickname will be captured clearly. Then winners, email the screenshot with your event nickname and your FSMOne or iFAST Global Markets Singapore account number to events@ifastcorp.com. Email us by the 15th of July to claim your prize. Let's now return to our presentation. This will be the last for this morning's session. Presented by Colin Low, Assistant Manager of the Research and Portfolio Management Team at iFAST Singapore, he will share tips on how to invest when both stocks and bonds are crashing. Over to you, Colin.
Hello, hi everyone. I'm Colin from the research team. I know we have overrun the time by quite a bit, so I will try to keep things short and keep things fast, so please bear with me. Okay, so back to this presentation, I think if you look across this year, markets has been very challenging for investors, for you and for us alike. So the market narrative has shifted from one of strength to one of caution. And as you look around all over us, major asset classes are falling quite rapidly. And so how, under this environment, how should you invest? So my presentation here, I will talk about some of the key points of how you should do or what you should employ for your portfolio practices, as well as some of the asset allocation strategies for investors to combat this volatility. So in the next slide, let's look at more in detail of what has happened recently. Next slide. So what has happened is a question that I get, our team get very often for investors as well as from the advisors. So if you look at a chart on your left side, you can see that markets, both equity and bonds have fallen by about 20% in the year to date. That is very drastic. And something interesting here is if you can look at the other chart, right next to it is the correlation between the equities and bonds. In fact, for global as well as the US, bonds and equities have flipped positive and in fact has been rising in the year to date. So what this means for investors is that bonds are essentially a less effective hedge for equities after this recent dynamics. So is this something that investors should worry or should be concerned about? So as a house, we think no, and I'll share 2 reasons why. Next slide. Sorry, next slide, please. All right, so in this slide right here is the first reason. So is this a common occurrence? It's something that we ask ourselves first and foremost. So in short, no. Based on our research, what we find is that if you look across the past 30 years since 1990, what we find is that whenever stocks and bonds start to fall, it is when inflation starts to rise, central banks start to hike rates, as well as during slowdowns and recession. So aside and outside from all these different dynamics or different scenarios, stocks and bonds falling is quite an uncommon occurrence. And I will show you two statistics right here. So if you look at look at over the past 30 years since 1990, there were only 76 out of almost 390 months that stocks and bonds fell. So as a percentage, that is about 20% of the time. So if you look at things from a quarterly perspective, you'll find that there were only 19 out of 128 quarters which both asset classes fell together, and only about 15% of the time. So statistics show that this is in fact a rare occurrence. And in the next slide, I'll show you the second reason why. So the next important question we have to ask ourselves is how long does this usually last? And as shown from this chart over here, you can see that this, in fact, is a very brief reaction as stocks and bonds tend to rebound relatively quick. As you can see from the chart here, stocks and bonds rebound about 1% 3 months after and about 6 to 7% 12 years out. So something even more interesting is that consecutive months of negative return for stocks and bonds are relatively rare. In fact, it is only almost 95% of the time stocks and bonds fell for only 1 month only. So if you look at as a whole, the reasons why we are not concerned about this situation is that it is a relatively uncommon occurrence, and this is also something that is fairly brief. So next slide, please. And having said that, let me now share some important reasons why investors should stay active during this turbulence and some of the important portfolio practices to combat volatility. Next slide, please. So starting with diversification, which is one of the most important practice investors can employ. And I'm sure the previous couple of speakers have also narrated and talked about this point. But I just want to share some important tips on diversification. And to simply put, diversification can reduce portfolio correlation and ultimately prevent major drawdown risks. And the reason why we believe diversification is an important tool in today's context is that if you look around us, look at the macro risks, look at the event risks around us, such as the Russia-Ukraine war, inflation, aggressive central bank, and growth slowdown. All these are in fact localized risks or more severe in one region over the other. And this makes diversification a very important tool to reduce the exposure to all these different localized risks. And as shown from the table right here, which is a correlation matrix between the major bonds and major equity segments over the past 1 year and 3 years, you can clearly see that the correlation differs across these different major asset regions. So I'd like to highlight 2 things from this chart right here. So first, as shown within the green box, which is the 1-year correlation between the equity markets. So as you can see, the 1-year correlation between the equity markets, as shown in the green box, are relatively low, as highlighted in blue. And what this means is that investors can achieve quite effective diversification just by spreading allocation across equity region and just not sticking into one equity region. And the second thing I want to share is highlighted on the red box right there, and which is the one-year correlation between major stocks and major bond segments. So as you can see, the correlation is even lower for the major stocks and major bond regions, especially for safer bond segments. So what this means for investors is that just by allocating away from equities and into bonds, investors can achieve even more effective diversification and reduce the portfolio correlation much more. So to link back to what I mentioned earlier in my previous segment, while the correlation for stocks and bonds have turned positive, these bonds are still a good asset class to invest in a diversified portfolio, because I think as investors, we should not forget that bonds are a return-generating asset class. It carries yield or carries a positive carry. And lastly, it has the ability to dampen equity market drawdowns. So next slide. So in my previous slide, I briefly mentioned the merits of diversification across region and across asset class. But there are also many other ways investors can diversify. For example, diversification through sectors, through styles, as well as through teams, be it in general teams or in more specific teams. Next slide. And the next important portfolio practice for investors is rebalancing. So a rebalancing strategy that are well planned works best when the markets are choppy, such as what we are seeing right now, when asset class can strongly outperform in one day and strongly underperform in the next day. And unfortunately, this is something that we are being dealt with right now, the cards that we've been dealt with right now. But nonetheless, rebalancing is a strategy that works very effective now because of two main reasons. First, it enables investors to maintain the diversification choices through the changing market condition. And what I mean by that is essentially by rebalancing, an investor is actively resetting the portfolio to its intended diversified choice. And instead of letting the allocation drift, which means that the portfolio becomes more concentrated in a certain segment. And for the second reason is that rebalancing can translate to a more stable portfolio risk profile during volatile times such as this, instead of one that mirrors the market. So for us, we ran a simple backtest to track the returns of a buy and hold strategy, which is no rebalancing versus periodic rebalancing over a quarterly period, a semi-annual period, as well as an annual period. So the results are shown on these two charts right here. And as you can quite clearly see that over a 20-year period, periodic rebalancing produces returns of around 5 to 10% stronger than the buy and hold strategy of no rebalancing. That is including the transaction cost per rebalancing. So once again, periodic rebalancing produces stronger return over the long term relative to a buy and hold strategy. And this example uses a calendar rebalancing, and investors can also consider a range-based rebalancing, which is rebalancing triggered when your asset allocation exceeds a pre-specified range. Next slide. And another important practice I would like to highlight during volatile times is to focus on the right asset class. And by right asset class, our definition is that one asset class should enhance the portfolio risk return profile. And with that regards, we think that crypto is a poor investment vehicle, as shared by my colleague JP earlier. And the reasons are listed on this screen right here. First, it lacks fundamentals. Next, it is a not so reliable hedge for inflation, as we have seen clearly. And thirdly, the global liquidity is receding, which means that the money, speculative money that has been pumped in the past couple of years are now receding, pulling the asset class lower. And next, we think cryptos have high idiosyncratic risk as well as high volatility. And most importantly, it is a reflection of the greater fool theory. So the next important point that I'd like to share is during this volatile period, investors should remain focused on the longer term horizon. So I believe many of you and many of my fellow investor peers do sometimes during market volatility have the tendency to exit all the position and put everything in cash. So while we acknowledge that cash in the near term can tactically outperform stocks and bonds because it is more resilient to capital destruction, but over the long-term period, cash typically underperforms, and in real terms even more severely. So On the chart right here, you can see that we ran the returns of stocks, bonds, and a 60-40 stock bonds portfolio versus cash over various horizons, such as your 5-year, 10-year, and 15-year. And what we found is that over all these periods, in fact, cash significantly underperforms stock bonds as well as a 60-40 portfolio. And bear in mind that all these returns are nominal terms. So if you convert them to real terms, taking into account of inflation, which is very prevalent in today's situation, the real returns of cash is much lower than the other asset class. Next slide. So having gone through some of the best practices for our portfolio, let me dig a little deeper. And in this section, I'll share a little bit on our managed portfolios as well as our asset allocation strategies to combat the ongoing volatility. So let me first introduce DPMS and MAPS, which is our managed portfolio solution. So at iFAST, we provide the discretionary portfolio management solution, DPMS in short, for institutional clients, and FSM MAPS portfolios, MAPS in short, for our retail investors. So both are independently managed portfolio services that builds, monitors, and balance your portfolio for you. So both DPMS and MAPS features 5 different portfolios, each catering to different investor risks. Next slide. So our portfolio mainly invests in equities and fixed income through a very carefully selected careful process of selecting the ETF as well as the funds. So for equity allocation, we adopt a GDP-weighted methodology, and that ensures that our portfolios are more diversified versus global benchmark. And as shown from this screen right here, you can tell by the comparison between our own portfolio versus, let's say, a MSCI AC World Index. The geographical allocation differs very much wildly. So in the MSCI Global World Index, it is highly concentrated in the US stocks, whereas ours is much more diversified. And for a fixed income allocation, as shown on the bottom pie chart right here, we are invested in major bond segments around the world, and we also have a larger allocation to safer bonds region, making sure that our portfolios are more diversified and also have stability in them as well. In the next slide, please. And across the different asset classes, we remain overweight equities over fixed income by 5%. So the decision to overweight equities stems from our view that the outlook for equities remains much more supported than fixed income. So for equities, what we have been seeing is that the fundamentals for both earnings perspective as well as a macro growth perspective remains positive. While we might see downgrades in the fundamentals, but growth numbers are still positive this year. And aside from that, valuations have retraced back down to much more palatable levels, and our forecasts indicate attractive long-term returns from several regions such as China and Asia as Japan. Whereas on the other hand, if you look at fixed income markets, they have been very much challenged by the volatility in rates, and that means that the price for fixed income as a whole may remain volatile because of the uncertain trajectory in inflation. And on top of that, when we look at yields, no doubt they have been rising, but we do think that spreads have even more room to rise as well because of financial conditions tightening and growth weakening, and therefore we see more downside in fixed income. And overall, for all these reasons, we choose to allocate more to equities over fixed income. Next slide. So for equities, we prefer Asian equities, and in the regions such as China, Asia and Japan, as well as Japan itself. So as a result, we remain overweight on these areas, and to fund the overweight in this area, we have a deep underweight in US equities, as well as a moderate underweight in digital economy stocks. So for fixed income, our strategy here is to dial back on the aggregate duration for the fixed income regions and instead allocate to regions that are shorter duration but provide decent yield. So what we did was we reduced the allocation to EM hard currency debt and reduced the allocation from US high yield and reallocate them to Singapore-centric bonds. Next slide. So in terms of a style preference, as mentioned earlier by Terjin, we do prefer value stocks over growth. And as shown from this chart right here, value has significantly outperformed growth in the year to date. And for reasons that I mentioned by my colleague Terjin, So for our portfolio itself, we have initiated exposure to value stocks and, in fact, initiated exposure in our US as well as European equity sleeve, which are the largest two equity sleeve within the equity allocation. So right now, we are holding a barbell allocation towards both large cap growth as well as US value-oriented, as well as value-oriented equities within the US and European sleeves, as shown on this illustration right here. So the reason why we hold a barbell approach is that we want to express our positive view on value, but B, we also want to maintain exposure to the large cap stocks, which, in fact, what we found through our research, we found that valuations have now been retraced back to much more palatable levels. Fundamentals are still relatively strong for a lot of these large cap companies, and we also want to be positioned for an eventual recovery, and having a barbell allocation to these two factors allows us to be positioned in such manner. Next slide. So in terms of sector as well as thematic preferences, we are still bullish commodities and have initiated exposure to global natural resource segment. So the reason for our bullishness was highlighted by my colleague Chloe earlier, but in short, we see a positive supply-demand setup, which is bullish on prices for the near to mid-term. And like I mentioned earlier, the Russia-Ukraine war is, in fact, one of the key catalysts. And from this chart right here, you can quite clearly see that Russia-Ukraine as a whole makes up a very overwhelming share of the global supply of major commodity complex. And on top of that, we also see a long-term bullish case for commodity prices, and that stems from the long-term structural underinvestment as well as shift in priorities from the government to food and energy prices. And lastly, we believe commodities are, in fact, a very effective hedge for inflation and geopolitics. So with these three reasons combined, we are bullish on the commodity sector. And with that, I've come to my final slide. And before I end, I would just like to leave you with the key takeaways from my presentation, which are these 3 points right here. Do not be afraid or do not be overly concerned when stocks and bonds are falling, and also some key important portfolio practices for investors and our recommended strategies to inject resilience in the portfolio. And as such, thank you guys for staying throughout this presentation, and I'll see you again next time.
Thank you, Colin. Before we head to our lunch break, we have some exciting but also important information to share with you. Do you fancy winning $500 worth of Capita vouchers? How about a Nintendo Switch or an M1 MacBook Air? If you do, we have 2 lucky draw segments for you to take part in today, and these lucky draws will happen after lunch. This is exclusively for in-person attendees, and 6 lucky people here with us will walk away with these attractive prizes. To take part, place your lucky draw slips found in your event flyer into the box found at the booth outside our event hall. I'll repeat this once more. This is exclusively for in-person attendees, and in order to take part, you have to place your lucky draw slips found in your event flyer into the box that you can find at the booth outside our event hall. Also, be amongst the first 200 people here to get a free cup of barista-style coffee. It's really easy. All you have to do is snap a photo at the event and share it on your social media. If you don't have an FSMOne.com account yet, today is a great chance to get started. Open one today and you will receive 5,000 rewards points. If you know of a friend who does not have an account, get them to open one, and both you and your friend will receive 5,000 rewards points each. Remember to enter the promo code shown on screen to enjoy these benefits. For more details, you can refer to our event flyer with a QR code. If you're new to iFAST Global Markets Singapore, receive 5 Singapore dollars in your IGM cash account when you successfully open your first iFAST Global Markets Singapore account. If you're an existing client of iFAST Global Markets Singapore, refer a friend or family member to open an account. When they successfully open their first iFAST Global Markets account, both you and your referee will receive 5 Singapore dollars in your IGM cash account. Remember, same thing to enter the promo code shown on screen to enjoy the benefits. For more details, you can refer to our event flyer with the QR code. We will now be taking a lunch break. Join us back here again at 1:15 p.m. for more presentations, quizzes, and lucky draws. Have a good lunch and let's catch up again at 1:15 p.m. Thank you.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFAST TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFAST TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel.
Welcome to another episode of Money Matters.
Welcome to the iFAST TV Market Outlook 2022 series.
Tune into iFAST TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst.
Later, I really find that investment was my passion. So
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kiong.
I'm Alvin.
My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny.
Here is my investment
resume.
investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
We want to invest in companies that are fast-growing.
How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing,
Once again, here's another reminder to those of you outside the hall, please make your way in as we will begin shortly. You're encouraged to take your seats towards the front of the stage. Thank you. Welcome back, everyone. I hope you've had a good lunch. We will start with the first lucky draw of the day. This is exclusive for our in-person attendees only, so to those here with us in the hall right now, if your number is called, please come up on stage to collect your prize. You may take out your event flyer to refer to your number. We would like to invite to the stage Mr. Terence Lin, General Manager at iFAST Global Markets, to give away the lucky draw prizes. A round of applause for Terence. There will be 3 prizes for this round. The first prize will be Universal Studios Singapore tickets. We will be giving away not just 1 nor 2 tickets, but 4 tickets for this prize. Let's start. Once again, you may refer to your event flyer for your number. The first lucky winner of the day for our first round of lucky draws is the number 8394. 8394. If you're here, please stand up and come up on stage. Congratulations, sir. A round of applause for our lucky man. He has won himself 4 Universal Studios Singapore tickets. Congratulations. You can take a photo in the center of the stage. Moving on to our second draw, the prize for this will be $300 worth of NTUC Fair Price vouchers. Terence has drawn the number, and the number starts with 8, followed by 1. I hear some sighs. Followed by 4. The last number is 1. 8141. Congratulations, another lucky sir. Our lucky winner has won himself $300 worth of NTUC Fair Price vouchers. You're both welcome to come up on stage together. A round of applause for our lucky couple. And smile for the camera. I'm not sure if our young boy over here would prefer our next prize, because the third prize for this round is a Nintendo Switch. This will be the last prize for this round, but not to worry, we will have another round later on. And the third winner, to win the lucky prize, a Nintendo Switch, will be number 842, not 1, but 2, 8420. Do we have a winner present? If 8420 is not here, we will have to draw another number. Once again, calling for 8420. Congratulations! A lucky miss, she has won herself a Nintendo Switch. You can take a photo. Congratulations to all our winners once again, and thank you, Terrence. To all our audience present here, if you did not win in this lucky draw round, not to worry. We will have another lucky draw round later on, so do stay on and join us. Before we kick off with the presentations for the afternoon, we'd like to warm up with a poll session. In order to participate in the poll, you have to log on to Event Live by scanning the QR code on your event flyer. Make sure to take your event flyer out with you and scan the QR code with your phone. By scanning the QR code, it will bring you to Event Live. Make sure to log on. After logging on to Event Live, click on Agenda and Activities. You can find Agenda and Activities on the menu on the left-hand side. This is just a simple poll session to help us start our afternoon. All you have to do to join is take out your event flyer and scan the QR code with your phone. Log on to Event Live, click on Agenda and Activities. Under Agenda, click on Join Poll. You will find the Join Poll button on your screen. After scanning the QR code with your phone, log on to Event Live, click on Agenda and Activities. Agenda and Activities will be on the menu on the left-hand side of your screen. Under Agenda, click on the Join Poll button. If you need help, feel free to raise your hand and we'll be with you shortly to help you out. To our online audience, you're extremely welcome to join us in this poll as well. We have a lady over here who needs some help, and another lady and sir in the middle, and another person over there at the back needs some help too. We'll be right with you shortly, but I'll repeat the instructions once more. You will find a QR code on your event flyer. All you have to do is scan the QR code with your camera phone. A little link will pop up. You have to click it to bring you to the page. And you have to log on to Event Live. Once you log on to Event Live, there will be an Agenda and Activities in the menu on the left-hand side. Under Agenda, there will be a Join Poll button. To those who have managed to log on, this is question number 3. Which market are you most bullish on for the second half of 2022 onwards? We've got a number of options here: China, US, Europe, Asia, ex-Japan, global emerging markets, others, or lastly, none, I'm bearish. We've got a number of answers here for you. This is simply a poll. Currently, 58.14%, more than half of us here, voted for China. With a big number of us choosing none, I'm bearish, consisting of 25.58% of us. Going on to question number 4, which sectors or assets are you most bullish on for the second half of 2022 onwards? We've got financials, real estate, technology, commodities, fixed income, others, or nothing, holding on to my dear cash. Which sectors or assets are you most bullish on? This is simply a poll question, so there are no right or wrong answers. Close to half of our audience here, both online and physically, have chosen commodities, consisting of 48.94%. It seems there are a small number of us choosing real estate, financials, and nothing. Some have also chosen technology. Question number 5, which is your biggest current worry when it comes to investing? Inflation, possibility of recession, geopolitical tensions, rising interest rates, or others? Which is your current biggest worry? We've got 5 options here for you. Share with us your current biggest worry when it comes to investing. Close to half of us have chosen the possibility of recession. A small number of us have chosen others, with some of us choosing inflation, geopolitical tensions, and rising interest rates. Thank you all for participating. This was an engaging session and it definitely helped us understand your sentiments. In our next presentation, Julian Kay, investment consultant at iFAST Global Markets Singapore, will share with you how iFAST can empower you with the right tools and resources to become a great bond investor. Over to you, Julian.
Thank you so much. Yeah, good afternoon, everyone. I'm Julian from iFAST Global Markets. Yeah, basically, iFAST Global Markets is the wealth management division of iFAST. So basically, today, my presentation, I will share with you how iFAST can make you a great bond investor. So I'm sure those of you who have attended this morning's session, you would already have heard from our research team on the topics of inflation, rising interest rates, and how these have impacted global bonds repricing all over the world. So they already did a good job, so I will not repeat these topics. So instead, what I will focus on for my presentation is basically to address the core questions that bond investors would have in their mind, which is very simply how to make money in bonds. And then on the other hand, how to not lose money. Yep. Then at the later part of my presentation, I will share with you how iFAST Global Markets can come in and empower your journey as a bond investor. So next slide, please. Right, I just want you to take a few moments to look at this screen and see if you can recognize any of these gentlemen. Yeah, next slide, please. Yeah, so I think I've actually heard you guys mention the names. So basically, all 4 of these gentlemen are all legendary investors who have made their fame and fortune from investing in the stock market. And I heard a lot of whispers of Mr. Warren Buffett, not Buffet, Warren Buffett. Yeah, so Mr. Warren Buffett has a very impressive track record during the period of 1965 to last year. He actually generated 20.1% per annum from investing in the stock market. And he actually outperformed the S&P 500 by 9.6%. Yeah, so you can see the other grades of equity or stock investing who have actually performed double-digit returns during their tenure. Next slide, please. All right, so now I just want you to take another moment to ponder who is this gentleman. All right, okay, next slide, please. Yeah, so this time I didn't hear so much whispers, but yes, I did hear from some of the more sophisticated investors sitting down there. So they mentioned the name Bill Gross. So Mr. Bill Gross, if you are not aware, he's actually one of the kings in bond investing, and he actually went on to become the co-founder of PIMCO. So during the period of 1987 to 2014, so the fund that he managed actually managed 7.9% per annum, right? So what happened, if you actually look keenly at the slides, is that when compared to the global bond index, if you have compared this with the previous slides showing Warren Buffett's performance, Buffett, yeah. So Mr. Bill Gross, you can see here, generated just 1.03% more than a global bond index. So basically, what does this imply? Yeah, next slide, please. Right, so you can see I actually removed the word great and then replace it with good. So basically, you can see from the investment results of a bond investment grade like Mr. Bill Gross, he only managed to outperform the bond index by 1%. So what I would like to bring across is that it is actually very unrealistic to be expecting the kind of returns that can be generated through stock or equity investing. In fact, all we need to learn is how to be a good investor. Yeah, which I will actually touch upon some of the critical factors that we should look at. Next slide, please. Right. So basically, as a bond investor, we need to know how bonds can help us to make money. Then number two, we need to know how not to lose money in bonds. Very simple, right? Yeah, then the third point is you need to find a service provider that can help you make the right bond investments. Next slide, please. Right. So first of all, in order to know how we can make money from bonds, we need to understand where our bond returns come from, and then actually what impact the returns of bonds. So there are actually four factors that I'll cover. Number one, which is coupon yield, followed by currency, interest rates, and then lastly, credit quality. Next slide, please. Right. So the first factor is the coupon yield. So this is basically one of the most basic yield that every investor should be aware of. So basically, the coupon yield is the annual amount of interest that the owner of the bond will receive. And these coupon payments are typically paid twice on a semi-annual basis. Yeah, so one thing I want to highlight and share with you is that essentially bonds, they are structurally created to make payments to the investors. And this is unlike stocks, which the expected returns are actually based on the future. So for bond investments, you can actually know your yield or your expected return at the time of the purchase. And so one of the most basic rule in bonds is basically to buy bonds that can provide you with a positive yield. So if you look at this headline from Bloomberg, in fact, it's very difficult to buy into a negative yielding bonds because, as you can see from the headline, there are only about 100 left in the world. Yeah, so this goes to show that they are still there are in fact more positive than the negative bonds out there. So yeah, so basically we should go in to buy bonds with that can give you this positive yield. So next slide, please. Right. So another factor that this is one factor you should be aware of, because this is the factor that can actually make you lose money in bonds. Yeah. So for investors who want to express a view on currencies, or you want to perhaps trade or profit from currencies, bond instruments are actually not the best not the best asset class to express this view. Yes. So when it comes to bond, basically we advise investors to buy into bonds that in currencies that you are already using or comfortable to holding, so that there is no need to take up that additional fluctuation by speculating on currencies. Yes. So next slide, please. Right. So the next factor that can actually help you make or lose money in bonds is interest rates. So I think this term needs no introduction. It's in the news every day. So but what is important to know that I think when you actually look back in your finance 101 textbook, you know that as interest rates goes up, the prices of bonds actually go down. Yeah. So but one crucial point that I want to bring across is that while bond prices, they fall in response to rising interest rates, a bond investor only lose money when he chooses to sell. Right. Remember earlier I mentioned to you that bonds are actually structurally created to make payments to investors. So basically the rule holds, bond prices, they will revert to par or their stated value at the time of issuance when they reach the maturity date. Yes. So it's important to be able to hold your bonds even though the prices are falling. So it is important to know exactly, like, how long can you hold your bonds? How long are you prepared to hold to hold your bonds, because there are bonds with varying maturities from even as short from 1 year to your 2 years, 3 years, 5 years, and even as long as 10 years. Yeah, so basically, if there's a point that I can bring home, if you are to invest in bonds, you need to identify that holding a period, and during times of a massive fluctuation, you do not sell when your bond prices are down, because eventually they revert back to par. Next slide, please. All right, so the fourth point is credit quality. So this is could be actually one of the most important factor when it comes to bond investing. So this morning, actually, if you attended our bonds research presentation, so he would have introduced you to bonds, to some bonds ideas which our team access to have a good credit quality. And usually these companies with a strong credit quality, they will have the ability to make good on their coupon payments, and also to redeem the proceeds upon maturity. So very simple. Basically, is do not buy bonds that default. Yes, but of course, how to do it? You will actually need to have the right information. You will actually need to have a very good research that actually goes through the balance sheet, the credit profile of the various bond issuers, so that you can make the right decision. Next slide, please. Right, so just to summarize, how to be a good bond investor. Basically, buy bonds with strong credit quality, buy the bonds with yields that you like, and very importantly, you need to buy bonds that you can hold to maturity, so you need to identify your holding period. And in order not to lose money, don't buy bonds with negative yields, and don't speculate on currency with bonds. And of course, don't buy into those lousy bonds. Basically, buy into bonds that have a strong credit quality, strong balance sheets. Next slide, please. All right, so if you were to ask me, all right, what are the bonds out there in the market which would have a very low risk of defaulting? So one name that you can think of that is like virtually impossible to default would be the Singapore government. So for those who are not aware, the Singapore government, they actually offer what we call the Singapore Government Security Bonds, or SGS in short. So as you know, in this year, we have already saw a lot of repricing in bonds globally. So it is also the same with Singapore government security bonds. So in fact, we have seen that the yields of these bonds, they for the 1 year and 2 year tenor, they have actually increased more than 150 basis points. And right now, for the 1 year tenor, as of yesterday, the yields have risen to about 2.3%, while the 2 year SGS yields have risen to about 2.6%. Yeah. So if you were to actually compare this with some of the fixed deposit rates out there, some of the local banks, they are actually offering up to about 1.4%. And actually this 1.4% is only offered to you if you satisfy certain requirements. Yeah, so this is one consideration. And you can actually find out more about Singapore government security bonds with our IGM advisor. So their booths are outside. So after the session, at the end of the day, you can speak to them to find out more. Next slide, please. Right. So after sharing with you all those pointers on how to buy into bonds with positive yield, strong credit quality, I'm now just going to share with you a very simple rule, which is diversification. Yeah. So basically, buy fewer bonds that lose money and buy more profitable bonds. So you will ask me, okay, Julian. So do you know that investing in a wholesale Singapore corporate bond, you will need at least 250,000. So in that case, if you're going to ask me to diversify, then I will need a lot of capital, right? Yeah. So over here at iFAST, I will show you one of the initiatives where we can actually help bond investors to diversify their bonds portfolio. Next slide, please. Right, so we have what we call a Bond Express, and this allows you to trade popular bonds in smaller denominations. So basically, like I mentioned, SGD corporate bonds are sold in 250,000 sizes. So, but over here at Bond Express, we make them available in sizes of 5,000. Yeah. So basically, when you buy into a Bond Express bond, the experience is exactly the same as buying odd lots. Basically, you can buy 5,000 of the same bond 50 times or different bonds. So in this case, you can actually have diversification and build up a portfolio of diversified bonds. Next slide, please. Right. Here are just some of the well-established names that I believe that you guys will recognize. And all these issuers, they are actually available on our platform. Next slide, please. Right. So lastly, now I will just touch upon how over here at iFAST Global Markets, how we can actually help you and empower you to make the right bond investments. Next slide, please. Right, so I already shared with you on our Bond Express initiative, and this allows you to build up a diversified portfolio. So number two is what we are very proud of here is our dedicated bond research capabilities. So if you have sat in this morning's session, you have seen how our analyst actually he did the heavy lifting of going through all their solvency, credit, debt ratios, and then at the end of it, they will do their assessment and then make a recommendation on whether this is a bond that they advise investors to hold. Right. So the third point is that over here at the iFAST Global Markets, what we offer is a very transparent bond pricing. So you actually receive a genuine wholesale bond prices with no hidden markups. So in terms of the fees, this you can actually speak to our IGM advisors. Right. So over here, we pride ourselves on giving you a holistic advice on finding out your financial goals, you know, how long you can hold your time horizon. And so rather than, you know, just give you like product pushing, we want to meet your long-term financial goals. Right. So with that, I've actually come to the end of my presentation, and you can take the time to speak to our IGM advisors. Thank you so much.
Thank you, Julian. Up next, Terence Lin, General Manager of iFAST Global Markets, will share with us why dividend investing can be dangerous. Terence, please.
Okay, very good afternoon, everyone. Can all of you hear me? Yep. This topic, does it make you uncomfortable? I think so far we have heard all great things about dividends, right? Can I get the next slide, please? So who doesn't love dividends? Please stand up. Those behind. Yeah. Okay, I'm not here to tell you that dividends are bad. Okay, so dividends, I think the whole idea of a dividend is really very good. Right? When you hear about dividends, you feel good. So if you look at the next slide, yeah, it actually gives you that kind of a warm, fuzzy feeling, you know, when you look at all these cute little animals and you think about dividends, you feel good about your investments. I think that's what everybody experiences. So I have this difficult job today to try to share with you some problems, okay, when us investors focus too much on dividends when we're making our investment decisions. Okay, does it sound interesting? I'm not sure, but I think hopefully you bear with me for the next 15 minutes and I'll share with you some of these possible lessons and takeaways. Okay, next slide. So I just want to be clear, dividends are important. Okay, I'm not here today to tell you that dividends are not important. Okay, most of you have seen a slide like this. Okay, with dividends reinvested, you can actually have a huge difference in your returns, and this is actually the US stock market from 1960 all the way to 2021. Okay, for those of you who don't like charts, you can see the numbers. So next slide. Okay, dividends were actually 30% of the stock market's return. Okay, that's how important dividends are. But I'm not here to tell you about dividends being important or not important. We're here to talk about focusing too much on dividends when one makes investment decisions. So next slide. Okay, I just want to tell you that actually dividends are pretty representative of health of a company, because all of you know that when a company is not making a profit, it can't pay a dividend. Okay, those who pay dividends when they are not profitable are basically not doing their shareholders a lot of justice. Okay, because a company needs to survive, it needs to make a profit, it needs to be healthy, and therefore it can pay a dividend from those profits. So yes, dividend payments are a good sign of a company's health. Okay. So dividends by themselves, they are not bad. Okay, but what I want to share with you today is that focusing too much on dividends can actually lead to a few problems. Okay, so let me share with you a couple of examples where these problems may happen. Okay, next slide. Okay, so today I think you've heard a lot about rising interest rates. Okay, right from the morning you heard about mortgage rates rising. You didn't hear too much about the mortgage rates, but you hear about the investment implications. Okay, higher interest rates are going to impact a lot of investments. So I'm going to put this out and say a rising risk-free rate may have some impact on the repricing of dividend stocks. Okay, next slide. Okay, what do I mean? I think if we talk about dividend stocks, it's not so easy to understand, but let's talk about the bond market. Okay, what happens for bonds when interest rates rise? All of you know that bond prices tend to fall because the bonds now have to deliver a higher rate of return because interest rates on the whole are higher. Okay, so but then what about, or what relationship does this have with dividend plays? Okay, stocks that you consider to be very good dividend payers. Next slide. Okay, this is a bit of financial market history. This is a chart showing interest rates all the way back to 1960. So you can see that the first 20 years from 1960 to 1980, we saw interest rates rising from the 2% level all the way to close to 20%. Okay, back in 1980, okay, the federal funds rate, okay, the range was between 15 to 20%. Okay, that was the peak of the interest rate cycle. And subsequently, the next 20 years, the next 40 years, I beg your pardon, okay, that's when interest rates were falling, and you saw the rates falling all the way down to near zero levels, okay, in more recent history. Okay, so remember these two periods, because in the next slide, okay, let's have a look. You can see that the dividend yield on the stock market, okay, the first 20 years was somewhere between 3 to 6%. Okay, so therefore kind of appropriate for a higher interest rate environment. And over the past 20 years, in fact, so that dividend rate or dividend yield on the US stock market has actually dropped all the way to a range of between 1 to 2%. So today, I think that's the kind of dividend yield on the stock market you're talking about. So what does it mean when interest rates start rising? Okay, I think that the market will start to demand a higher dividend yield. The companies that are known to be good dividend players or payers are likely to have to then sort of reprice so they can offer investors a higher yield. Okay, let's look at the next slide. Okay, so what I'm talking about is that a decent dividend yield in the context of very low interest rates may actually not, okay, be enough when interest rates start to rise. Okay, so just as an example today, if you look at high-yielding US stocks, okay, they're currently yielding about, I don't know, 3.1%. So that's not too bad if you compare that against a 0% interest rate environment. But when the 10-year yield today, okay, in the US is already 3.1, 3.2%. Okay, I think there's this risk and danger that some of these stocks will then have to start repricing, both against the general stock market as well as against the interest rate environment. Okay, so just leave you with that thought. Okay, next slide. Okay, the second thing, this is more in terms of dividends giving us a false sense of confidence. Okay, let me give you an example. Okay, next slide. Okay, this is a bad example. Okay, so some kittens can be pretty dangerous when they grow up. Okay, next slide, please. Okay, just give you a Singapore-based case study. Okay, this particular stock opportunity, okay, back in the year 2006. I'm not going to name the company because we're not here to talk about specific examples, but those of you who are a bit better read or well read will probably be able to guess the company. Okay, so this was actually a household name, and actually still is a household name in Singapore today. Okay, had a 1/3 share of the mobile market, 50% share of the residential broadband market. Okay, in a resilient defensive telecommunication sector, and actually spotted a 5% dividend yield, pretty attractive, right? So you imagine that you can't really do a lot of wrong buying a stock like this. Okay, blue chip name. Okay, yeah, I see some people laughing because, yeah, obviously things are not going to work out so perfectly, right? Next slide. Okay, so the company is also well aware that people are buying the company stock because of the dividend. So they actually, every year in their annual reports, they will highlight how great the dividend is: 7%, 6.3%, 8.8%. They even dedicate big sections of the annual report telling you why you should be investing in the stock, and the dividend is a big part of that. Okay, so this is a pretty extreme example because I don't think most companies focus a lot on their dividend payouts. They always tell you that we don't. Dividends are, there's a certain policy, but it's also dependent on the profitability of the company. But this company tried to pay a whole big dividend, and they actually held that dividend over a number of years. Next slide. So what happened was that dividend went up. It was held steady at, I think, 20 cents a share for quite a number of years. And then as the industry changed, okay, more competition, you needed to spend more money investing in new infrastructure. Okay, it's a capital-intensive industry, right? Telecommunications, 5G. So after that, the company realized it couldn't pay a dividend, or at least a big enough dividend as what it did in the past. Okay, so the dividend went down. And what did that mean for stockholders? On the next slide, you can see that actually over the entire holding period, okay, 16.5 years, you made less than 3% a year. Okay, holding this stock, which is actually, I mean, it's not a bad or I wouldn't say it's not a reasonable return, but it's a far cry from that 5% dividend yield. Okay, as an investor, you're looking at a company and saying, yeah, I'm guaranteed. Well, okay, sorry, I didn't say it's guaranteed, but it's not the kind of return you would expect buying into a stock with a high dividend like that. Okay. So there are also a couple of other examples. Companies in the media industry, I think recently also delisted. I think also gave investors not a very good total return. Okay, even with all those hefty dividends that were being paid out over the years. Next slide. Okay, it's not just stock investors, okay, that will have this false sense of confidence. So we obviously are big on unit trust. Okay? That's how we started the business. And we find that there are actually unit trusts or mutual funds that tend to overpromise or try to do certain things that are not aligned with the underlying market. So as an example, there's this particular strategy. Again, I'm not going to name the specific fund or the fund manager. But this fund wanted to pay a 7% a year dividend rate. Okay, this comes from a fund. And they actually invested in global stocks. So this fund was launched back in 2007. And anyone knows that you can't get a 7% income investing in the stock market. Okay, but they still went ahead to do that. And currently today, there's still about $1.3 billion of client money inside there. Okay, mostly not our clients, but I guess they're clients all around the world that are invested in something like this. Okay, so what kind of experience did investors get after that? On the next slide. You can see that there was a lot of capital destruction. So that fund was launched at $10. Today, it's barely around the $4 mark. So you lost 60% of capital. But of course, you were paid a dividend, right? So you get that 7% dividend a year. And on a total return basis, you made just 1.2% a year over the past 14.5 years. That is not the kind of return anyone wants to get in investing in the stock market. Okay? But of course, many investors were still very excited about that high dividend yield or distribution yield. And of course, the investment outcomes were less than ideal. Okay, next slide. Okay, the third point. Okay, you could actually miss out on certain opportunities if you are very focused on dividends. Okay, next slide, please. Okay, there's this particular study that I found quite recently, a study that came out in the year 2021, where these researchers found, or they examined 65,000 stocks. I think you're free to go and look this up on Google. You can see the research done. And they actually found the companies out there that were investable, that made the most money for investors. Okay, so they were not looking at stocks that grew the most in a percentage term, but they were looking at the stocks that if you were invested in them, you actually generated a lot of wealth. And I think if you look at these names, you'll know that these companies have made many investors decent investment returns over the years. And actually, most of them, or at least some of the key ones there, actually didn't do dividend payments or dividend payouts for quite a long time. Right, so I think Apple only had dividend payouts, I think in more recent history, the likes of Microsoft, Amazon, Google, which is now Alphabet. So these are companies that generated all that wealth and they didn't deliver any dividend income or not meaningful dividend income to investors. So you would have missed out on some of these opportunities if you were using dividends as a main criteria. On the next slide, I think you saw this guy's face earlier. Okay, this company called Berkshire Hathaway. Okay, I think most of you who are in the value or investor camp, you know that this guy is probably one of the greatest investors of all time. His company has never paid a dividend before. So if you see that compounding of returns over time has made Warren Buffett one of the richest people still alive. Okay, so some of the opportunities that you would have missed out on if you're only looking at the dividend yield in your investment philosophy. Next slide. So I've talked a lot, given you some examples. Not sure how you guys are feeling, but don't worry, okay? I'm going to suggest some practical things you can do as an investor today. So just some key sharing points. Okay, first thing is you got to watch out for dividend traps. Okay, I've given you some examples of things that actually, unfortunately, only in hindsight we could have seen them. But also, you got to be more open to questioning, where you got to ask, is the company's dividend sustainable? Okay, does a fund that pay huge dividends, can they support that with the underlying market that they're invested in? The second point, I think it's about not being overly concentrated. I think my colleagues this morning actually mentioned the Singapore REIT market. Okay, and when we think of dividends, I think everyone in Singapore tends to think of Singapore REITs, right? That 4.5% yield. And we've given you quite a lot of reasons why the Singapore REIT market could be poised for some uncertainty and maybe a bit of weakness going forward, especially with higher interest rates. So I think one of the things you all should go have a look at today is, how much of your portfolio is concentrated in some of these sectors? Because sometimes we are blinded to that over-concentration purely because we want the yield. I mean, we all love yields, right? So, yeah, it is possible. And we have also seen many clients in that camp where, it's not just half the portfolio, but it looks like 80-90% of the portfolio is actually in Singapore REITs. Okay, so that's a huge concentration risk that we think could be problematic. The third point, I think we heard from fund managers this morning, it's not just the dividend that matters, but actually it's the growth rate of the dividend. Okay, those of you who like the science behind the dividend growth model, you know that the formula inside there doesn't just have a dividend number or a dividend amount. There's this important number called the growth rate of dividends. And that actually determines the right stock price for a particular company. Okay, that growth cannot be understated because the fundamental reason why you buy stocks is because of earnings growth. Okay, so I'm probably going to say this outright. If you find a stock that has no growth potential but a high dividend yield, that raises a lot of red flags. Do you actually want to own that stock? Okay. And the fourth point is don't worry too much about payouts. It's important to be allocated to the right instruments, having the right asset allocation in your portfolio, and worry less about the payouts that come from funds. Okay, those of you who are looking for a regular payout, we can actually do that. We have this thing called a regular drawdown feature that works a bit like a reverse RSP. Okay, so speak to our advisors outside. If you want to find out more. Okay, next slide, please. I just want to end off because we've been talking a lot about interest rates and what you can do. And I think when we speak to clients, one of the aspects or conversations we have is inflation hedges. Okay, so in recent times, people talk about gold, commodities, they talk about real estate. Okay, and more recently, they talk about things like cryptocurrencies as an inflation hedge. I'm not sure why. Okay. But I just want to leave you with some key takeaways from 1960 to the year 2021. Okay, inflation in the US, high and low, on average was about 3.8% a year. Okay, something over 60 years. Okay, the S&P 500 or the US companies actually grew their earnings by 6.9% a year. So that's 3% faster than the rate of inflation. So what that means is these companies actually not just overcame inflation, but they managed to grow faster than inflation. And when you buy the stock market, you're actually capturing that kind of growth, and you're going to get a return that's aligned with earnings growth plus that dividend yield, and that gave you that 10% or 10.5% a year, okay, over that period. So I can think of fewer things that are structured to help you defend against inflation. And I think we do commit quite a lot of research and the thinking on where the best stock ideas are, the best stock markets, what to overweight and what not to. But yeah, I just want to leave you with that last point that stocks are actually a pretty good inflation hedge, with or without healthy dividends. Okay, so with that, I'll thank you for your time, and I'll pass the time back to the MC. Thanks.
Thank you, Terence. We have talked about this a lot. Rising inflation begets higher interest rates, which means higher mortgage rates are soon to come. In this next presentation, Isaac Tan Guan San, Senior Investment Advisor at iFAST Global Markets Singapore, will share some tips as to how you can defend against the coming rise in mortgage rates.
Test. Okay, can everyone hear me? Okay, good afternoon everyone, I'm Isaac. So today I'm going to talk a bit about interest rates affecting our mortgage. So we have a lot of speakers earlier talking about how interest rate will impact our investments, but interest rate is something that will affect our mortgage rate as well. Okay, so let's take a look. Next slide, please. Okay, so in my presentation, I will briefly touch on housing prices, what are the type of mortgages around, how are mortgages constructed, and a little bit of pulse check and some key takeaway. So before I move forward, right, can I just have a quick check with everyone? How many of us here today has recently bought a new home over the last 3 years, or know somebody who bought a new home over the last 3 years? Raise of hands. Wow, a lot of hands, huh? Okay, so next slide, please. Okay, so let's take a quick look. This is the property price index of Singapore property over the last 3 years, and you can see how much the prices has gone. Okay, so when you buy a new property, what is one thing that will definitely cross our mind? Okay, unless you are super cash rich, you buy a property in full cash, you'll likely go for a mortgage loan. All right? Next slide, please. Okay, so what is a mortgage loan? Okay, I'm sure every one of us here are quite familiar. So to put it simply is when you purchase a house, you are pledging your house to the bank as a secured collateral, and in return, the bank will lend you some money to purchase that house. Okay, and the risk for the bank for lending you a mortgage loan basically is you are collateralized. So in the event that we cannot pay, the bank will just let it go at a fire sale, take back the proceeds, and close up the credit. So that's a mortgage loan. And there's generally two types of mortgage loan available. The first one would be fixed rate loans and floating rate loans. What are the key differences? As the name suggests, a floating rate loan is a loan that will float its interest rate as accordance to the market rates, like the interest rate that we are seeing today. And the fixed rate loans are fixed for maybe 2 years, 3 years, depending on the market condition as well. So one is floating, one is fixed. Pretty straightforward. Next slide, please. Okay, what happened to most homeowners? What do they do when the mortgage interest rate get too high? Okay, they do this thing called repricing or refinancing. Okay, anyone here has done some repricing, refinancing before on your housing loan, mortgage rate to bring down interest? Okay, I see some hands coming up. So, is that the solution to high interest rate on our mortgages? Okay, something to think about. But before we go into that, let's take a deeper look on how the bank construct mortgage loan. Next slide, please. Okay, so mortgage loans are always constructed based on the current interest rate environment. So if we are in a high interest rate environment, naturally the mortgage loan will be high. When we are in a low interest rate environment, just like the past many years that we've seen, mortgage rate will be very low. Okay, so typically, let's say a fixed rate mortgage loan, usually is fixed for 2 years or 3 years, and it comes slightly higher than your floating rate loans. Okay, and after the 2 or 3 years, usually there's a lock-in as well for your mortgage. So after the 2 or 3 years, what happens? Okay, the bank actually has the ability to adjust your interest rate with advance notice, right? So is that really a fixed rate? If you look at a longer term perspective, right, your fixed rate loan is actually also a floating rate loans, subjected to the bank changes, right? So the next type of rate is floating rate. Okay, this floating rate is very interesting. There's 2 key components inside a floating rate loan. The first one will be a market determined rate, which is something like SIBOR rates, SORA rates, or fixed deposit rate. That is market determined. We cannot control one. It's depending on market. And the second component to a floating rate loan is the spread, which is known as the commission to the bank. Now, when we hold a certain mortgage loan over a long period of time, there's a small step up every year. 0.1, 0.2, every year, the longer you hold, the spread get higher. So when we do a repricing, what happens? We are actually doing a reset on the spread component of this housing loan. The market determined rate is still running as per market rate. So we cannot change that. So to highlight this, right, repricing is not the answer to high interest rate in our mortgage loan. So do take note. Why am I highlighting this? Because if any one of us here today in this afternoon, if you are thinking about purchasing an investment property, you may want to hold that thought. Okay, I'm not saying cannot buy. Hold that thought. Just to know what's going to happen in the coming year so that we are better prepared to see if that's really a sound decision that we want to go for. Okay, next slide, please. Okay, and in current increasing interest rate environment, right, we will likely see 5% on mortgage loan, all right? And by the end of this year, the Fed rate is targeting around 3.25 to 3.75 in interest rate. Adding on the spread component in the housing loan, you may potentially see 4%, 4 plus, by the end of this year. Okay, so what happens to our mortgage loan when it hit 5%? Let's take a quick look. Next slide, please. Okay, I want to show an example, reality check. Okay, when it happens, are we still comfortable? First example, let's say we have an 800,000 mortgage loan at 1.5 interest rate current level. Okay, we are paying around 3,200 per month over a period of 25 years. Okay, and when interest rate increase to 5%, your 3,200 will become 4,650. That is a $1,000 plus increase per month. Is that still comfortable for us? If we are thinking of purchasing a property for investment, right? This is something we need to cater in. In a year, it's $17,400. So you can do a lot of things with $17,000 a year. You can buy a nice watch, buy a handbag, take your family, go holiday, and this is the additional interest we need to pay on the increase on interest rates. All right? So do take note of that. Next slide, please. Okay, on this slide, I want to talk about pulse check. Okay, for those of us who currently have an ongoing housing loan, okay, we may want to spend some time to look at the contracts of our mortgages to understand how much are we paying now. All all right? Because the current interest rate maybe is 1+%. How much are we paying now? How much will we be paying when it's 5%? All right, so you want to know the differences in that so that you can plan your finances better. Okay, if you know how to see your housing mortgage contract, right, please take a look so that we want you to start planning for it before it happens. It's gonna come, okay? So if you can make sense of the numbers, you know how to read the contracts, that's great, take a look. If you can't, speak to someone who can. All right, so there's a lot of advisors here with us this afternoon, speak to them. Okay, look for someone with a black bus like this outside, walking around in the room, we have a lot of us here. Speak to them, okay, and then let's try to make sense of what this means to you. Next slide, please. Okay, so before I end off, I have some key takeaway for 3 groups of people. So what are these 3 groups of people? Okay, people who are looking to purchase an investment property for the purpose of investment. Second group of people will be newlyweds. Okay, if you belong to that category, a huge congratulations to you. You know, moving on to the next phase in life, this is something you cannot miss, you have to do it. But I'll be sharing something more for you to consider. And the last category will be existing people with existing mortgage loan. All right? So let's look at the first part, the people who are looking to invest. The key thing to think about is, of course, is your money better placed into a new purchase of property, or you can put it into some other investment that is shared throughout the whole morning. So let's look at an example. First-time homeowner. Okay, let's say I have a friend, father very rich, you know, have a house, and then he want to invest a property with his own money. First-time homeowner, look at the cost involved. Your buyer stamp duty on a 1 million property is around 24,600 plus your agent fee, 1%. That's 3.46% for your entry to own a property, excluding all other costs. Renovation, furniture, appliances, property tax, legal fees, all those are excluded in this. So it's potentially 5%, 6% just to own a property. And for the second type of person who are existing homeowner, buying a $1 million property, your cost to entry is 20%. You just buy already, you lose 20%. You need to pay uncle, akong. Must give akong 20% on that. So is that a investment that you want to put in and pay tax for it, 20% down, and see where things go? All right? And it's also illiquid. So including all the costs involved in the second property, right, you are down 25% upon entry. Okay, and then what if your tenant not around, never pay rent? Problem again. So is this the best option? I'm not saying it's no good, but think again, what are the other options? Right? There are many things that can do, passive income, capital gains, things like that. Speak to your advisor. Next slide, please. Okay, so the next group of people are newlyweds, homeowners for own stay. This one, you can't help it. When you get married, you need your own house. But the key thing that perhaps you want to put some thoughts into is when you purchase a property, the valuation that you are looking at and the housing loan size you are looking at, you need to plan in terms of where the numbers will be, which is 5%, and not plan based on the number today, 1.5. Because the difference in monthly payment can be, I don't know, $1,000. So you want to plan forward to make sure you are comfortable. Okay? So this is just something for us to think about, newlyweds, people who are starting to move on to the next phase in life. So plan together, because having financial issues in a marriage is not fun. Okay? So it's not fun. Okay, next slide, please. Okay, so existing homeowner with an ongoing mortgage loan. So for this group of people, you already own your property, don't be in a rush to sell, that's okay. But take a look at your mortgage, loan, packages, finance, and things like that. Really take a good look at it. If you can make sense of it, great. If not, look for someone who can. right? Look for someone who can help you with it and see if the number is still comfortable for you. Okay, but there are certain things that is limited, like let's say we need to cut back on our lifestyle. How much can we cut back? I can cut back, maybe I drink 2 coffee instead of 5 coffee a week. Then maybe instead of going overseas in Europe, I go Asia. Instead of 4 times, I go 2 times. There's a limit to how much we can cut, right? And the next one is perhaps you may want to see if there's anything we can do to our housing loan. Okay? What do I mean by that? This doesn't apply to everyone. It depends on the terms and conditions in your housing contract. So we need to take a look before we can advise. Maybe we can look at extending the tenure to bring down the monthly payment to make sure our cash flow is comfortable. But that being said, if you extend the tenure, you're paying more interest. But then it beats losing a house because of cash flow problem. Okay, talk to someone. And the last one is for those of us who happen to have some money, CPF, cash, consider making a partial payment. Your CPF give you 2.5%. Housing loan 5%. Okay lah, pay off lah. Bring down the loan obligation a little bit. Free yourself out with some cash flow. And don't overextend ourselves. So this is something that if you ask agent, good time to buy or confirm, yes. Good time to buy property, going to 5%, no problem, sure can. Because they need you to buy. Then they have commission ma. Yeah, we are not in that line, but we want to advise on very real financial situation where you must think about. Okay, so that spells the end of my presentation. I hope this help everyone here put some thoughts into it, or if you know someone who are owning a housing loan, speak to them to speak to someone. Right? That's all. Thank you very much.
Thank you, Isaac. As we move to our next presentation, here's a little question for you. Is there ever a free lunch in investing? Our next speaker, Ko Yang-zhi, Team Director of the Investment Advisory Team at iFAST Global Markets Singapore, will share a scientific way in which you can improve your odds of success when investing. Over to you, Yang-zhi.
Thank you. It feels great to finally be back at a live event, seeing all of you. I hope you are enjoying the energy here. So for today, I'll be sharing with you all this thing called the free lunch strategy, a scientific way to improve your odds of success. But don't be fooled by this title, because it's actually not as complex as it seems. I believe a lot of you would have already heard of this phrase, right? That diversification is the only free lunch in this world. But I find that there is a certain problem that is happening, right? That how come, everybody enjoys free things and everything, but when it comes to investing, everybody knows that diversification is the only free lunch. And, in several different, whether is it analysts or presentations or articles that you read, they always talk about diversification, yet investors are not keen to, enjoy this free lunch, right? So for today, my job is not to throw you with a lot of data about the benefits of diversification, because I believe you have seen a lot of that in the earlier part of the day. In the next 15 minutes, what I hope to achieve is to encourage more people to eat this free lunch, okay? Sorry, back one slide. So a little introduction about myself. So I am an active stock investor myself. Currently, I'm managing 40 million of assets under advisory across different asset classes: stocks, bonds, unit trusts, ETFs. Okay, and together with me, it's a very brilliant team of advisors. So we serve clients, investors like yourself, across different strategies. So on the screen, you'll see 4 key strategies that we deploy: the growth strategy, which focuses more on growth-oriented stocks, right? Boring portfolio that focuses more on consistent, if you like Warren Buffett style. Trend following, which is more of a trading kind of strategy. And lastly, the free lunch portfolio. So today I'll be sharing with you all why this free lunch is something that you all should be eating and considering. Okay, next slide, please. Right, so here's the agenda for today. Very quickly, firstly, how risk affects your returns. Secondly, how to claim this free lunch. And thirdly, how to amplify your expected returns. So how risk affects your returns, right? This seems like a very simple statement or maybe a bit complex, like what does it even mean, right? So when I speak to a lot of my friends, they actually say that, why should we diversify? Warren Buffett says that diversification is the insurance against ignorance. But I'm not ignorant, right? I want to buy into a sector, I do my research, I'll get something that gives me the highest returns, right? So, but when someone buys a particular sector or particular stock, what they are seeing is the potential upside of it. But a lot of times, they do not consider things like risk. So I believe you will see, and you would have heard of a phrase, high risk, high returns. Do you all think that investing high risk equals to high returns? Do you all think so? Right? So all my life, my earlier adulthood, right, I was under the impression that, you have to take risks for high returns. So what I'm about to do, right, is to demonstrate to you all in a simple simulation that high risk may be low returns, where low risk can actually give you high returns, right? To set the parameters right, okay, I define risk by the probability of a permanent loss. So if you're buying into a stock that says it goes up from $1 to $10, back to 50 cents, and then to 20 cents, it goes on a roller coaster ride, that is not risk, okay? That is volatility. Risk is defined by the probability of permanent loss, meaning that, for example, if you had bought into an asset class or a stock that went bankrupt, or even, the more commonly known thing like you've bought into a Luna coin, yeah. So it goes down and, it never comes back up. That's a permanent loss. Okay, next slide, please. Right, so let's try something fun over here, okay, to demonstrate this point, to illustrate this point. In this hypothetical situation, okay, there are 3 different investors. I don't know which of it is you, but 3 different investors, right? And their job is to invest $100 in the stock market for 100 trading days. Okay, so on the left most, you see this guy that is a bit gloomy, a bit glum, and all, right? We call him the average investor, the boring guy, okay? So he focuses on strategies that are, very diversified, but, nothing really fancy about it. So in this hypothetical situation, he wins 1 out of every 2 days, right? So for every win, his portfolio makes a return of 10%. For every loss, his portfolio goes down by 8%. Okay, so that's the boring investor. And in the middle, you see this other lady that is a little bit more confident, right, in her blazer, just like a lot of the speakers here, very confident, right? So she's a very strong stock picker, and she's right quite often, 1 out of every 3 times. Okay, so for every time that she wins, every time she's right, out of these 100 trading days, every time that she's right, the portfolio goes up by 75%. So she's not only a good stock picker, she can pick stocks that go up really fast, right? And for every day that, the stock goes down, that she's not correct, the portfolio goes down by 25%, right? So that's the strong stock picker. And in the last category, we have this lady that is giving a very wide smile, okay? We call her the stock guru. Basically, she's an investor in stock T, maybe, some particular stock that made a lot of money, right? And her philosophy is go big or go home, right? She believes in high risk, high reward. And she's pretty good with stock picking because she wins 1 out of every 4 days. Which means that if you're going to find the next multi-bagger, actually, if 1 out of 4 is a very good probability already. So assuming she wins 1 out of every 4 days, for every day that she wins, her portfolio goes up by 400%. Meaning that for every $100 you put in, the second day it becomes $500. And then for every day that she's wrong, it goes down by 50%. So now, right, we will have seen these types of investors across our lives. It could be ourselves, it could be our friends and family and everything. So in this hypothetical simulation, who do you all think will come out on top? Is it the boring investor, the strong stock picker, or the stock guru? Okay, so we're about to find out. Next slide, please. So I did a simulation over here using very simple Excel to calculate based on the probabilities and the numbers who is going to win, right? So if you are the boring investor, I highlighted two rows in yellow. If you are the boring investor and you look to your left and to your right, the strong stock picker and the stock guru, right, you will be very discouraged because you would see that on the 5th day, I only made $12. The strong stock picker made $29. And the stock guru tripled her portfolio. So at this point in time, I might be doubting myself, like, you know, maybe I'm wrong. You know, diversification isn't the way. Maybe, you know, I should be a bit more aggressive. And then it doesn't help that on the 13th day, even though, you know, there's volatility up and down, the other two are still outperforming me. Right, next slide, please. But if I run a simulation for 100 days, so I believe that all of you seated over here, when you invest, you don't invest for just like 1 year and then you say, okay, I'm just going to invest for 1 year and stop, right? The truth is that once you start investing, you're going to invest for a pretty long time, right? So after 100 days, this is the result, right? Surprise, or no surprise actually. The winner is actually the boring guy, okay? So by the 100th day, his portfolio would have grown to $181.56. For the lady in the center, her portfolio would be worth $104.07. And for the stock guru, actually, by the 100th day, it would be $0, right? So if any of you are interested in this Excel sheet, right, and you know, you say, these numbers, it cannot be right, you can feel free to look for me, give me your email, I'll send it over to you, okay? So what is my point over here, right? What is my point over here? A lot of times we try to chase high returns and all, but in this simulation, your numbers don't lie. So which is more important? Is it more important as an investor for us to chase higher returns, very sky-high returns, or is it more important for us as investors to try to aim for higher odds of winning? That means creating a strategy that gives you the highest odds of winning. And I think through this simulation, the answer is quite obvious that not necessarily, you know, getting sky-high returns like the stock guru may not always pan out well. Right? What is more important is that you need a strategy that can deliver you the highest odds of winning, right? To put odds in your favor. Okay, next slide, please. So now, then you'll be asking me that, so how you know, Yang Zhi, how should I do it, right? Should I be, how to put odds in my favor? Should I be researching more? Should I, you know, attend more of these events and, you know, find out what are views of analysts, what are views of these people, and then I place my bets there because they know better than me, right? So I have one bad news and one good news for you, okay? The bad news is this, is that the market doesn't care about how much time you spend in research, right? If the market wants to go up, it goes up. When the market wants to go down, it goes down. It doesn't matter how much time you spend researching, how much you understand about this, right? Because we basically have no influence over what's happening in the external world, right? So more effort does not mean better results, right? So in fact, it is not uncommon even in the professional world, the big boys or even professional money managers to not be able to outperform the market despite their best efforts, right? So it's not just us as retail investors, right? So it's not easy. I'm not saying it's not impossible, but it's not easy. So, but that's the bad news, right? So what's the good news? The good news is this, is that nobody said that investing is about outperforming the market, right? You don't have to outperform the market to get a very good return. So this is the good news, is that, you know, if you cannot beat them, why don't you join them? So instead of trying to beat the market, what you can do is that you buy the market, right? You don't have to. So what do I mean by buying the market is basically what a lot of the colleagues of mine earlier has reiterated. Basically build a globally diversified portfolio. The free lunch is standing in front of all of us, but we are just not eating it. You know, in 2020, when I asked people about building globally diversified portfolios, in 2018, they were saying that, no, I think China is going to be good, right? I'm going to buy China. Then in 2020, I asked them, no, you see, you know, China's having some trouble. How about you buy globally diversified portfolio? You know, it's a free lunch. And then they will say, no, 2020, I want to buy tech. I want to buy disruptive innovation, right? And then, yeah, it went up, right? Then after that, in 2021, 2022, market came down. I go back to the same group of friends. They are still looking for opportunities. But is it really that hard, right? You don't really have to spend so much time to identify what kind of opportunities, how to outperform and everything, if you simply just buy the market. Right, next slide, please. Right, so here's an example of a globally diversified strategy. This is obviously a bit simplified, but the idea here is that we want to build a strategy. Today, if you're investing, you want to build a strategy that gives you the highest probability of success, right? And one of the ways is to do global diversification through the investments that you buy, right? So this chart that you see over here is, it replicates the performance of this index called MSCI World. So literally, if you just buy one ETF like this, right, what's going to happen is that you are buying thousands of companies, the thousands of the biggest companies around the world, right? And over the 10 years, you have gotten a 130% return, which is a compounded annual growth rate of 8.68%, right? Nobody said anything about outperforming or giving you 20, 30, 40, 50% returns, but it gives you this power of compounding, right? Yeah, next slide, please. Of course, that being said, you know, today is about free lunch, right? Free lunch means that you come here, you eat, and then it's free. You don't really have to put in so much effort or do a lot of stuff, right? So how global diversification alone is not enough for free lunch, because if you look in this chart, right, it just shows you the last 40 years. But over the last 100 years, there are a lot of things that happen in the world. And the truth is that a lot of these things, despite our best intentions and efforts, we cannot avoid them. So take a look back in history, right? In 2001, there was a dot-com bubble that burst, dot-com crisis, and then there was the September 11. 2008, there was a global financial crisis. 2020, there was the COVID crisis, and recently we are struggling with inflation and interest rates, right? And everybody's talking about stagflation. Nobody wanted it to happen, but eventually it still happened, right? So even a globally diversified portfolio will fall during such a time, right? And even a portfolio like that can go down by as much as 35%, right? So today, if you want to have a free lunch, right, what you need to do is a combination of two ingredients. The first one is global diversification, and the second key factor is actually time in the market. Right, so at this point in time, you might be asking me, time in the market, right? How long is time in the market? What is time in the market? I always hear about time in the market, but what is time in the market, right? So if you ask, you know, somebody ever ask, like, you know, Warren Buffett, what's your favorite holding period? He would say that my favorite holding period is forever, right? But I mean, if I'm a retail investor and I hear that, I was like, what? Forever, right? But if you ask me, right, I would say that a very practical way of approaching it is that you would need at least minimum 2 years in a globally diversified portfolio. And the reason I'm saying this is because over the last 100 years of the stock market, right, the average recession lasts about 11 months. And the average bear market, which we are currently in, lasts 9.6 months. That's the average of it, right? So a lot of times, investors tend to, you know, overweight and think very highly of our own research and our own views. And we tend to underestimate this thing called luck, right? I'm not saying that we should, you know, invest based on luck, but we can be investing in a very good strategy during a very unlucky time. For example, if I bought today and then tomorrow the market crashes, Russia decides to go to war, these are things that I cannot control, right? So with that, you need some time in the market to give you some margin of safety, and a minimum of 2 years would be something that is reasonable. Okay. Next slide, please. So knowing that, that forms the baseline of your free lunch. But if you wish to amplify expected returns in a more strategic and more rule-based way, what you can do is have a look at what are some of the factors that actually outperform the market consistently over the past 10 to 20 years, right? So meaning to say that, let's say today if I invest in a certain companies, why are some companies growing faster than others? Why are some sectors more profitable than others? So in a research seen over there by Dimensional Fund Advisors, So they found that there were 3 factors that meaningfully outperformed the benchmarks, right? Which is size, value, and profitability. Size meaning that you're buying small companies. When small companies become big companies, you make an outsized profit. Value meaning that you buy something that is obviously not too expensive, at fair value or cheaper, right? And profitably means that buying into companies or sectors that earn more than its peers, have more earnings power, higher profit margins than its peers, right? So these are factors that manage to outperform. So after building your globally diversified portfolio, what you can do to amplify these returns is just add a little tilt to this portfolio, and you can actually enjoy a free lunch with slightly amplified expected returns. Okay, so next slide, please. So this is my last slide already. There's a lot more that I wish I could share with all of you all. But I'll leave you with this, okay? So if you are investing for excitement, you will get excitement, right? You will track the stock market, you look at things like that, you'll get excitement. But you'll not necessarily make money, like what we've seen in the Stock Guru. If today you are here to make money, then we should start strategizing and thinking about what gives you the best probability of success. We need to be like the boring investor, boring guy, right? So I hope that after this, more and more of you will start thinking about eating this free lunch that is right in front of you, okay? So I'll leave you with this. Your free lunch equals to global diversification combined with time in the market, okay? Thank you very much. Have a great afternoon.
Thank you, Yang Zhi. In the next segment, Stanley Ong, Team Director of the Investment Advisory Team at iFAST Global Markets Singapore, will share with us the 3 biggest mistakes stock investors make. Please welcome Stanley.
Hello and good afternoon to each and everyone. Thanks all for coming. First of all, I'd just like to ask a quick question to each and everyone in the audience here and also to our Zoom friends also. Can I ask a quick question? Who has bought stocks before? Okay, very good. Almost all. Who has also, keep your hands there, who has also bought bonds before? Okay, we have some, Good, thank you very much. Who has bought ETFs and funds before? Fantastic, you're in the right room right now. Today, I'd like to thank each and everyone for dropping by because you are on a quest for knowledge today. And what I want to share with you is actually some of my mistakes. It's not easy to stand on stage sharing with you some of the mistakes that we have, but I think it's something that I hope that we can all learn and reflect from it. Moving on to the next slide. Right, so my agenda basically is very simple. How to aspire to be a successful investor. And in order to be a successful investor, sometimes my friends tell me it's just like fighting a war. What do I mean by fighting a war? Because you have to employ the best strategies and tactics, be it growth investing, value investing, factor investing. But at the same time, besides fighting and attacking aggressively, would you also agree with me that it's also important to know how to defend? Okay, because you need to keep your money. You need to save your troops also. And also, in order to be a successful investor, we will also need to know what are the more important mistakes that we potentially might have made. So when I go through with you some of the mistakes, I need your help. Is it something similar? Because if we keep repeating the same mistakes over and over again, we realize we might not have actually learned the lesson, and the mistakes will come back again. And one of the mistakes that I'd like to share with you is buying high, selling low. I'll be happy to share with you from a personal point of view, okay? Trying to time the market, having potentially unrealistic expectation of the market, and if time permits, maybe one bonus. Next slide, please. This is one of the greatest secrets to becoming a successful investor is actually to avoid simple mistakes in life. This is not a Singapore chart, fortunately. Now, if you look at the chart closely, you realize that the average retail investor, sources are from JP Morgan, would only have made 1.9%. And this is during the period from 1999 to 2018. But what's very interesting is on the left-hand side, you can see the REITs are doing fantastically okay, 9.9%, perhaps gold, 7.7%, oil. Of course, the time frame is important because the time frame is from 1999 to 2018. But the question on my mind is, why is the average investor only making 1.9%? It all starts with accepting a simple truth. Most investors not here, not in the Zoom, they don't perform well in the stock market. And take this with a pinch of salt, because for us Singaporeans, by keeping our money in an ordinary account, we have already made 2.5%. By putting our money in the special account, it's already 4% already. So let's move on to the next slide. I'm going to go through some of the important points. For example, not paying enough attention to the asset allocation. Okay, this is one potential mistake that perhaps some of us might have made. All right. The other important point is perhaps trying to time the market. How nice if ideally we will know that tomorrow is the market top. We will just sell it at the top. Then after we sell at the top, maybe we short the market a little bit. And then wait for it to come down all the way and start scoping all the way up. If anyone knows, please come and see me. I'd love to learn from you also. I'm still learning along the way. The other point is perhaps having too much money in a significant investment. For example, sometimes I just fall in love with a particular stock. I like the CEO, he's good, he's my idol, and then perhaps I put a little bit more than I put because he's good, so on and so forth. And perhaps another mistake might be holding on to a particular investment for a little bit longer than most, right? Okay, so bear in mind that stocks, we don't fall in love with our stocks, right? Basically, if the stock has made the desired position or the desired profit, then we move on in life. We take our profits, let's move on. Okay, so I've gone through with this. Now, can I have a show of hands? Who has made all these 5 mistakes in life? Okay, thank you. Thank you for your honesty. Who has made only 4 mistakes only? 4 mistakes out of this. Who has made 3 mistakes? Lesser. Who has jumped? Who has not made any mistakes at all? Okay, yours truly, I have done more than 6 mistakes. So sometimes I reflect, especially these few months, I start reflecting. Why did I make these mistakes? Okay, is there any way that I can do to improve it? All right, so it's very important to know the mistake so that we can take a step back and reflect. How can we stop these mistakes from happening again? Let's move on to the next slide. This perhaps might be very familiar to you, buying high and selling low. How do we make money in the stock market? Or how do we make money in the market? Buy low, sell? Buy low, sell? Fantastic. The second way to make money in the stock market, buy high, sell? Wow, you guys are fantastic, man. Then how come we end up buying high and selling low? Okay, so it's very interesting. Let's move on to the next slide, all right? This is, most of us sometimes might fall into the trap. We do the opposite. And I'm speaking from the heart because when the markets do take a tumble, I look at my stock portfolio, wow, all red leh. Got green there. Why don't I just sell off the green one, then plow it back, okay? So that's something that you might want to look into and see whether it's correct or not. Most importantly, you must have a system. Let's move on to the next slide. This is a busy slide. I'm going to spend a couple of minutes sharing with you what you see over here in the year 2000 on the top left-hand side of the slide. Do you know what happened in 2000? .com bubble burst, tech crisis, sounds familiar? Okay, so at least you know what's happened in the year 2000. How about 2008 on the bottom left-hand side? What happened in 2008? SARS? Financial crisis? Anybody says Lehman or Brothers? Okay, so at least you have this in mind. So what happened is that in the year 2000, $262 billion piled straight into equities and stock funds. $262 billion. And on the right-hand side, which is the blue one, it seems to me like $50 billion outflow from the bond markets. Okay? Now, what happened actually? The subsequent returns in 2001, the stock market actually went down in terms of the S&P, maybe down by 12%. All right? And 2002, the stock market also went down a further 22%. Okay, so those who power into it, maybe they might have gotten a bit disheartened. But what happened in the year 2002? Let's have a look again. The subsequent returns for the S&P was close to 28.68%. And in 2004, it went up by another 10+%. But very interestingly, what did the investors do? Negative 29 billion outflow from the stock market. And then what happened? 140 billion went to the bond market. How come? Why? What happened? Okay, and in 2008, no need to say so much lah. Lehman Brothers crisis, 88 billion moved out, but in 2009, the subsequent returns from the stocks was 26.47%. Let's move on to the next slide. Okay, and some more, and all right, fantastic. So basically what I'm trying to share with you is this actually real happened. It happened before, and it will keep on happening again and again. So where are we now in this market? What's happening to our market right now? Is the story the same? It's the same story that happens again and again. The problem is the actors are different. For year 2000, who was your actor? Mr. Technology. In the year 2008, who was the actor? Not Tom Cruise, but actually Lehman Brothers. This year, could it be inflation or could it be interest rates? The story will keep repeating itself again and again. All right, let's move on to the next slide and let's have a look. The next point that I want to share with you is trying to time the market. I guess in a nutshell, this really depends on your personality. All right, you have to understand your personality. Is your personality somewhat like a trader? Okay, if you are a trader, then most probably you have to keep on looking at the screen, set your stop loss tightly, and so on and so forth. But if you're like me, I don't have so much time, or rather, I like to spend time with my family, my friends, and my colleagues, and then perhaps I would want to take a little bit long term in that sense. So do take note, it's not easy to time the market. Many times, we just sell off at a 10-20% profit, and we miss out on the bigger gains 1 year, 2 years later. Possible. That actually happened to me, because very happy to take a profit. In 4 days, 5 days, 1 month, make profit already, only to see it move up. The opposite is also true also, because today I buy a stock, then the next day the investment forecast say, hey, no good leh. Then I sell off already. So the question is, identify yourself. The neighbor next door to you might be a different profile from you. Yes, he might be a trader, high frequency trader perhaps. For you, you might be more like Warren Buffett, perhaps also. So different strokes for different folks. Okay, let's move on. I like this slide a lot. So if you have the time, you might want to take this picture of the next slide that shows what drives stock returns in the long run. So, in 1 day, what actually drives stocks return? It could be computer algorithm. Because in 1 day, does the business really make money or not? It doesn't really matter much, right? In that sense, in driving the stock prices. In 1 quarter, it could be perhaps of analyst ratings. Okay, that might move the market. But in the 1 year, okay, iFAST has lots of research reports. It talks to you about valuations. 5 years is most probably profit growth. 10 years is returns on your capital. And most importantly, for the long term, 20 years is people and culture. That's why you guys are here with us in iFAST, right or not? So every time when I see the market down, I look at this chart, which I photocopy in color on my computer screen. And then I tell myself to focus on the basic stuff. Moving on to the next slide. Okay, so next slide, please. Having unrealistic expectations. Let me read to you this quote that I kind of like it. The average investor only wants one thing, which is the right stock pick, the one that will go up forever and start earning immediately. For me, Stanley Ong, I only want one thing. Pick the right stock, yesterday start making money already. But unfortunately, it doesn't work. Okay, so if you play the game on the stock market terms, you're likely to make a lot of money over the long run. But if you try to bend the stock market to move it your way, you want it fast, you want it furious, then I'm afraid I have one word of suggestion for you, which is to play the patience game. And why do I say that? Because we need to ask ourselves these questions. Are we vegetable farmers? Do we plant vegetables? No, perhaps. Plant vegetables, good one. Every 3 weeks can eat a tauge already. Or are we actually planting fruit trees? There's a difference, because if you plant your vegetable very fast, you get your results. But then after 3 weeks, you got to plant again. You got to keep planting, you got to keep watering. But if you plant a Mao Sang Wang, wow, how many years does it take to plant a Mao Sang Wang? 15 years, sir. yesterday I heard from with my colleagues, we went to the Mao San Wang store. Wow, he said 5 to 7 years, don't know true or not. But what I'm trying to say that if you really want to plant a good fruit tree with perhaps dividends, then you have to have patience in the game. Let's move on. The next, perhaps bonus slide that I want to share with you is abandoning a good strategy too quickly. All of us have our own specific systems. You could be a momentum-driven, or you could be a valuation, or you could be a patient investor. Good strategies take time to play out. Even my wife also tell me, give birth also need 10 months. From start to inception. So I also remind myself on that. So there's no overnight guarantees. Value investing takes time. Sometimes undervalued stocks are out of favor. They might take some time to catch up. But as long as you have a system, you stick to it. Don't just jump. For example, if you study from Wu Tang Pai, then you just follow the Wu Tang Pai. If you study from Mei Pai, then you follow the Mei Pai. Don't today Mei Pai, Wu Tang Pai, then Shaolin Pai, then you 走火入魔. Confirm. Okay, let's move on to the next slide. Bonus slide. Holding winners for too long and holding losers for too long and actually selling winners too soon. How many of us might be guilty of this? Let me give you an example. Today, I only have 2 stocks. Okay, the first stock went down 25%. The second stock went up 25%. What will I do? Or what will you do? Those that is down 25%, wait, long-term, actually trading position, will then become long-term investor already. Those taking 25% went up in one day, sell off lah. Possible, potential, sounds familiar, right? Okay, so welcome to the 2 strongest emotions in life. And the 2 strongest emotions in life, in investing, is not love and hate, but rather fear and greed. Today, we are facing fear or greed. Look within yourself in your mirror tonight when you bathe, is fear or greed. How do you tackle that? Today cannot talk so much because only 2 minutes left already. So one of the solutions is to speak. Okay, maybe you don't have an advisor, that's fine. But if you have an advisor, maybe your wife, maybe people like us in iFAST, speak to my team, speak to our team. They might be able to work together with you to potentially look at changing certain horses in life. Because maybe your horse you're riding, like Terence said, the dividend play 5%, right for 10 years already, still never move. Okay, so perhaps we might be able to work together with you on this journey for wealth accumulation together. All right, so change the horses. All right, don't change us. Let's move on. Okay, this is to cut a long story short. Are you a diamond hand, or are your hands made of paper? You know, this picture, I got it from the, Bitcoin, diamond hands. Okay, so those diamond hands don't know whether change to paper. But once in a while, it's very important to speak to your partner. Because I think one of the most successful things is to get your spouse involved. Try to encourage them to understand where you're coming from. Try to get them to understand why you want to enter into a market like now. Why is there a crisis? Why are we able to pick up this opportunity? So I just want to end something by asking all of us this question. Who took action during the last crisis in 1997? 1997 Asian crisis. Who took action? As in took by. Okay, not many hands. Who took action in 2008? Buy. Who took action in COVID? 2 years ago. Fantastic. Okay, now all of you are here. It's your choice to decide whether to take action or not. But at least do something. Speak to your advisor. Because we don't want to wait for another 10 years. Then you say, wow, last time Stanley was here in 2022. I should have listened to all the speakers over here. I should have taken action. Now bo pian, got to wait for another 10 years. All right, so thank you very much for your time.
Thank you, Stanley, for your insights. Now, did you know that you can write your will to not only pass on your assets, but also your personal values in an ethical and sustainable way? In this upcoming segment, Bernard Chan, Team Director of the Investment Advisory Team at iFAST Global Markets Singapore, will tell us more. Bernard, please.
Thank you for giving me a chance to share more with all of you. And actually, what is estate planning? Because this topic is going to be about estate planning. Put it simply, is about how we split our funds when we are no longer around. My guess is some of you guys over here, including sometimes myself, I would say, Choi, 大家嚟試啊. We're going to talk about investment over here. We're going to talk about growing our money. Suddenly now, the last few topics talk about me going to pass on. Yeah, so it can be a taboo topic for many of us. But again, some of us actually specialize on this sector of finances. And it's really about estate planning. So I'm Bernard. I'm actually one of the director running estate planning. And I must say, this is an interesting department. Because this is one of the departments whereby actually there's 2 directors running it instead of 1. Okay, let me share with you more as I share with you, tell you the story behind there. Next. Because the topic is a little bit different, and I know some of you guys will be taking photos along the way. To help you with it, if you need some of the slides, just drop us an email. We will send the slides directly over to you. Okay? So let me share a small story with you before I even start. A few weeks back, I went for a holiday with my kids. And we went over to an amusement park. You know, the Universal Studio like that one. So we were on a roller coaster ride. And it was quite scary. It was really scary. And even some of the young people don't dare to go on top. But we saw an old auntie, yeah, she went up there. And then when the ride started, all of us, we were quiet because it was really scary. But she said, Chong ha! We were quite surprised. The old auntie, but she called Chong ha. Then when we left the ride and came down, I saw one young person actually ask her, Auntie, we all very scared there. But you were there, you chong all the way. Then she said, yeah lah, my husband is Ah Chong ma. I was very scared, so I keep calling for Ah Chong. Yeah, next slide. That is actually what is happening in the last many years. Next slide. I want to share with you about this part about Chong and about estate planning is because in our generation over here, I would see that most of us should be in our maybe late 30s, 40s, 50s, or even 60s. And actually, in the last many years, one of the market actually Chong all the way. And this is actually a chart from HDB about HDB prices. Next. If you have looked at that exponential rise over there, that was before the year 2013, which means that some, or if not many of us over here, you have bought a property before 2012, 2013, you will have experienced this exponential rise. And which also means that a lot of us over here may have a huge asset locked in our property. I give a very simple example. My parents bought a HDB in Bishan, a 3-room HDB. Yeah, that was many years back. Now I talk about the price, I also very shocked. They bought the HDB, 3-room HDB, for $37,000. To be exact, $37,700, 3-room HDB. When they sold it, that was approximately 3-4 years ago, they sold it at a price of approximately $400,000. From $37,000 to $400,000, that was the rise in property price. And this blue part that you see over here was what they actually experienced. And for my parents they are illiterate one. They never even finished primary school. But in their assets, eventually when they pass on, of course my dad has passed on already, they actually had 400,000+, and now actually even higher. Even though they are not professionals, they are not engineers, not doctors, but they have that level of assets. And that's what's happening to most of us over here, or if not all of us, is that you will be surprised at the point when you pass on or when you move on. Generally, as a Singaporean, you should have at least 500,000 of assets across over with you. And that's something very important. That means with this 500,000, how are you going to pass it on? It can be to a charitable group, to your next generation. And I was sharing something I was finding very interesting. We want our next generation to spend the money like the movie, Crazy Rich Asian, and maybe using the money to buy a sports car or buy a luxury item. I don't know. Some of us may, but most of us may not. And that will tell you how important it is to be looking at estate planning. Because over here, all of us most probably has a high level of assets. Next. I'm going to use a few case studies to share with you. This is a very famous case study in Singapore of this tour guide Yang Ying. And I'm actually still handling the case right now. with some of the key prosecution witness in this case. What he did was that he had this authority to manage the money of a lady called Miss Kathleen Chow. So in this case, there was an misuse of the funds. Reported was that 1.1 million was misused. Next. But in my discussion across with the prosecution witness and even the family, actually there were a lot more than that. This whole case lasted from the year 2006 all the way until he was actually prosecuted, approximately 2016. And I think the words might be a little bit too small, but to read out to some of you guys, some of the discussion with the friends was that, wow, this guy only in prison for 8 years, 1 million 1 year. This guy is really very rich already. And recently, of course, last month, he completed his jail sentence and he was thrown back over to China. And this is one very simple example. My understanding is, maybe some of you guys may be sharing that, Bernard, actually, I don't have that much money. I don't think I have 8 million for people to bluff, to cheat away. But let me show you, many of such cases are really happening. Next. Using other case studies to show you, some of you guys may be saying that, actually, Bernard, my way of estate planning is to have a joint account. Can be joint account with my husband, joint account with my wife, joint account with my child. But let me share a crossover with you that joint account as a method of estate planning is not foolproof. In fact, it has been disproved in court a few times. These two are actually case studies that we extracted from Straits Times, very recent, just 1 month plus. The one on the left that you see was about 6 siblings who fought over a HDB shop house. Take note, it's HDB, yeah. And actually, they won. They won the case, even though the shop house was owned by another siblings. And of course, the one on the right, where a joint owner did not inherit the house. I'm not going to go through in details over here. You can quickly Google about the case. And these two cases became a landmark case in estate planning in Singapore. So the last few months, for those of us who are legally trained, we discussed so much about this case, and we started to have a little bit of concerns about traditional methods like joint ownerships. Like including my grandparents or even my parents, sometimes they say, just add one name inside can already lah. A joint owner, okay already. I would share with you, no, it is not so. Next. Okay, let me show you what estate planning really is and why it is important for many, or if not all of us. Because I would think while we are healthy, we will grow old, we will have many years ahead, but eventually, I think all of us will pass on one. That one, correct, right? Yeah, I think all of us will pass on one. So some proper documents that has to be done, like having a will. That is important. Yeah, of course, some of you guys, if you have a little bit more assets, important to set up a trust. Yeah, but that is not absolute. There are other legal documents like ACP, required advanced care plans, or even having an advanced medical directive. This part about the advanced medical directive is something very interesting. My mom, she has had cancer twice, not 1 time, 2 times. Yeah, and actually the 2 times that she had cancer, the first round was a stage 3 colon cancer. The next round was just 6 months later, it recurred, and that was a stage 4 colon cancer. And in her advanced medical directives and her advanced care plan, she made it very clear. She said, I don't want chemotherapy, and I don't want radiation therapy. Yeah, that is actually a treatment plan. And that was also part of the estate planning that we did a crossover with her. So if any of you guys have a certain preference, I think it is important. You should state this down, either with your legal personnel or either with your family members. And that's what the whole advanced care plan and advanced medical directives are. Next. Okay, the interesting part is that is not all. I think legal documents are over there. You might be sharing that, you might be thinking, hey, legal document means you need to go and see a legal person, need to cost money. Let me share with you why all these legal documents are important. Because before we pass on, a lot of time, there will be a period whereby there's a medical issue. And this medical issue can last 3 years, 5 years, sometimes even longer. Of course, in our present cases, for families where I'm actually managing, working with, some of them can be a stroke issue. Post-stroke, They will have mental capacity issues, same like Miss Kathleen Chow that I mentioned just now as a case study. That is the point in time that someone still has to manage their investments and their assets across for them. And if a document is not being drawn up, what we need to do is that we need to go back to the subordinate court, the high court again, to draw such documents. And let me show you the very simple contrast. If a document is done, which is the LPA if it's done, normal cost in Singapore is around $150. It is very cheap and very affordable. But if an LPA is not done, and the opposite, which means that we need to go to court to apply for all these things, it should cost generally around $3,000 to $5,000. You see this huge contrast in pricing. Yeah, and a lot of time we can be medically incapacitated, and that's where all these documents are actually required. So my suggestion, get all these things done for yourself, whether with your family lawyer, with your legal personnel. Yeah, but what's also important is that all these are just documents. When we start to run estate planning, I don't have the time to run through all these full details across with you, but there are many occurrences whereby actions will be required. Like I wrote down here, there are a few phases of illness. It may not apply to us directly, but it may apply over to our own parents. Like example, the onset of chronic illness. That time still, like example, maybe cancer stage 1, chronic illness, or even diabetic situation, high blood pressure situation. Some actions need to be taken. Or if not, can be a critical illness diagnosis, or even a terminal illness diagnosis. And that's why we step in as an estate planning team to work across with the whole family. Yeah, I know this can be a little bit advanced, a little bit too fast across for all of you, but there are other information involved. Next. My encouragement across to all of us is that when we leave a certain portion of assets around for our next generations, my question to all of us is that, do we want to just pass them money and let them spend the money in any way that they want? Or maybe, for some, or if not many of us over here, we may have a certain wish and a passion across for our next of kin, like our children or even our grandchildren. And using one case study as an example for you, I've always been managing foundations. And in fact, last few days, another foundation wanted to start another bigger account across for the next generation. What they specifically, what they wanted was to maintain the family values. And what is the family value that they had? One important part was that they mentioned everything must be ethical. Whatever business they are doing cannot get into the illegal business. So I said, yes, that one very important. And second part, they mentioned that they want to focus on taking care of seniors, people who are slightly older. I said, yes. And their question back over to me as a foundation manager and as the investment manager was, Bernard, so these two ethical and take care of old people, so how are you going to do it? Wow, they are starting to quiz me. But using this real case and this portfolio as a simple example, we scrolled through on the list of available bond investments. We had to make sure some of the companies, or if not all the companies over here, are socially responsible, which means that there are different portfolios. For example, if there are casinos, we will not invest in casinos. If there are tobacco companies, we will not invest in tobacco companies. Or even companies that sells marijuana, or maybe sometimes they call it gaming situations, or even digital porn online. All those companies may earn money, but we're not going to invest in it. So that's the first part about ethics. The second part is how to make it sustainable and how to let it evolve through the time. I don't have time to share in full details, but this will be an example of a portfolio which is primarily property-based that yields around 3-4% or sometimes a little bit more. Next. To end off the whole session across with you, it is important to work with a team across for estate planning. I know some of you have teething questions. Yeah, normally after such a presentation hall, some will come to me and say, hey, Bernard, my friend has this situation. Okay, I know that it's your friend, or maybe it's your own family. We will be around. We know that some of you all have unique situations across. We work as a team of an estate planner. I'm actually investment trained, but because of really what I've gone through, I work in the embalming theatre with the patients when they pass on as well. And when we handle estates are not just your financial assets. Some of you guys over here may actually have art pieces. may actually have music as some of your investment musical instruments, a Steinway piano that you have emotions for. We want to manage that part of the art as well. Of course, moving towards in the next few months, we have a musical concert that's going on to commemorate some of of our clients that we are working with. Okay, so my team of, I think today Zen and me are around. We will be around here or outside as well. If there's any questions, come back over to us. Thank you, and we have the last slide. We know that estate planning can be a little bit unique, so if you need anything special, drop us an email, then we will follow up a crossover with you again. Thank you.
Thank you, Bernard. Up next, we have a fireside chat where our panelists will discuss the key factors in deciding what type of route to go for in your investment journey, DIY or assisted investing. To help us better understand the considerations, joining us in this session are Catherine Chua, Assistant Manager of the Investment Advisory Team at FSMOne Singapore, and Olivier Freipin, Director, Investment Advisory at iFAST Global Markets Singapore. Moderating this session is Wong Wei Yi, Director of Strategic Investments at iFAST Singapore. Let's welcome them up.
Hello? Hello? Okay, great. Good afternoon, everyone, and good afternoon, both panelists here as well. So today we are going to discuss quite an interesting topic, DIY versus assisted investing. How many of you here are actually DIY investors? Can I get a show of hands? Wow, that's quite a lot. So how many of you actually work with advisor? Okay, just a couple. Okay, that's great. So today we will learn more about both types of investing and see which one is actually more suitable for you. So let's start with Olivia. Olivia, you are 53 years old. You graduated from Boston College in America with a master's degree in finance. And you spent 5 years in Switzerland working in the field of finance. And since 2014, you've been in Singapore, providing financial advice to your clients. You recommend investors to take a long-term view with patience and discipline via the iFAST platform. Of course, this is also what you do exactly for your family. Can you share briefly with us, as a financial advisor, what do you do?
Thank you very much. I think it's very important to understand that a financial advisor needs to bring something to the table. When you use a financial advisor, you have to pay for that service. Therefore, it's very important that the financial advisor is going to add value. So I always tell my clients, if I don't add value, you should not be working with me. So financial advisors, they are going to have different type of things that they bring to the table. Some advisors will bring experience, others will bring knowledge, and some will bring motivation. For me, when I studied in America, I happened to teach finance classes. And I really enjoy teaching finance classes. So I think I am very much an advisor, but also a teacher, a professor. So I like to spend time with my clients to teach them what is a portfolio, what is asset allocation, what is performance and risk. So this is the type of financial advisor that I am, is yes, I bring experience, motivation, and some knowledge to my clients, but I think I'm very much a teacher.
Great. So you're a teacher, and of course, being an advisor, do you think it's, then in this case, you wouldn't think it's wrong for someone to actually try to do it themselves, right?
I think it's very important to understand that there is nothing wrong wanted to manage your portfolio by yourself. As a matter of fact, I often recommend the Phone Supermart platform because it's a great platform for someone who wants to do it alone. What I think it is important to remember is that we are trying over time to build what I called financial independence. We want to prepare for retirement. We want to prepare for later in life. And so it's very important that we have patience, discipline, and that we build passive income in order to be successful at reaching financial independence. So I think what is important to understand is that if you have a financial advisor and you're happy to bring this financial advisor on this journey towards financial independence, it's wonderful. If you want to do it alone and you are successful in building over time your financial independence, then that's also wonderful.
Right, great. I think John Paul will be very happy to hear that you actually recommend clients over. So over to Catherine. Catherine has been with FSMOne as an investment advisor for the past 5 years. Prior to this, you have worked as a banker at CIMB, providing investment solution to your clients. Can you share with us now what do you do as an IC?
Okay, so at FSMOne, I do investment advisory service. So unlike Olivia, whereby he has a group of clients' portfolio to monitor very closely, eyeball. For myself, me and my team, we are answering inquiry mostly based on reverse inquiry. So that means if investors do have questions about their portfolio and they just need a second look, they can actually contact us, or they have some questions about specific features of a bond, or like some unit trust or stocks, corporate action that they want to understand more, they could actually look for us. Yeah.
Okay, great. So in your case, because you guide investors how to do it on their own, do you think it is wrong or if someone wants to go and look for an advisor?
Yeah, I think my answer is very similar to Oliver's because there's actually no right or wrong way. And in fact, it's actually what is more suited for the client's need. So for instance, if like we do have clients who are very busy managing their schedule, like from businesses to family and to work. So it's very hard for them to always eyeball and DIY their portfolio because they might not have the mental capacity or like the energy to monitor the market day in, day out, to understand like, oh, is Fed going to increase 75 basis points to this month, or is it 50, or is it 25 basis points? Like, how is this going to impact me? And they have no time to read all these news. I think having an assisted financial advisor to actually explain to you all the implication and tell you exactly how you should position your portfolio and to review them on an ongoing basis with you and knowing your exact needs and your, your investment goals is actually very important. But like I said, having a DIY portfolio isn't wrong as well because some of clients might think this as a hobby, and I do think that there's a lot of investors out there are just curious to find out more, like, finding, like learning about bonds and reading into all the annual reports, digging through all the numbers and, grinding through all the hard works and all the elbow grease. Yeah, so there's nothing wrong about that. But I would just want to draw a parallel to like renovating, because recently I just renovated my house a year ago, and actually I was actually faced with two choices: to actually engage an interior designer, an ID, or I could actually engage my own carpenter, painter, tiler, and then design my own house to my own liking. So I mean, regardless whichever you're choosing, the ID route or the painter, carpenter route, one of them, of course, you need a lot more effort. You need to go research, ask your friends which brands of tiles or like which paint of brand of paint would be more suitable. Whereas for an ID-wise, they manage your entire renovation timeline, including liaising like when should the aircon people come in to set up the pipings, and when should the painting be done, and so on. So obviously for my schedule-wise, I think I'm not a really expert in this case. I just hired an interior designer. But if those of my friends who have contacted, like do their own, finding carpenters and tilers, painters themselves, their overall house maybe look perhaps probably more their ideal version of the house versus like if they went through an ID, maybe some of those things might not be as communicated as well. So at the end of the day, there's really it's a personal choice, not a binary decision whereby I can only use DIY or should I get only an advisor to assist on the portfolio.
Okay, so if I hear you rightly, you're saying that people who do not have enough time to manage their portfolio, they will be better off with an advisor, given your analogy.
Yes.
And also you said that for those people who like to experience it as a hobby, they can still do it DIY.
Yes.
Don't know how many of you are experiencing this as a hobby. I hope it's not too expensive for you over the past year to date. So the other question, like, do you, on your side, course, I'm sure, of course, it'll be hard for you to reject client if they ask for advice, continuous basis, or treat you like an advisor. Are there any clients that you feel like, go and tell Jean-Paul, sorry, I think this client would be more suitable if he goes to another platform and get some help by advisor?
Yes.
What kind of profile are these kind of clients?
I would say generally there are a few kind of profile. Like for instance, like I mentioned previously, those investors who are very, very busy on their own and yet they want a very active form of management of their portfolio. They don't want to eyeball it themselves and they rather have a trusted professional to actually manage for them and update them to keep them updated of what's going on. So I think this set of investor would be more suited for that. And also for Oliver Wise, he does more holistic, financial planning and wealth planning. So I think if clients who wants to have an overview of their portfolio, including like insurance and legacy planning and so on, talking to a financial advisor that will be able to give you a whole roundup of your portfolio, not only just the investment aspect of things, because FSMOne, as myself as an investment advisor, I only give investment advice, not really on the insurance or like the legacy planning of things. Yeah, and also lastly, I think for clients who are not very tech savvy, I would say, because FSMOne is an online platform, so a lot of things has to be done online, either through the mobile app or you can go through the website to do it. So some investors are not comfortable using these kind of a mobile platform and do not have the confidence to place trade and would prefer like a face-to-face interaction. Then I think knowing somebody there, a trusted professional to help you transact in all your trades would be able to elevate that kind and give you that kind of confidence to do your own portfolio and how to go about investing.
Okay, great. How about Olivia? In your line of business, of course, in advising clients, the more the clients, the merrier it is for you. Have you come across any business prospect that you think that this guy is not suitable for you, not suitable for both of you to work together?
It's very true that, of course, in our business, the more money we manage, the more income we earn. So usually when you start in this business, you try to have as many clients as you can. As you grow older and as you become more successful, it's true that you become sometimes more careful about adding new clients. So when I talk to prospects or when I try to talk to new clients, I always want to make sure that we share the same vision, the same strategy. So often I will ask my new clients or my prospects, do you want me to double your money next month? Because if you want me to double your money next month, I don't want to work with you. This is not what we do. This is not a casino. So it's very important for me when I take the time to bring new clients that they understand about the long-term exercise, that they understand about the patience, the discipline, that there will be time in the markets that are not pretty, like now. So I think, if we share the same vision, if we share the same strategy, and we have this long-term vision, then of course I'm delighted to work with new clients over the long term. But if they don't have the same strategy and the same vision, then I'd rather not work with them.
How about doubling my money in 6 months? Just kidding. Okay, so while you're giving advice to other clients, I'm sure you have been managing your own portfolio. So from your perspective, what do you think is the most challenging aspect of managing your own money?
When you help clients with their money, it's difficult. It's a lot of pressure. It's a lot of responsibility. My clients, they work hard for their money. They save their money. And then they trust me with financial advice on how to invest that money. So it's a difficult situation. It's a difficult job. And when I started in this business, I always said to myself, I will recommend to my clients what I would recommend to myself, what I do to myself. So do I have an iFAST portfolio with my wife? Yes. We actually have 4 portfolios. We have a joint account, 2 personal accounts, and 1 iFAST portfolio for our daughters. So the way I do my job is I very much recommend to my clients what I do. And so in my own portfolios, in my own investments, I have very much the same type of investment that you will see in my clients' assets. So this is the way I can manage the pressure, the responsibility of doing that. It's true that as an advisor, we have certain restrictions on what to invest and how to invest, but it's really the same approach of patience, discipline, and going through the long-term exercise. So I do very much the same thing that I advise my clients of doing.
Okay. How about Kat? Yourself, you advise clients, you teach them how to DIY, right? What about for yourself? What's the challenge of managing your money, or would you rather to have an advisor look after it?
Yeah, I mean, being in this line, I read about market news every day. So, I mean, to be honest, I mean, looking at market performance is definitely shocking. And for myself, my portfolio isn't, because I do have a very huge percentage exposed to equities. I mean, for my age, I don't plan to use the money anytime soon. So I have a very long-term investment horizon. So technically, my portfolio is a little bit more aggressive. So with a high equity exposure, I think I'm looking at the losses or like the lower returns as everyone is looking at their portfolio right now. Yeah, so the challenges for me managing my own portfolio is, I would think the number 1 challenge is emotional challenge, because I'm also human. So when I see something that's in the red in my portfolio, I will second guess myself, like, is this the correct move that I'm doing? Like, should I switch out? And I would think that for my investors, clients on FSMOne platform who do have the same questions as well, especially if they do not have someone to talk to and then they sell on fears, or buy on rumors. Yeah, so end up the portfolio will always not be performing that well because you just read the headlines and then you just sell on these news. So I think it's very challenging, especially for someone who do not have that knowledge or like the patience to read through the news, to dive deeper than the headlines and to read in between those catchy, catch liners news. It would be good to talk to an advisor to just get sorted out with the investments aspect of things, to understand exactly how, why, and what's the market going to do moving forward.
Okay, so these are the challenges, and of course, it is actually very suitable now. We have been through a challenging time year to date. I think the US S&P 500 down about 20%. If you're in tech, you probably suffered downside of about 30%. So given this current inflationary outlook and that central banks are all on a tightening cycle, and of course we have seen higher odds of recession coming on, how would you advise us to deal with such challenging time? Maybe we'll start with Olivia first.
I think the answer is I don't know. It's sometimes important to remember that we don't know, and I tell my clients I don't know. I don't have a crystal ball. I don't have the numbers of the future. But just because we don't know doesn't mean that we cannot think, doesn't mean that we cannot look at the past and see what has been happening. So we know we had COVID in 2020, and then we had a massive amount of money being printed in 2020. And I think that was the right decision. The central banks very quickly printed a lot of money in 2020. The mistakes that they made is that they continue to print that money in 2021. And for me, that was very difficult because I never believed that inflation was transitory. I thought they're doing too much. They're sending checks to people who are not working, what we call helicopter money. And so I was very worried. In the summer of 2021, that's exactly 1 year ago, I actually took a very difficult and drastic decision to sell all US stocks and European stocks in all my portfolios. Now, usually we don't take such a drastic approach. And a lot of my clients did not understand and said, Oliver, it's 2021, stock market is going up, why are we selling now? And some of them were upset because for the rest of 2021, it was still going up. But now they understand. As you know, the first 6 months of 2022 have been very, very difficult, and now we have an inflation problem and we have interest rates. Of course, the big decision now is whether we are going to enter a recession or not. And the same people who told us not to worry about inflation, that it was transitory, are telling us, don't worry, we will not hit a recession. I don't believe that story either. So for me, of course, we are going to have a recession. The question is whether it's a mild one or whether it's a severe recession. Recessions happen before, they will happen again. We should not worry about recessions. It's part of long-term investing. But the difficulty is it going to be a very severe recession? And so we have to look today at what are the additional problems that we have. And for me, I see several additional problems that I am worried about. First of all, we have a very large amount of debt. The level of debt today is much higher compared to the 2008 Lehman Brothers crisis. And I'm not really worried about the corporate debt. I'm very worried about government debt. The debt in the US is gigantic, but it's America. They're in a position where they can have that type of debt. I'm very worried about the debt in Europe. My own country in France and Italy has a very large amount of debt. Now, you remember that when you have a lot of debt, but the interest on that debt is zero, it doesn't cost you anything to have debt. But it's not zero anymore. Interest rate in France, for example, I'm talking about a 10-year interest rate, they've gone up from minus 0.4%. Can you imagine? You get debt, and you actually get paid for having debt. That's already crazy. But the 10-year interest rate in France is now 2.5%. And every time the interest rate goes up by 1%, you will have to find 40 billion euro per year. This is how much the entire French country is spending on defense. So that's very worried. The other problem that we have, and we must not forget, is we have an aging population problem. Now that's a big problem because we haven't had this before. I went to a school in Japan recently. They used to have 750 children in that school 50 years ago. Today they have 25. You have 25 kids who are basically in a school that's so big because it used to have 750 students. So the aging population problem is something difficult. Of course, the next problem is going to be the very expensive cost to move towards renewable energy. You know what's happening in the world. You know how the planet is having all those problems. We need to solve that issue, but that's expensive, and we need to do it quickly. Finally, you have geopolitical frictions because China will become the largest economy in the world. The economy of China will become bigger than the economy of the US. Not per capita, but as a whole. So I think it's important to understand that, yes, we have a lot of issues, we have a lot of problems, and I am worried that this recession could be much more of a problem. So quickly, the question is, should we panic? No. Should we stop being patient? No. Should we stop being disciplined? No. We have to continue to do what we do. We have to continue to invest for the long term. We have to be careful about second-guessing ourselves. And we have to basically absolutely remember that when some asset prices go down, it's also a wonderful opportunity for the future. So I think we have to be prudent. That's definitely what I tell my clients. There will be a time for me to go back into the stock market in the US, but I would like to try to have the right timing if possible. So I think it's important we continue, patience, discipline, but it's okay to be prudent.
I see. Okay, great. So how about Catherine? What's your take now, given the the environment that we are in right now, and what Olivia has painted, even worse?
Yes.
What's your challenge? What would you advise your clients now in handling this?
I mean, what Oliver said is correct. We are looking at inflation highest in like decades, never seen at this level before, exacerbated by wars and, you know, the post-pandemic challenges. Yeah, so I do think that as an investor, I think what I always tell my clients is do not panic sell, because every time they read headlines like, oh, you know, S&P got the worst months in ages, or like the worst first half in like many years, so they will start to, you know, like, should I sell? Like maybe I could catch in at the bottom and try to enter again. So I think this kind of thinking is a little bit in a vicious cycle, because I exactly heard what they said that in 2020 during the COVID pandemic crisis. So I think trying to time the market is impossible. And of course, the direction, I do believe a lot of our investors have stayed for the session 1 this morning. They have heard about, you know, our FSM and iFAST, you know, investment outlook, about positioning into like companies of better credit quality, and also looking into value stocks, companies that can pass the rising cost of higher costs to investors. So usually they are the market leaders, the large cap, large cap companies. So I do think like it's very important to keep a very diversified portfolio, not only across assets but across different regions, because US, China, I mean, there's not a consistent country that tops the performance every single year. So I think this is generally what the advice that I give to my clients. Yeah.
Okay, stay diversified and don't panic sell right now.
Yeah.
Okay, I think I'll just ask one more question also to each of you, because just now, I think in earlier session, Stanley asked whether they have taken advantage of the various crises earlier on to add on to it, and I noticed that in 2008, nobody really bought into it. The COVID crisis, 2020, some of you bought into it. And this year to date, we have quite a steep drop in various markets right now. If you have to give an advice, just a speculative small amount of money, tactical approach, which asset class or which investment would you advise the client? We start with Kat.
Okay, I do think like speculative assets should be kept to a very, very minimal portion of the portfolio. But I do think like we do like China as a house view, and I think Chinese equities have corrected so much. There's a lot of pessimism that's being priced into the stocks. Whereas for the US side, I think a lot of them are still painting a pretty rosy picture, and I do think it's more attractive to go into Chinese equities compared to those more aggressive, I mean, speculatives like tech stocks and all in the US. Yeah.
Chinese equities. Yeah. What about Olivia?
Very difficult question, obviously. What you have to understand is that everyone is going to have different needs, different investment horizon, different portfolios. So it's extremely difficult to just throw a name or throw numbers in the hat. What I would say is that I always find it interesting that many people invest in stocks without fully understanding the risk that comes with investing in stocks. I always tell my clients that even if you have a well-diversified portfolio of stocks, you can lose up to 50% of your portfolio. Now that's very rare. NASDAQ is minus 30%, S&P is minus 20%, but it's possible. So a lot of my clients, they say, well, Oliver, I want to invest in stocks, but I only want to lose maybe minus 10%. But that's not possible. And that's really what we learn. What we are learning right now is we are learning about risk. So what I would say is that as long as you have a long-term horizon, as long as you have that patience and that discipline, you will be fine. But if you really want to invest for the next 6 months and hoping to make quick money, this is not how it's done. So I agree with Chinese stocks. I still own Chinese stocks in my portfolios. So I think what the most important thing right now is, rather than just going back into the market all at once, is perhaps you need to take some type of a strategy with, again, discipline. So maybe just start investing slowly, month after month, where you basically dedicate part of the cash that you might have, rather than just jumping in right now all at once. So sometimes when you take this more gradual approach, then you might have better results over the long term. At this point, it's very difficult for me to sit here and to promise you that the worst is over. Obviously, we don't know that. So I think it's important, on one hand, not to lose patience, not to panic. We need to go back. Prices are slowly getting more attractive, but perhaps at the same time, don't just put everything at this time yet. So that would be my answer to your question.
Okay, great. So we have heard from both my colleagues, and there is no wrong to trying to do it yourself or getting some help. In fact, it can be complementary. You can do it yourself as a hobby, like Catherine mentioned, or you can also at the same time engage a financial advisor who will be there to help to guide you more stable way of investing, like you have heard from Olivia, how he will approach the market and investing right now. So if I were to blend the last question that I asked them, where to invest, and Olivia said how to invest, you can actually look at investing into Chinese equities, but use a DCA approach. Okay, with that, thank you for joining us in this session, and thank you both panelists.
Thank you.
Thank you, Catherine, Olivier, and Wei Yi. It is now time for our quiz. This will be the last quiz segment for today. But before we head to the quiz, I would like to run you through some of the final segments of today's event. We will be moving on to the quiz, and right after the quiz will be our Q&A segment. This Q&A segment is a vital session where we answer some of your most burning questions, so make sure to stick around for that. Right after the Q&A, we will be starting our Lucky Draw segment. This Lucky Draw session will be the last one for the event as well, and right now I would like to remind all of you in the hall to drop your Lucky Draw stub at the registration booth located outside the event hall. You need to have done that in order to participate in the Lucky Draw. Without further ado, let's access the quiz. To access it, all you have to do is take out your event flyer and scan the QR code found on the flyer. Head to Event Live and click on iFAST Mid-Year Review 2022. The QR code can be found on your event flyer. All you have to do is scan it with your phone and head to Event Live. 6 winners ranked from 1 to 6 will be able to win $50 worth of Grab vouchers. So all you have to do to stand a chance to win is to scan the QR code, head to Event Live, click on iFAST Mid-Year Review 2022. Once you've logged in with your name and email, click on Agenda and Activities on the left-hand side menu. Under the Agenda section, click on Quiz. And then click on the Join Quiz button. You'll see the activity window displayed on the right. Note that after every quiz question, a leaderboard will be displayed so you can check if you are ranked our top 6. In order to rank the top 6, all you have to do is aim to answer these questions correctly in the shortest amount of time. We'll give you a bit more time to access the quiz. If you need help, you can raise your hand and our staff around will do our best to help you out. So once again, you can take out your event flyer and find the QR code on it, scan it with your phone and head to Event Live. Click on iFAST Mid-Year Review 2022 and log in with your name and email. Our team will do our best to get around to those who need help, but apologies in advance if we can't get to all of you. After you click the Join Quiz button, you will notice the activity window displayed on the right. We'll begin with a trial question. This is simply a warm-up round to help you get started with the quiz. If you're ready, let's begin. This will be a trial question. Remember to answer this accurately in the shortest amount of time. Our top 6 rankers who have answered this accurately and in the shortest amount of time will win $50 worth of Grab vouchers. Our team is still going around to help some of our audience out, so thank you for your patience. While we're waiting, let me get you excited with some of the prizes for our Lucky Draw segment later on. We've mentioned our grand prize to be our MacBook Air, but some other exciting prizes would be our Nespresso machine, as well as $500 worth of CapitaLand vouchers. So make sure to stick around for the final highlight of the day. Our team is still walking around to help you out, so if you haven't been able to access the quiz, you may raise a hand and we'll do our best to reach out to you. And while we're at it, let me remind you, if you happen to be our top 6 rankers who have won in the final quiz, make sure to take a screenshot showing the whole activity window. We'll need you to take that screenshot and email us by the 15th of July to claim your prize. Our quiz will begin any moment now. To our online audience, you're welcome to join us as well. And in order to join, same thing, all you have to do is scan the QR code on your event flyer. I see that some of us in the audience still need help. If you need some more guidance, all you have to do is scan the QR code, click on iFAST Mid-Year Review 2022, and log in with your name and email. On the left-hand side menu, click on Agenda and Activities. Under the Agenda section, click on Quiz. You'll see a Join Quiz button. All you have to do is click it, and the activity window will be displayed on the right. We have a sir in the audience over here who needs help. Our team will do our best to reach out to you as fast as we can. Thank you for your patience. If you're ready, let's begin. This is a trial question. What does IGM stand for? We have 4 options for you: International Global Merchants, iFAST Global Markets, iFAST Global Market Makers, and the last option, International Global Markets. What does IGM stand for? Answer this as fast as you can. Speed and accuracy are key to ranking top 6. And let's take a look at the results. Congratulations to all 83.74% of our audience out there. You have got this correct. The answer is iFAST Global Markets. We have a very small percentage choosing International Global Merchants and iFAST Global Market Makers. Some interesting results, but the answer is iFAST Global Markets. The correct answer is marked with a green tick that you can see on the right side of the screen. There is no leaderboard because this is a trial question. Let's move on to the actual question. Question number 1, which of the following is not a feature of bonds investing with iFAST? Option number 1, transparent bond prices. Option number 2, automatic purchase of new bond issues. Next, Bond Express initiative allows investors to diversify their bond portfolio. And lastly, dedicated bond research capabilities and holistic advice. Congratulations, the majority of you have got this right. The answer is automatic purchase of new bond issues. 84.3% of our audience have got this right. We will move on to our leaderboard. Currently, our top 6 rankers are Shiya, SCI 4000, Ross, Elaine, Yong, CH Yuan, and Sherman. But not to worry, even if you don't see your name in the top 10, right now, you still have a chance to chase up the ranks. All you have to do is answer as fast as you can in this next question. Dividends can be dangerous. Which of the following is not advisable? 4 options for you to choose from. Could it be watch out for dividend traps? Or look beyond dividend yield of a stock? We also have the option consider the stock's earnings growth potential or concentrate on building income generating portfolios. 4 options, make sure to choose one. Which of the following is not advisable? Congratulations, about half of our audience here have got this right. The answer is concentrate on building income-generating portfolios. 52.29% of our audience got this right. Congratulations. I see that the names of our rankers have changed. Currently, Elaine is number 1, followed by LOL 543, Shiya, AET, CH, and SSH. I see some familiar names ranking in the top 6 from our previous quiz as well. We can do this. Let's go on to the next question. Which of the following is not an investing mistake frequently made by investors? We're looking for an investing mistake. Not abandoning a good strategy too quickly, buying high and selling low, having unrealistic expectations, trying to time the market. Which is not an investing mistake frequently made? Congratulations, the majority of us have got this right. 71.31% answered not abandoning a good strategy too quickly. We will look at the leaderboard right now. It seems that the ranks have shifted. I see a lot of familiar names in our top 6 ranks, but our 7th, 8th, 9th, and 10th rankers have changed. So you still have a chance to climb up the ranks. This is the next question. Question number 4. Which of the following statement is mostly untrue when investing? We're looking for a false statement right here. Investors do not need to beat the market for decent returns. More effort does not mean better results. Accept periods of short-term underperformance and hold for the long term. Timing the market is better than time in the market. A lot of familiar statements are made right here. Which is untrue? Timing the market is better than time in the market. Congratulations, all 74.6% of you have got this right. Now, this is the leaderboard. I see that some of the names have replaced our top 6 rankers from the previous question. And we've got some new names in rank 9, I believe, and rank 8, G, JW, and Xiangrong 209. Congratulations. Moving on to the next question. This is the final question. You have one last chance to aim to be the top 6. What should property buyers do with the impending hike in mortgage rates? Should you buy more property to grow wealth and generate passive income? Or review affordability based on higher mortgage interest rate? Rush to sell investment property to avoid paying higher rates or frequent switching between fixed mortgage loans and floating rate loans. Congratulations! Almost all of you got this right. 90.55% of you chose review the affordability based on higher mortgage interest rates. Congratulations. And very soon we'll unveil the top 6 winners. Congratulations, Shiya, Elaine, LOL 543, SSH, AET, and CH. All 6 of you have won $50 Grab vouchers. If you see your name on the screen ranking between rank 1 to 6, please take a screenshot showing the whole activity window. Make sure your rank, your score, and your nickname can be seen clearly. Then email the screenshot and include your name, your FSMOne or iFAST Global Markets Singapore account number, and email to events@ifastcorp.com by the 15th of July to claim your prize. Just before I introduce the last speaking segment for today, once again, I would like to remind all of you here in the hall, in order to participate in the Lucky Draw segment later on, you have to drop the Lucky Draw stub found in your event flyer at the registration booth located outside. And now, let's move on to the Q&A section where we take your top questions for today. To answer your questions, we have John Paul Wong, General Manager at FSMOne Singapore; Terence Lin, General Manager at iFAST Global Markets Singapore; Yo Wei Ren, Senior Portfolio Manager of Research and Portfolio Management at iFAST Singapore; and Colin Low, Assistant Manager of the Research and Portfolio Management Team at iFAST Singapore. Moderating this session, we have Catherine Chua, Assistant Manager of Investment Advisory at FSMOne Singapore. Let's welcome them up.
Thank you for thank you for all of you for continuing to stay to the end of our event. So, and also thanks for all the questions that we have received in the Q&A. Just wanted to address one of the highly voted questions. We got like 10 votes on these questions. So, the question is asking if gold is a good hedge against inflation and in this commodity super cycle that we have predicted. So maybe for this question, I'll get Colleen to start.
Right, thank you, Catherine, for the question. So what I would say right now, off the bat, is gold is not a reliable inflation hedge because right now what we are seeing is gold is driven very heavily by real rates. So what is real rates? It is essentially your nominal yield subtract away the inflation compensation. So in fact, gold has a very strong negative correlation with real rates. And what we are seeing very recently is the real rates from deep negative is moving higher and higher. And the reason why it is moving higher and higher is that financial conditions are tightening and the nominal yields are rising much higher than inflation expectation. So but personal expectation is for real rates to continue rising because financial conditions are gradually tightening and the Fed wants real rates to be positive so that the financial conditions tighten further and to slow down the demand of the economy to essentially slow down inflation. So with this expectation that real rates is going to rise further and further, I think there will be more headwinds for gold prices. And if we were to look at real rates against gold price, the inverse of real rates against gold price, you can see quite clearly that gold had a very strong run earlier start of the year when real rates are in deeply negative area, and when real rates start to turn positive, gold declined very sharply. So with regards to that, I do not think that gold is a very reliable inflation hedge, especially in this environment. But looking at some of the other commodity asset classes, I see better reliable hedge. For example, if you look at during my presentation, I recommended the global natural resources, which has a weightage in, say, oil and gas, as well as base metal and coal and consumer fuels. So I think all these areas are even better hedged for inflation than gold. Yeah, thank you.
Yeah, I just wanted to add on to what Colin has said. I think our investment thesis for commodities at this point is firstly geopolitics. the Russia and Ukraine war is currently a major factor that is driving commodity prices because these two countries actually produce quite a lot of the commodities that we need, including agriculture and also energy products. But gold, not so much. The major gold producing countries in this world is actually China, Australia. Ukraine is actually not a major gold producing country. So if you look at how geopolitics will influence commodity prices and how gold doesn't actually fit into that definition, then I would say perhaps gold is not something that we are entirely positive on. And also the shift towards clean energy, the need for a lot of these green metals to be used in your wind turbines, to be used in the EVs. Gold is also not something that falls under this category as well. There is no structural forces that underpins the demand for gold in the future. And unfortunately, we don't think that gold is a very good hedge against inflation at this point.
Okay, thank you so much for your response. So I mean, riding on the point about the commodities like natural resources, there's another question that's asking about like U.S. shale oil production. Do you think it can make up for the global oil supply shortage? Yeah. So what's your view on that?
In short, my answer to that is no. At least in the short term, because there are constraints in terms of getting production up and ready in a relatively short period of time. So the US has already been pressing their own oil producers to produce more oil, but quite clearly they have not been able to do that. A couple of reasons. There are shortages of everything. Shortages of not just workers, but also shortages of equipment. So even if the US oil producers, they want to ramp up supply, it is also not so simple because they are facing shortages of everything, and these are causing bottlenecks. Just think about our airlines industry. There's been a very strong rebound in terms of travel demand, but yet at the same time, the airlines, they have also been experiencing shortages of workers, and this is causing them to not be able to meet the strong rebound in demand. So shortages of everything, I think that's one bottleneck. And also down the line, the refiners, there has also been shortages in refinery capacity as well. So as consumers, we don't actually buy the crude oil. The crude oil has to be refined by refineries before we can purchase them as petrol or aircraft fuel. So so there is also another layer of bottleneck downstream in terms of the refinery capacity. So all things considered, I don't think in the short run the US is able to ramp up production in enough to be able to replace the oil that is lost by Russia.
Okay, thank you so much for your insight. So following the next question, I think it's also one of a very popular questions by our investor. I think Terence would be good to help us to address this question. It's asking whether dividends should be, should they sell the stock or the security after when they get the dividends after they are being paid?
Yeah, so I think I saw this question, and there are a couple of elements in terms of what exactly is being asked. So I believe one angle you can come from is after a stock pays out a dividend, so normally the stock price drops, right, by the dividend amount. I think everyone knows this. So the short answer to should you buy or should you sell the stock after the dividend is paid out, the easy way of looking at it is, has the stock dropped more than the dividend amount and is now so-called cheaper than its intrinsic value or what you think is fair? Right, so that gives you an opportunity to buy a stock that's slightly undervalued. Or if the stock basically doesn't drop and people are sort of ignoring the dividend, you can also say that hasn't really factored that in. But putting aside the dividends, because I think those of you who heard me earlier, I think I was saying that actually dividends shouldn't be overly emphasized. Actually, the only reason why you sell a stock is because you don't believe in the fundamentals. You don't think that the stock is a good investment, whether or not the stock has paid out a dividend already. Because companies can pay out dividends for various reasons. They can also stop paying out dividends for many reasons. So it's not a good investment. It's not a good investment process to link those dividend payments with whether you should buy or sell a stock. I think that's the more important thing I wanted to emphasize. Yeah.
Okay, Ken, thank you for your question. Thank you for your answer. So moving to the next question, actually there's a lot more new questions that are coming in. And of course, I think the chatter around the room and around all the newsroom is all about pending upcoming recessions and, whether inflation will be kept under control. So I just wanted to open this question to the floor to see hold on, let me just put up the question here. So a lot of investors are asking, should we just wait for the recession, then buying on this, or what should be our view on it, and what are the first sectors that will show sign of it coming? Yeah, so perhaps I just open up to the floor.
Maybe I'll get started first. I think first and foremost, it's always a fool's errand to try to time the market, to try to guess when the market bottom is. I think at this point, there has already been quite a sharp sell-off, not just in equity markets, but also in fixed income markets as well. So I do think there are still opportunities within both the equity as well as the fixed income space. So within equities, I think China is one area that I personally am positive on, even if a recession is to come. So so that's my first point. I think it's impossible to find the exact bottom to invest in both equity and fixed income markets. You should invest when the price is right. I think that's point number one. Number two also, I think the word recession is quite scary because when we talk about recession, I think people tend to just think about the very deep recessions that they have seen in the past, like the global financial crisis. But I think this time round, if a recession does indeed come, I think there are also signs to think that perhaps the impact of this recession will not be as serious, as deep as the one that we have experienced during the GFC. So consumer balance sheets at this point still very strong. That's one point. And also number two, mortgage rates, even though it's climbing in the US, a lot of them, it's fixed for decades, which means that in a rising rate environment, we likely won't see a lot of new home sales over the next few months. But at the same time, we also likely won't see defaults, the scale that was being experienced during the GFC. And I think these are some of the reasons that underpin our belief that perhaps a recession, if it does come, it is likely not going to be as serious as that was experienced during the GFC. And I think there are still opportunities within both equities and the fixed income space.
Yeah, I just want to add that I think there's still a lot of things investors can do instead of waiting for the market to crash and then invest. For example, I shared earlier in my presentation, there are a few stuff investors can do right now during this volatile period to protect your portfolio. So one good thing is to diversify. Of course, if you find that, say, for example, your portfolio is heavily invested in, say, US markets, then the risk of recession in the US market, if you think is running high, then all the more you should diversify accordingly. So perhaps out of US markets into other markets as well as into other asset classes. So diversification is a very good tool right now to defend your portfolio. And another thing to do also is to rebalance regularly. So if you were to let your portfolio run for say, for example, this past year or so, the weights have actually drifted. So your original allocation have also drifted. So if you intend to diversify and then to maintain that diversification benefits, then you should also rebalance regularly to maintain that diversified allocation. So all these are different ways that you can do to inject some resilience in the portfolio in between if you think that the recession is coming and markets are going down.
Yes, and perhaps JP, would you like to share some insights?
Yeah, I think Wei Ren and Colin have spoken a bit more from the research point of view. So I guess the other maybe idea to bring is when the market expects a recession, that could have already been timed in the market already. So maybe the market has corrected partly because they anticipate that there will be a recession. So if the idea is to time my investments thinking that there's going to be a recession announcement coming out, then that could have already been factored into the market. So the question of timing it that way may not always work out well because the recession may indeed be expected. In fact, most market participants are increasingly anticipating that the US economy would have a recession. So we've seen the US market correct. And if the the economic report from the US comes out and turns out to be, let's say, better than expected, even if there's a recession, then actually the market could actually turn and rally. So timing our entry or exit from the different sectors or markets in that sense, it's very difficult to time it correctly, which is also why I think we always hear people say, time in the markets is actually a safer approach, because you don't want to time and then be out of the market if there's a sudden rally, because there could be a rally while there is a so-called recession, which has happened the previous quarter. So I'm just saying that, timing it in that sense is not an easy thing to do. So I guess time in the markets, and it's more of like what Colin said, diversification of the portfolios, and maybe during this kind of a volatile period, then just having a dollar cost averaging strategy where I don't put a lot of my cash into all the different markets that maybe I may like I like China, but I don't have to necessarily put 100% of my cash right now into China. I can just break it into smaller portions, and I just adopt a more dollar cost averaging or regular savings plan kind of strategy.
And Terence, okay. So
let's move on to something happier other than recessions.
Sure. So I also got this question on the question wall that's asking whether China tech stock are turning into value stock, and I thought it's quite interesting because I mean tech is always like a growth stock. So just want to see any insights on this.
I think given the extent of the share price decline seen in China tech stocks, I think value is starting to emerge in the sector. But ultimately, I think it doesn't matter whether China tech is a value or growth. If it's a growth stock, does that mean you're not going to invest in China tech? No, because there is very attractive value in this sector, very strong upside potential, and also clearly some of the factors that have been, causing the China tech stocks to sell off. A lot of these factors are starting to turn around. So answer to that, I think it doesn't matter whether it is value or growth. If it's a good investment, you should invest in it.
Yeah, maybe just a comment, because there's this whole value growth thing. So I'm not from the research team, so I'm not going to dwell into the mechanics there. But I think that, as I also sort of alluded to this earlier, that when you buy the stock market, you're always looking for growth, right? Because that growth is the thing that determines your stock price today. And even if you listen to what fund managers look at when they assess how good stocks are and why they include certain stocks in their funds, in the portfolios that they manage, it's not so much that a stock is cheap, okay, just in terms of the stock price and where it was before, but that the growth potential of the company is really something that most investors don't really think too much about. But that's what your fund managers are doing. They're worrying about that on a daily basis, right? So they have to figure out, is this company going to show strong growth? Can that growth be sustained? And of course, then that boils down to, after that, the price you pay for it. So I guess the Chinese tech stocks are in that sweet spot where you know that they are leveraged on an economy that has very strong growth potential. They are all so-called market leaders in their respective fields. At the same time, because of all these political uncertainties, the market is giving you a chance to buy that growth for the price of a value stock, right? So I mean that's just a comment on that sector.
Okay, Ken, thank you. And actually, I saw more questions about asking about commodities. I think this is also a question that, as an investment advisor, I do get quite a lot from my clients. Everyone's asking that a lot of these kind of stock prices within the commodities, like energy sectors and all, has really rallied up a lot. Like, are they a little bit too late to join this, bandwagon? And also, if let's say the recession really do occur, like, will commodity demand for it, collapse? Yeah. What's your...
Okay, so to answer the first question on whether it is already too late to invest in the commodity sector, my first comment for this question is that commodities should be seen as part of, as a hedge against inflation as part of your overall portfolio. If you're looking for something that is going to rally 40-50% over the next 2 to 3 years, then I think commodities may not be the best thing to go in right now. Commodities should be seen as a hedge against inflation. I think that's point number one. And there was a second question on demand for commodities if recession hits. Okay, so in the past, you'll see that the demand for commodities usually goes down if a recession hits. But this time around, if a recession does hit, I think there are also other factors that we need to consider, other factors that also drive the price direction of commodities. So geopolitics is one. The Russia-Ukraine war, that's a driver of commodity prices, and that was absent in the past. Another thing is the structural underinvestment in oil and gas infrastructure. The fact that we are shifting towards ESG, there is a lot of pressure on oil and gas companies to decarbonize, and the fact that they have not been ramping up supply over the past few years, and they have actually not been ramping up their capital expenditure for future oil production. So I think that is another structural issue that is likely going to support energy prices. And then there is the clean energy revolution. A lot of clean metals are going to be needed for this shift towards clean energy. So again, another trend that is likely going to underpin commodity prices. So the demand will be there. Maybe in the next few months, if a commodity fears rise, then there could be a slight dip in demand. But if you look at it in terms of a long-term investment in your portfolio, I think commodities does deserve a place in your portfolios.
Yeah, thank you for summing up so nicely. Yeah, so maybe moving on to like one of the last questions due to the time that we have. Maybe I just wanted to like ask everyone here, like what's your view on speculative assets? Is like commodities considered like a little bit speculative, and also leveraged products? Like because I think there was another question that was asking about those leveraged ETFs. Yeah, so just wanted to see what's your take on it, and like should investor even consider them? So maybe start with JP.
Yeah, maybe this morning I talked about cryptos a little bit, so I'll take that. And I'm assuming the question is from another Catherine as well. But I mean, we brought up crypto at iFAST Research since last year. I think Colin was the first analyst at iFAST who talked about why we shouldn't be invested in crypto. And the reason was, he gave a few reasons. I think the lack of intrinsic value, it's essentially a speculative gamble into so-called an asset class. We don't even want to call it asset class in that sense. So our view is we should not be invested in cryptos. When we mentioned this view about a year ago, it was before the crash that has happened in the last few months. So even by the end of last year, I think some investors at least, were still very bullish on crypto. But of course, with hindsight, we know that most of the cryptos hit a peak in November of last year. And when we entered 2022, I think there was not so much pessimism. But in the last few months, I think investors start to find out that the lack of fundamentals suddenly becomes an issue, when actually all along, most of the cryptos, if not all, have no fundamentals in terms of what's driving them. And I think the other thing we highlighted was if people are looking about digital currencies, there are actually many other options, including central banks across the world, including the MAS, looking at various digital currency projects. And those are the ones that are likely to have some usage of value, whether it's in terms of settlement of different trades between central banks globally. So to say that, let's say cryptos will be used as digital currencies, again, very far-fetched idea. So we came out and warned investors. And when it comes to the other part of the question, which is on leverage products, I guess there's a few ways of looking at it. Leverage products could be, for example, via the ETFs. Some of the ETFs that are invested in some sectors, like semiconductors. If you want to take a leverage view, which is bullish or bearish, you can via ETFs. But generally, for me, I would be cautious about leverage products or leverage options types of investments, simply because you're taking a more oversized bet on where the sector is going. For me, I try to just look at asset allocation along fundamentals, along asset classes that have shown historically for decades that we can rely on it. So whether it's equities or fixed income, and which is what I think Wei Ren does every month in terms of his update for the asset allocation for the managed portfolios. So I would rather stick to that rather than so-called leverage products options. Yeah.
Yeah. So maybe Colleen, you want to share your thoughts?
Sure. I'll share more regarding people considering to include crypto in the portfolio. So I do not think it's a good idea, and I mentioned that earlier. Apart from the reasons that what JP mentioned, I think crypto itself is a highly volatile product, as well as one with very high idiosyncratic risk. So the inclusion of it can skew the portfolio risk to very high level, and you do not want to do it, especially in today's environment. And aside from that, I think a key reason why we do not think it is a suitable product is also for the fact that we are unable to do any homework on crypto because it lacks fundamental. So it relies a lot on, or rather, I think it's a reflection of the greater fool theory, where essentially capital appreciation only comes when there's a bigger fool who comes to buy it at a higher price. And how they determine a higher price, it's hard to say because there's no fundamentals. They are unable to do homework on cryptocurrency to determine what is a fair price that you should be purchasing. So having all these attributes, I do not think that crypto fits into a well-diversified portfolio that is able to be more resilient in times like this.
Thank you. And for William, maybe your take on let's say commodities. Do you think they would classify something like a speculative asset?
I would say no. I would definitely not class commodities together with something like crypto, because crypto clearly, I'm not sure if there is a real demand for crypto. It's not backed by anything, and also no structural trends that underpins the price of cryptos. And like what Colin said, based on the greater fool's theory, the value of crypto is based on what the next person is willing to pay for it. So no fundamental basis for value for crypto. But commodities, like I have already explained in my previous question just now, I think there's a real demand for it. There are structural trends that underpin the demand for commodities. So I think it is, I will not see it as a speculative asset. And also just to add one more point to this question, I think as we move into a new environment of higher inflation and higher interest rates, I think there are certain kinds of things that investors are starting to price, and one of those things is actually cash flows, which also means that the loss-making stocks that derive earnings far out in the future, I think the sell-off that we have seen over the past year, I think that is going to be permanent. And cryptos is also something that doesn't produce cash flow. So I don't think that that is something that will likely work as we move into this new macroeconomic environment.
Yeah, so I'm actually a student of financial market history. So when I look at cryptos, cryptos are fairly new to the marketplace. I think they've only become popular in recent years. And of course, there's this expectation that you will make as much money as your predecessors in the asset class. But I guess what people don't see is some of the parallels to prior asset bubbles. I mean, I grew up with the financial market crash of 2008. And people seem to forget that there was this big problem in the US housing market back then, where a lot of loans were made out to people who didn't deserve them. And because of the way the loans were structured, they actually looked like good assets. And basically, banks all around the world bought huge amounts of these assets. And actually, the main reason why the markets didn't look like they were going to end crashing is because the banks were all leveraged. That means you had a balance sheet that you had to borrow money to sustain an asset. And that asset price suddenly didn't have a value. So I guess today, if in crypto you say that people are purely speculating, you speculate with your own money, I think that's less of a problem, unless, of course, you speculate a lot more than what you can afford to lose, right? So you hear of people losing a few $100,000 in anyone's context. I think that's quite a lot of money. But of course, if it's $1,000, $2,000, it's a mistake you can afford to take. Where I am a bit more concerned is the future derivatives of how crypto is being used or viewed as an asset class. And when you take money that doesn't belong to you, whether it's corporate money, whether if you are a bank and you buy some of these crypto assets, you must be prepared for a future where these assets could be worth close to nothing. And the implications on your shareholders, the stock prices, the industry that you're in, I think that could be quite a major problem. Yeah. So I just want to say that in the context of where asset class bubbles happen. I think the implications are always to do with leverage, to do with borrowing money to buy things that really don't have a fair value. Yeah. So long story short, don't borrow money to buy crypto. Yeah. Okay.
Yes,
Yep.
against a rising interest rates environment, borrowing money to buy something very speculative definitely doesn't sound good. Yeah, so thank you everyone for staying around for our Q&A. So that's the last question that we have wrapped up. From now, I will just pass back the time to Gladys. Yeah.
Thank you, John Paul, Terence, Weiren, Cullen, and Catherine. Before we head to the lucky draw where many prizes are about to be won, I'd like to share with you some of the happenings at FSMOne.com. If you don't have an FSMOne.com account yet, open one today and receive 5,000 rewards points. Also, if you know of a friend who does not have an account, get them to open one and both you and your friend will receive 5,000 rewards points each. Remember to enter the promo code as shown on the screen. For more information and details, please refer to our event flyer with the QR code. If you're new to iFAST Global Markets Singapore, receive 5 Singapore dollars in your IGM cash account when you successfully open your first iFAST Global Markets Singapore account. And if you're an existing client of iFAST Global Markets Singapore, both you and your referee will receive 5 Singapore dollars in your IGM cash account when you refer a friend or family member to successfully open their first iFAST Global Markets Singapore account. Same thing here, remember to enter the promo code as shown on screen. And for more details, refer to our event flyer with the QR code. You can also capture opportunities in turbulent markets with FSMOne.com and iFAST Global Markets and receive $10 of bonus units for every $10,000 invested in selected unit trusts. On top of that, for a limited time, you can enjoy 2 free trades on selected ETFs. Head over to FSMOne.com and iFAST Global Markets websites to find out more about the offer. And now, it is time for our lucky draw. Let's invite on stage Mr. Jean-Paul Wong, General Manager, FSMOne.com, to give away the lucky draw prizes. A round of applause. To everyone here in the hall, if your number is called, please come up on stage to collect your prize. If the winning number is not present, we will do another draw. The first prize for this round will be a Nespresso machine with a frother. Jean-Paul, please. Doing a really big stir. We have 3 prizes for this round. The first winning numbers are 8, 3, 2, 6. 8, 3, 2, 6. If you're here, please come up on stage. Congratulations, sir! You have won yourself a Nespresso machine and frother. He looks a little bit confused, but also very happy. Please collect your prize and take a photo. Smile for the camera. Congratulations once again. Moving on to our second prize. This will be $500 worth of CapitaLand vouchers. Let's see who our winner is. Our winner is the person with the number 8, 3, 6, 3. A lot of disappointed sighs. Do we have a winner? Congratulations, sir. 8363. Our lucky sir over here has won himself $500 worth of CapitaLand vouchers. Please take a photo and smile for the camera. Congratulations. And now, for the final and grandest prize for today's event, we will be giving away a MacBook Air. That didn't sound very shocking. We will be giving away a MacBook Air. Thank you for the support. And now, John Paul, do the honors. I heard a number. That was not it. The number is 8452. 8452. Very close to an 8, but it's 8452. Do we have a winner? Congratulations, sir. Many close winners, but 8452. Congratulations, you have won yourself a MacBook Air. Please take a photo. Congratulations once again to all our winners, and thank you, John Paul. This wraps up iFAST Mid-Year Review 2022. Thank you, all of you. We hope you have enjoyed and taken away useful lessons from the various segments and presentations, and will be able to put the lessons learned today into practice. Here's to wishing you good health and a profitable investing journey ahead. Thank you all, and goodbye.